It's a pretty lovely good evening once again from here in Delhi, and hope as always each one of you are absolutely fine, happy, and of course in fine spirits. So, coming directly to the business end, we pick up this particular Ind AS which you are seeing on your what we call screens, that is Ind AS 8. Each one of you by now very well aware that this particular standard is pretty simple, and at the same time, not a single case study is given in your module. Unfortunately, should I say. But anyway, even though it is not quite a bit very important, and moreover, if we are going to actually have a look over the last 3-4 attempts paper, we didn't find any single question is striking from this particular Ind AS. But in spite of that, we need to do that because it is also a part of your syllabus. So coming over to the intricacies of this particular standard. Now this is a simple standard, as I told you. Now this particular standard simply provides guidelines with respect to an entity with respect to selection of accounting policy. Likewise, if an entity is going to change its accounting policy, then how it should go for such change. So direction in respect of that are also provided by this particular standard. And besides that, this standard will also talk about what we call changes in accounting estimates and similarly correction of errors. Coming over to the first part of this particular standard, that is what we call accounting policies. Now, if we are going to pick up this particular part, accounting policy, this standard simply gives us some direction in the selection and application of accounting policy. For example, if you are an entity, quite obviously, every entity wants to have a specific, proper, appropriate policy with respect to a particular accounting treatment. For example, one of the entity might be interested in having a what we call might be interested in deciding whether they should have cash system or accrual system or hybrid system of accounting. Similarly, other entity might be interested in having a particular accounting policy for what we call depreciation method, straight line or written down. Similarly, other entity might be interested in having a particular accounting policy with respect to valuation of inventories. Should it what we call go for inventory valuation of inventories on the basis of FIFO or what we call weighted average. So similarly, there are several areas where an entity actually has to decide which will be the most proper, appropriate accounting policy. So in that respect, this particular standard is going to give us some directions. And similarly, this particular standard states that if entity wants to have an accounting policy with respect to a particular transaction or events, but at the same time, no guidance is available for that particular event or transaction by any Ind AS. In that case, the management of the entity must apply the judgment and frame an accounting policy which is relevant and reliable. This is the another point this particular standard actually provides. Another important point is that once the accounting policy which has been selected by an entity, the entity must continue with that accounting policy. That means there should not be what we call any changes. However, sometimes changes become imperative. Your first priority should be to keep the what we call accounting policy on a consistent basis. But in spite of that, sometimes we have to change the policy because it becomes imperative. And changes in accounting policy is generally required, as you know, when there are changes in Ind AS or for the distance changes in law itself. So at that time, we have no alternative but to change our accounting policy. Similarly, sometimes accounting policy is changed by an entity simply to have more reliable and fairer what we call information. Correct? So these are the what we call situations when an entity may have to change its accounting policy. Now coming over to a very important aspect, following are not changes in accounting policy. Following are not changes in accounting policy means, for example, if there is an entity and it is applying an accounting policy, or for that instance, it is applying an Ind AS on a particular transaction or event which is completely different from the events which have taken place earlier. So when we are applying an Ind AS on this particular event which is taking place now, and it is completely different from the event which has taken place earlier, so it cannot be considered as changes in accounting policy. Similarly, if we are going to apply an Ind AS on an event or transaction which did not occur earlier, so even in that case, it cannot be considered as changes in accounting policy. Just to elaborate the point, let's have a look over this particular case study. Now, in this particular case study, as you can see, we are being given that there is an entity by the name of F1 Limited. Now, F1 Limited has classified an owner-occupied property as investment property. So there is an entity by the name of F1 and it is having an owner-occupied property, OOP. It is having a property which is owner occupied, and now it has classified this property as investment property. Correct? Further, it is stated in the question, it was being measured as per revaluation model. That means this entity earlier, it had classified this property as owner occupied property, and it was measuring it as per revaluation model. And now this investment property has been classified as an investment property. The question is asking now, can entity measure this investment property as per revaluation model? This is the question. Can we measure it as per revaluation model now? So in order to actually seek the answer to this particular case study, first of all, you need to know what exactly the investment property and investment property are. So in order to understand this, first of all, you need to know actually, this is entity F1. As I told you, it is having a property, and this property is owner occupied. This property is owner occupied right now. Now, what is an owner occupied property? An owner occupied property is one which is held by an entity for the purpose of production of goods and services, or for supply of goods and services, or for administrative purposes. Is it clear to you or not? What is an owner occupied property which is held by an entity for the purpose of production, supply, or administrative purpose? So if you are having a property and this property is meant for production or for supply of goods or for administrative purposes, it will be classified as owner occupied property. An important point is that an owner occupied property is covered by Ind AS 16. That means it is simply considered as a non-current asset, and you are going to reflect owner occupied property under the non-current asset. Is it clear to you? And we have already gone through Ind AS 16, where we have seen that subsequently an owner-occupied property, or for that instance, any asset under Ind AS 16 can be measured through cost or what we call revaluation model. So that is the reason actually it is given in the question that when this property was owner-occupied, this entity was measuring it as per revaluation model. But now, this property has been classified as investment property. Now, what is an investment property? Actually, first of all, you need to know that investment properties are covered by Ind AS 40, and Ind AS 40 is not part of your syllabus. But anyway, investment property. What is an investment property? Property which is held by an enterprise for the purpose of rental or for the purpose of what we call capital appreciation. That means entity wants to actually get some gains out of this particular property rather than using it for the purpose of production, supply, or administration. So this is what we mean by investment property. So investment property is one which is kept or held by a particular enterprise, actually either for the purpose of earning rental income or for the purpose of what we call capital appreciation. And as I told you, now investment property is covered by Ind AS 40, and Ind AS 40 clearly states that any investment property must be measured at cost. So now we can conclude that after what we call categorizing this property, owner occupied property, into what we call investment property, now this entity cannot use a revaluation model. Now it cannot use the revaluation model. It will have to measure it as per cost. Is it clear to you? Now, similarly, there is another case study in this particular question wherein it is written that there is an entity by the name of F2 Limited. Now, F2 Limited is an entity, and it is having a building, for its administrative purpose. Now, this building is used by this particular entity for administrative purpose. Indirectly, it means presently this particular building is owner occupied building. Just a moment ago, I told you any property is categorized as owner occupied property if it is meant for production of goods and services, or for supply of goods and services, or for administrative purposes. So it is an owner occupied property that presently it is being categorized and covered by what we call Ind AS and Ind AS 16. Now further, it is written in this particular question that it is presented in the financial statement of 2023 and 24 as property, plant and equipment. I have already told you it will be presented under non-current asset as property, plant and equipment as per Ind AS 16. Correct? So far this particular building is being used by the entity for administrative purpose. Now what happens? So it is given that till up to 23-24 this building is owner occupied building. Now question states further here. Question is stating now that during 24-25 entity relocated its office to a new building. Now what happens? Company has relocated its office to a new building. Now this is a new building. So company has moved into a new building now. After moving into the new building, now what is stated? And lease the building to a third party. That means when this particular entity moved to a new building, it leased leased this particular building, because this building is now vacated, because earlier the office of the company was in this particular building, and now company has moved from this particular building to a new location in a new building, and this building has been leased out. Now, when company will give this particular building on lease, entity is going to earn some rental income. So indirectly, it means this building has now become investment property. Is it clear to you or not? And further, it is given very clearly in the question also, entity also reclassified the building as investment property. So it is given itself that now this building is being classified from owner occupied to investment property. But what is the question? Question is, should entity account it as change in accounting policy? The question is, when this entity classified this building from owner occupied to investment property, should it be considered as change in accounting policy? Now the standard says that if we are going to classify or categorize an owner occupied property into what we call investment property, so indirectly there is a change in accounting policy, because as per accounting policy now we are classifying it as per investment property. So a change in accounting policy due to change in purpose. Now here the purpose has changed, because earlier the purpose was to keep the building for administrative purpose, but now our purpose and intention has changed and we want to earn some income out of it. So whenever accounting policy is changed due to change in purpose, it is not considered as change in accounting policy. This is what exactly this particular standard states. So in this case, it cannot be treated as a change in accounting policy. This is the point which you need to learn. Correct? Another important point in this question is now how to apply the changes in accounting policy. How to apply the changes in accounting policy. This is another question. Now coming over to this particular part. See here, sometimes changes in accounting policy is due to the fact a new Ind AS has been incorporated. Obviously, if a new Ind AS will come into play, I will have to change my original accounting policy. But here, accounting treatment is very uncomplicated. It is not a very complicated one, because here standard itself will guide you how you are going to apply this particular change. So here no problem will apply when you are going to change the accounting policy due to what we call arrival of a new Ind AS. So in that case there is no problem. So when the problem would arise? The problem would arise only when change in policy is due to initial application of an Ind AS. Due to initial application of an Ind AS means, for example, there was an entity and it was following existing accounting standard. Correct? But in the current year, now first time this particular entity decides that we are going to follow Ind AS. So it is known as initial application of Ind AS. So at the time of initial application, if we are going to change some accounting policy, then some problem will arise. What sort of problem will arise? I will let you know. Or when change in policy is done by an entity voluntarily, sometime an entity may actually is interested in changing the accounting policy of its own. So that is known as voluntary change in accounting policy. So when there is change in accounting policy, either due to what we call initial application of an Ind AS, or for that instance, voluntary basis, in that case, why the problem is there? Because standard says that such changes will be applied retrospectively. And how we are going to apply such changes, this is the question. And in order to comprehend this particular question, let's have a look over this particular case study. Now in this particular case study, it is given to you, first of all, I have given the accounting year as 1/4/2005, pretty old date. Now on 1/4/2025 and is the accounting year starting on, and 1/7/2005, it is given here that E1, this entity, starts business. So on this particular date, this particular entity is starting the business and did not follow any specific method of valuation of inventory. So initially, when this particular entity started the business, it did not follow any particular method of valuation of inventory. However, in the current year, now current year is 24/25. See here, earlier the accounting year given in the question is 1/4/2005 and 2026, and almost 20 years later, in the current year, this entity decides that when in 24/25, this entity decides to apply Ind AS 2. So Ind AS 2, now entity is applying. Indirectly, it means it is clearly given now entity decides to apply Ind AS 2. It means this is first time entity is going for Ind AS. Are you getting my point or not? So this is a case of what we call changes in accounting policy due to initial application of Ind AS. And I just told you a moment ago, whenever there would be change in accounting policy due to initial application, first time application of Ind AS, in that particular case, we will have to actually do the retrospective treatment. Now, how the retrospective treatment is done in order to comprehend that, because sometimes student fraternity feel very complicated task whenever word retrospective comes into picture. Now, let's have a look over here. It is not as tough as it seems. First of all, you need to understand that from the perspective of the entity, this is your current year. 1/4/2025 and 31/3/2025, this is your current year. Now, because you are following Ind AS from this particular year, you have now decided to follow Ind AS from this particular accounting year. Now, when we are going to prepare our current year's financial statement, as you know better than I will have to present the comparative income statement also. So when I'm going to prepare the comparative income statement, that means my current year is actually 24-25. So I will have to prepare the comparative income statement. That means I will have to prepare the comparative statement for 23-24. But the important point is that I'm applying Ind AS from this particular point. From this particular accounting year, we have decided that we are going to follow Ind AS. If we are following Ind AS in the current year, we will have to prepare the comparative income statement. But you must remember actually one thing, that accounting year, now we are in the year 24-25, so automatically it means actually we have gone past this particular accounting year. If we have gone past this particular accounting year, you must also understand that financial statement of this particular accounting year must have already been prepared. But problem is that earlier we were following the existing accounting standard and not Ind AS. Even though the financial statement of this particular accounting year have already been prepared, so now we will have to actually prepare again the financial statement of 23-24 in the light of Ind AS. Are you getting my point or not? So, because first time you are following Ind AS in the year 24-25, so you will have to present the comparatives, and comparison can become possible only when your previous year's financial statement are also on the basis of Ind AS. So, put it in simple words, in the current year, 1/4/2025, you are going to prepare the financial statement, and obviously now you are going to prepare the financial statement as per Ind AS. And you are going to prepare as I told you, prepare the comparative financial statement, and comparative financial statement means previous year statement. And many people do not know, previous year statement is also known as earliest period statement. Comparative period or earliest period are generally used as synonyms. Is it clear to you or not? So now, what we are going to do, see here, on account of changes in accounting policy, with respect to inventory valuation in this particular case, obviously there may be some gain or loss. For example, as per accounting standard, because earlier we were following accounting standard, let us say our inventory valuation was coming to rupees 10 lakhs, correct? And now through application of what we call Ind AS, or new accounting policy, you can say, now let us say inventory valuation is coming to 12. So there is a gain of rupees 2 lakh, imaginary figures, correct? So this 2 lakh I will have to adjust. But the point is that how I am going to adjust it. So in order to adjust the same, on account of changes in accounting policy with respect to inventory valuation, any loss or gain shall be adjusted in the opening balance of equity. In the opening balance of equity, what we mean by that? This is your current year income statement, correct? These are current year statement. These are last year's statement. And on this date, you are going to make some adjustment. You will adjust the opening equity because you have revalued your inventory now. Earlier, as per your what we call earlier methodology, your inventory was coming to say 10 lakh, and as per new valuation, it is coming to actually 12 lakh. So there is a gain of 2 lakh. So you will have to pass this particular entry, inventory account debit, to retained earnings account. Retained earning is considered as a part of equity term. So directly or indirectly, we may say that on this particular date, I will have to now actually do the incorporation in the what we call opening equity. So that is why we may say adjustment will take place in the opening equity. And how the adjustment will take place, we are going to increase the value of the inventory by 2 lakh, and we are going to increase the retained earning by rupees 2 lakh. This is what we mean by what we call retrospective adjustment. In order to comprehend it better, we take another case. Let us say accounting year is starting from 1/4/2025, similar to the last year, similar to the last case, and accounting year is ending on this particular date, on 31/3/2026. And similar to the last case, here also it is given that E1 starts the business. E1 starts the business and adopted FIFO method. This time it is given in the question that this entity has started the business on 1705 and it went for FIFO method for the valuation of the inventory. Now, similar to the last question also, here it is given that in the current year, entity E2 decides to adopt weighted average. Now, because earlier we were following FIFO method, and now we have decided to follow weighted average method. So this is a case of change in accounting policy on voluntary basis. This change is being done on voluntary basis. So voluntarily we have decided to move from FIFO method of valuation of inventory to weighted average method of valuation of inventory. Is it clear to you or not? So in this case, how the adjustments will take place. So similar to the last question, actually, even in this case, we will have to adjust the opening equity. Is it clear to you or not? So in this case, entity has gone for change in accounting policy voluntarily. As such, change shall be applied retrospectively and adjustment shall be made in the opening balance of the equity. When we say in the opening balance of the equity, you need to understand on 1/4/2023, I will have to, because this is our current year's financial statement as per Ind AS. Even comparative income statement we will have to prepare, and of course those will be prepared as per Ind AS, and we are going to make what we call adjustment over here. If there is any gain, let us say on account of application of new accounting policy, the entry will be inventory account debit to retained earnings account, and in case if there is any loss, you are going to reverse the entry. But the important point is that you will have to adjust the opening equity. Is it clear to you or not? We pick up another important point here. In this case study, I have given to you that current accounting year is 1/4/2015, accounting year 1/4/2015 ending on 31/3/2016. And here it is given there is an entity by the name of E5 Limited, and it was using FIFO method for valuing the inventory. Now, in the current year, let us say 1/4/2023 to 31/3/2024, in the current year, this entity E5 decides to follow weighted average method. But important point here is that this time it is given, however, all previous records were lost due to virus attacks. So sometime, actually the rule is that when entity is going to change the accounting policy, rule is that when entity is going to have a change in accounting policy, either due to initial application of Ind AS, correct, or what we call on voluntary basis, such changes will have to be adjusted retrospectively. But sometime actually what happens, previous year records get violated, get what we call damaged. So here due to virus attacks, all the previous records got what we call, you can say, damaged, and we are not in a position to track the what we call previous year records. So how under such circumstances we are going to bring about the changes? So standard says that in this case, when retrospective adjustment is impracticable, it is not possible, then we are going to actually adjust it prospectively. When we are going to adjust it prospectively, what do we mean by that? For example, this is our current year. This is our current year, and this is our current year. Current year is starting from 1/4/2023, as I just told you, and it is ending on 31/3/2024. Is it clear to you or not? And obviously this is my last year, 1/4/2022 and 31/3/2023. Now this time I am not going to do the retrospective adjustment, so no question of what we call adjusting the opening equity. This is known as opening equity. So gains will be adjusted in the beginning of the current year itself. Is it clear to you or not? Any gain or loss will be adjusted here at this particular point itself. That this is what we mean by retrospective prospective adjustment. So prospective adjustment in case of accounting policy is possible only when you are not in a position to retract or what we call recover what we call past records. Is it clear to you or not? Is it clear? Now, besides that, there is another we have already covered. Initially, when I started this particular standard, I told you that basically this particular standard we are going to study under 4 sections, correct? The first section is selection of an accounting policy, and second one is accounting for changes in accounting policy, and there is another section, changes in accounting estimates. What we mean by changes in accounting estimates? Correct? Changes in accounting estimates. Actually here application is very simple. So whenever there will be change in estimates, standard simply says that such changes must be incorporated. Standard says that such changes in estimates, correct? Such changes must, see, obviously when we do accounting, we have to take various assumptions, and on the basis of various estimations we do the accounting. For example, in case of what we call depreciation, we only estimate that so much is the useful life. So there might be some change in it. So it is a case of change in estimate. Are you getting my point or not? So similar may be situation with respect to provision for doubtful debts, because on the basis of estimates, we create provision for doubtful debts. Again, there could be some changes in it. So that is a case of changes in estimate. So standard simply says that whenever there will be change in estimate, then accounting will be done, or it will be incorporated through prospective adjustment. That means here no problem will arise. Why? I will tell you in a short while. Standard. So any changes in estimates, if there will be any changes in the estimates, as I told you, it will be incorporated prospectively. Now what we mean by prospectively, just have a look over here. For example, let us say there is an entity, correct? And this entity on this particular date, let us say bought plant and machinery for rupees 5 lakh. An entity decides that it is going to charge depreciation at the rate of 10%. And entity also estimated that life will be 10 years. So on such basis, this entity has decided to charge what we call 10% depreciation on a straight line. Let us say at the end of the first year, we have reached, so now obviously we are going to charge a depreciation of 50,000, and written down value of this particular plant and machinery will appear at 4,50,000. At the end of the second year, written down value will become 4 lakh. Is it clear to you? And still remaining life is 8 years. Now, let us say from this date onwards, or you can say we have reached the end of the first year and second year. Now let us say in between second and third year, now this company went for what we call change in accounting policy and decide now to provide depreciation at the rate of 20% on written down value basis. Correct? In between second and third year, this entity decides that now we are going to change the methodology of the depreciation. So in this case, no retrospective adjustment need to be done. When I am going to reach the end of the third year, only thing is that what will be by depreciation, because at the end of the second year written down value was 4 lakh. So now I am going to charge a depreciation of 20%, that is 80,000. So at the end of the third year, this particular item will appear at 3,20,000. So changes in estimates will have to be incorporated prospectively. So there is no problem in this particular case. Now, we come over to the last part, that is change in errors. Now coming over to change in errors, correct? Coming over to change in errors, and I have a sort of, you can say, hunch that you may have a small question from this particular topic, correct? Changes in errors. First of all, you need to understand that if error is related, let us say this is our current accounting period. Correct? Current accounting period, CAP. And this is our comparative period, CP. This is comparative period. So what I have written here, if error relates to comparative period, in that case, entity is going to correct it by restating the item in the financial statement of comparative period. That means if the error is related to comparative period means period prior to what we call your current accounting period. If your error is related to comparative period, in that case, only thing is that we have to restate the comparative period financial statement. How do we do that? Point is this. And so in order to comprehend this, just have a look over here. Here it is given under case study 7. Under statement of salary of rupees 15 lakhs. Under statement of salary of rupees 15 lakhs. Indirectly, what does it mean? Suppose my salary payable in the last year was 50 lakh. Let us say I was supposed to pay a salary in the last year to the extent of 50 lakh. And when I am saying understatement of salary of rupees 15 lakh, that means last year I did not debit 15 lakh, I debited only 35 lakh. Are you getting my point or not? This is what we mean by understatement of salary. That means when you are going to write your expense at a lower value, that means profits of last year are actually inflated. Last year profits which you have reported are up by 15 lakhs. So it is a case of error. But further it is written understatement of salary of 15 lakh, and this error relates to 23-24. So this error relates to 23-24. That means last year 15 lakhs worth of salary was understated. Understated means you wrote at a lower value. Now, how will you disclose it in the financial statement of the current period? So your current period is given to you as 24-25. Now, if your current period is 24-25, that means your accounting year will start from 1/4/2025, end on 31st of 3/2025. You are going to prepare your comparative period statement, and the comparative period statement will start from 1/4/2023, end on 31st of 3/2023. And last year, because salary you wrote at a value lower than its original value by 15 lakhs, so obviously last year comparative financial statement will be adjusted. Actually, while writing the answer, you will have to write only this much. Salary expense shall be restated in the financial statement of 23-24, that is comparative period, will be restated, and right in bracket will be added. But indirectly, what does it mean? For example, this is your current year. In the current year, when you are going to do your financial reporting, you will have to prepare the current year's financial statement, and your current year's financial statement means financial statement of 24-25 you will have to prepare. Are you getting my point or not? Besides that, you are also going to prepare your comparative financial statement, that is 23-24. Is it clear to you? So, when you are going to prepare your current year financial statement, in the current year, along with what we call comparative financial statement, so whatever salary expenses were there earlier, you are going to increase it by 15 lakh because there was understatement of salary expenses. So that is what we mean by restatement. Restatement means now this salary expense will be reported at its true value so that we can find out the true profit of the last year. Is it clear to you? That is what we mean by restatement. So as an accounting professional, you need to understand actually how we have to restate and what exactly is the meaning of restatement. So very simple. In case of errors, if the error is related to the what we call comparative period, so only this much of treatment is needed. But at the same time, it could be a possibility, this is your second situation, it could be a possibility that error may relate to a period which is lying earlier than the current period, earlier than the comparative period. See here, as I told you, this is my current accounting period. Error may relate to what we call comparative period, or it may relate to a period which is falling earlier than the what we call your comparative period. So in that case, suppose error is related to this particular period, and it is now how actually you are going to adjust it. So this is another important point. So in order to find out this, let's have a look over this particular case study. In this particular case study, once again, I have given similar sort of question. Again, there is understatement of salary of rupees 15 lakh. But this time it is given error is related to 22-23. And question, and your current year is given as 2024-25. So you can see your current year in this particular question. Your current year is actually starting from 1/4/2024 and it is ending on 31st of 3/2025. 31st of 3/2025. Correct? Obviously, this is your comparative period, previous year. This is your comparative period 1/4/2023. And it will end on 31st of 3/2024. But problem is that this particular error is having relation with this particular accounting year, 1/4/2022 to 31st 3/2023. That means it is a case of error which is taking place in a period which is earlier than the comparative period. Which is earlier than the comparative period. So in this case, how the adjustment will be done? loss on account of salary. Loss on account of salary, obviously, because earlier we did not record 15 lakh worth of salary, or we recorded the salary at a figure which is lower than by 15 lakh. So now I am going to record this amount of 15 lakh. So obviously it is a loss now, correct? So loss on account of salary shall be adjusted in the opening balance of the equity, in the opening balance of the equity. And remember, whenever we say opening balance in the equity, that means we are talking about equity on this particular date, because this is our comparative period. We will have to adjust it because this error is related to this particular period. So we will have to adjust it over here itself. Is it clear to you or not? So this error will be adjusted, and because when we are going to record this adjustment, so ultimately it will be a loss. So our entry will become like this: retained earning account debit to salary payable account. On one side our liability will increase, and at the same time it is a loss, and this loss will be debited to retained earning, and retained earning is considered as a part of opening equity. So if error is related to a period earlier than the comparative period, your answer will be very simple. You will simply write your answer that this adjustment will be adjusted in the opening balance of the equity. Correct? You need not require to write exactly the date or something like that, but just to make you comprehend it better, I'm simply giving you example this way around. Of course, no one else is going to give you example in this way around. So this is exactly the treatment. And if you want to have a look over another question, so this is all as far as Ind AS 8 is concerned. I told you it's a simple question and not a single case study is given at your level. And this is the last one which we are going to pick up. And such sort of question may strike in the examination, even though so far I haven't, although I had a look over one question which was given in MTP, but that was very simple, similar to this one, even simpler than this one. You can easily manage it. So as far as case study 9 is concerned, here it is given: depreciation provision recognized as 1 lakh instead of 50,000. Error relates to 23-24 and your current year is 24-25. Now in this particular case, your current year is 24-25. Your current year is 24-25, and question is specifically stating that this error is related to last year, 23-24. And what is given here? Instead of 50,000, you wrote 1 lakh. So problem is that last year you wrote amount of depreciation provision as 1 lakh. Actually, you should have written 50,000. So in this case, what is happening? Because last year you wrote a higher figure, so profits of last year are little bit lower than what they should have been. Are you getting my point or not? So when you are going to adjust it, when obviously now the adjustment is possible in the current year, but when you are going to adjust it, last year profit will increase. So directly or indirectly, when in the current year I am going to prepare my financial statement for 24 and 25, this is current year, and obviously we will have to prepare the comparative financial statement, that is 23-24. Now because last year figure depreciation was written as 1 lakh, so I will reduce it by 50,000. So this is what we mean by what we call restatement. Correct? So now I will arrive over the correct what we call treatment, and obviously now my answer will be in this particular case, this will be adjusted through restatement in the last year. But how the readjustment is done, this is exactly what I have told you. So this is all about Ind AS 8. I have already told you it's a pretty small standard, although student fraternity ignore it, but I have already cautioned you so many times, at this level you should not neglect even minutest of the what we call things. You need to study, and we are over there. So on such count, on your demand, we are taking up Ind AS 12, and each one of you are well aware that it deals with income taxes. Now in order to understand the intricacies of this particular standard, without wasting much time, we come directly to the business end and start this particular session. In order to comprehend this one, just have a look down over here. We presume that the accounting year of a particular entity begins on 1/4/2026 and ends on 31/3/2027. We further presume that this entity has acquired a property, plant and equipment, let us say plant and machinery, for rupees 5 lakh. Also, we presume that this entity decides that it is going to provide depreciation at the rate of 10% on a straight line method basis. But at the same time, as you know, the depreciation rules are governed by Section 32 under income tax. So under IT rules, that is income tax rules, the rate of depreciation is 50%. Our entity has decided that we are going to depreciate this particular asset at the rate of 10%, while the income tax rules, as you know, which are governed by Section 32 of income tax, correct, wherein the rate prescribed is, let us say, 50%. Now, further you are being given that net profit before, or net profit or income before what we call tax and depreciation happens to be 10 lakh, and for simplicity's sake we presume that tax rate is 30%, correct? Now you presume that you are the accountant of this particular entity for a while. Now, presuming that if you are the accountant of this particular what we call enterprise, now you are going to compute the tax, and you are going to compute the tax by applying the accounting principles, isn't it or not? So as per accounting concepts, when I am going to find out my taxation liability, I will simply take into account the total income. The total income given to you is 10 lakh before depreciation. As far as item of an expense is concerned, in this case is depreciation, because you have purchased plant and machinery for 5 lakh and your entity has already decided that you are going to provide depreciation at the rate of 10%. So 5 lakh into 10%, that makes it 50,000. 50,000 is the depreciation. Now this is your what we call income before tax, and we have presumed that tax rate is 30%, so I'm going to make a tax provision of 2,85,000 as per accounting principles. So all in all, actually the point I just want to bring to your notice that as per accounting principle, we have seen actually our tax liability is coming to 2,25,000, isn't it or not? Number one. Number two, now presume that you are a very big officer of the income tax department, correct? You are a very big officer, not a small one, very big officer, high profile officer. And now let us say you are going to compute the what we call tax liability of this particular enterprise through application of what we call taxation laws. Now, if you are going to apply the tax laws, obviously you are going to take into account, first of all, income. Income obviously will remain at 10 lakh. But because income tax rules as per income tax rule given in the question, your depreciation rate is 50%, you are going to apply a rate of 50%. So that means you are going to provide a depreciation of 2,50,000. So what you have seen that as per what we call taxation laws, the income before tax comes to actually 7,50,000, whereas under accounting principle it was 9,50,000, isn't it or not? So because income as per taxation laws is 7,50,000, you are going to apply the tax rate. So ultimately we reach the conclusion that tax liability as per income tax rules is 2,25,000. Here one point actually I just want to actually make it absolutely clear in the beginning, and most of us sometimes tend to actually neglect this important but highly significant point. This 2,25,000 is the tax determined by the taxation authority without an iota of doubt, correct? But at the same time, you must understand in this particular case, ultimately entity will have to pay this much of tax. How much tax entity will have to pay? Should entity pay tax of 2,85,000, which is determined through what we call accounting principles, or what we call as tax determined by taxation principles? So this is the amount entity is supposed to pay. Entity is supposed to pay this much of amount. Are you getting my point or not? Now, obviously, when you will find that you are the accountant of the what we call entity and you have determined a tax liability of 2,85,000, oh my God. But now income tax authorities are telling you, oh my dear, you need not require to pay 2,85,000 because as per our principles, your tax liability is coming to 2,25,000. So you are supposed to pay only what we call 2,25,000. You may feel for a while very elated. Oh my God, 2,85,000 was our tax liability, but we are being asked by the government to pay only what we call 2,25,000. There is a straight gain of what we call 60,000, isn't it or not? It looks for a while and we may feel happy very about it, isn't it or not? But point here is that before you feel happy or sad, I will let you know later on. But the point actually I just want to discuss and hammer into your mind is one, you first of all must notice that there is always a possibility when we are going to compute the income before tax through application of accounting principle and at the same time what we call through application of taxation principle. More often than not, chances are more glaring that we are not going to have the same incomes before tax. Simply because of the fact that rules, correct, which we apply in accounting are a little bit different than the one actually which we apply under taxation. And this gives rise to differences in the ultimate tax liability, as you must have noticed. And in fact, this is exactly the significance, or this is exactly the chief reason behind the introduction of this particular standard, correct? So now the point here is that we are supposed to pay 2,25,000, but we were under an impression that we were supposed to pay 2,85,000 because as per accounts our tax liability was 2,85,000. But ultimately we will have to pay 2,25,000. But at the same time, here you need to exercise caution. You should not feel elated. As I told you, whether you will feel elated or sad, that I will let you know later on. So you should not feel, you should not feel elated. You might be feeling that we are paying only 2,25,000 even though our tax liability was 2,85,000. But ultimately this 60,000 you will have to pay at some or other point of time in future. So that is the reason, even though you are going to pay a tax liability of 2,25,000, still your tax expense will amount to 2,85,000. Now what we mean by tax expense? First of all, you need to understand in the beginning itself. The tax determined by the taxation liability is known as current tax. It is known as current tax. It is known as current tax. What is current tax? Just allow me a sip of tea. Yes, what is current tax? Current tax means the tax determined by the taxation authority. This is known as current tax. But there is a difference between current tax and tax expense. Now we will see later on. I will talk about all these terms later on, in fact. But there is a slight difference between the tax expense and what we call current tax. Tax expenses means ultimately which you will have to reflect in your income statement. Because ultimately now your income statement will have to be revised, because it is the duty of the enterprise to send what we call their proper statement to the various regulatory bodies. So ultimately we will have to revise our statement, and over there we need to actually put up tax expenses. Now how much tax expenses we will put up? Now in this particular case, I just told you, first of all, I am going to write the tax liability as determined by the taxation laws. We have already seen that tax liability determined by the taxation laws is 2,25,000. But at the same time, I told you, although there was a difference between the tax liability which were computed through application of the accounting principles and as well and what we call taxation principle, we found there was a difference of 60,000. But I told you at the same time, even though as per your accounts your tax liability was 285,000, but because taxation department estimated your tax liability to the extent of 2,25,000. So you might be feeling that you are supposed to pay lesser tax, because I just told you whatever liability has been determined by the taxation authority, ultimately this much of amount which you are going to pay actually in the current year. But that doesn't mean that you are going to reflect only 2,25,000 as the expense. In fact, your expenses will be equal to 2,85,000. Your expenses will be equal to 2,85,000. So you must have noticed, but point is that why I added here 60,000. Number one, I just told you that we need not require to feel elated at this particular point of time, because at some or other point of time in future, we will have to pay this difference of rupees 60,000. So that is why it is a sort of future obligation. And in more technical word, we will see later on that it is known as deferred tax liability. But what exactly we mean by deferred tax liability, deferred tax asset, I am going to explain it in a short while, but just wait for a while. So at this moment, you simply understand this way, that ultimately when you are going to revise your income statement, you are going to reflect over there taxation expense of 2,85,000. That means you are going to add deferred tax liability to the current taxes. Current taxes means the tax as determined by the taxation authorities. Is it clear to you or not? So ultimately your tax liability will be 2,85,000. Sorry, your tax expense will be 2,85,000, and you are going to reflect it as a liability in your financial statement. Now we move a little bit further. As I told you, because of the differences, correct? And we know now in advance that our tax expenses ultimately will be equal to 2,85,000. So the accounts department now will have to revise the income statement. Why the accounts department? Because ultimately it is the enterprise, it is the organization who is more responsible to what we call file its financial with the various regulatory bodies. That is exactly what I told you. So in order to revise their income statement, once again, they are going to write what we call 10 lakh as the income, because at this moment, this revised statement is being prepared in the accounts department. Obviously, as per accounts department, your depreciation is 10% of 5 lakh. So you are going to write over here 50,000. So income before tax comes to 9,50,000. Now see here. Now here you are going to write tax expenses. In order to write the tax expense, you are going to write the current tax first of all. What is current tax? Tax as determined by the what we call taxation authority, which happens to be 2,25,000. And here I have added DTL, deferred tax liability. The difference which was coming, I am considering it as what we call deferred tax liability. But why I am considering it as deferred tax liability and how I came to this particular conclusion, that I will let you know in a short while. Ultimately, 2,85,000 worth of expenses will be put what we call in the financial statement. Is it clear to you or not? Now I tell you, in this particular case, why I considered it as deferred tax liability. Now I'm trying to elaborate it. In order to elaborate it, first of all, you need to understand that under Ind AS 12, basically the approach which we follow in order to find out what we call deferred tax asset and deferred tax liability, that approach is actually known as balance sheet approach. And under balance sheet approach, what we are supposed to do, see here. Now, I'm taking into account the same story. As we saw earlier, the plant and machinery which was acquired by this particular enterprise in the beginning of the current year, that is on 1/4/2026, correct? So then we are going to reach the end of the year. If I am going to ask you a very simple question, what is the written down value as per accounts? Because in accounts, you are charging a depreciation of 10%. That means by the end of the first year, the carrying amount will become 4,50,000. And similarly, when I am going to ask you what is the written down value as per the taxation authority, because the taxation authorities are having a depreciation rate of 50%. So 5 lakh minus 50% of 5 lakh, that means the written down value of the asset will be equal to 2,50,000. Now in more technical jargon, we will call it as carrying amount. Carrying amount means written down value as per accounts. And written down value as per taxation authorities or as per tax laws is known as tax base. It is known as tax base. The carrying amount is also known as book base. It is also known as book base. Is it clear to you? It is also known as book base. Is it clear to you or not? Now, after having a little bit of understanding regarding the what we call tax base and carrying amount, actually both tax base and carrying amount signifies the written down value, but only thing is that from the perspective of the accounts, the written down value is known as carrying amount, and from the perspective of the taxation authorities, we are going to call it actually tax base. Is it clear to you or not? So once you have noted down the tax base, the next step is, what is the next step now? Under the next step, we will simply take into account the difference of these values, carrying amount and tax base. We finally conclude that the difference is actually 2 lakh. Now very important, because of this difference, the concept of deferred tax liability and deferred tax asset will come into picture. Now ultimately we will have to find whether this difference will give rise to deferred tax asset or whether this particular difference will give rise to deferred tax liability. Now this is the trillion-dollar question. The trillion-dollar question is whether this difference will give rise to deferred tax asset or deferred tax liability. I will have to figure it out. Now, what is the art of figuring it? Let's have a look over here. First of all, you need to understand that whenever there will be any difference between the what we call carrying amount and written down value, correct? We will take into account that difference, and ultimately we will have to figure out whether that difference is a taxable temporary difference or whether it is a deductible temporary difference. Ultimately, I will have to find out whether this difference, because ultimately this difference is going to give rise to deferred tax asset or deferred tax liability. Whether it is going to give rise to deferred tax asset or deferred tax liability, in order to conclude that, in order to assess that, I need to know first of all whether this difference is a taxable difference or whether it is a deductible difference. Is it clear to you? So how we are going to conclude whether this difference is a taxable difference or deductible difference, correct? Now, in order to understand that, first of all, you will have to actually look over here. See here, simple rule is that, and you need not require to cram these rules. Let me tell you, you need not require to cram these rules, correct? Logically, you will be able to understand, but first of all, pay attention. In order to figure out whether the difference happens to be a taxable difference or deductible difference, you will have to compare the carrying amount and the tax base, as I told you. Now, First of all, you need to see whether this difference is related to asset or liability, because this difference here is related to plant and machinery. That means it is related to an asset. This is the first thing which you need to assess. Is it clear to you? After assessing that you are dealing with an asset, now you are taking into account the difference of what we call carrying amount and taxable base. Now, if your carrying amount is more than the taxable base, then it is known as taxable temporary difference. Then it is known as taxable temporary difference. And if it is taxable temporary difference, what does it mean? That means this difference in future will be taxed, and the organization will have to provide account, and the accounts department will have to pay more amount of tax in future. This is what we mean by carrying amount is greater than taxable base. Means it is a taxable temporary difference that in future our entity will have to pay more tax. And so that is why when I say that it is a taxable difference, it means in future it is a sort of future obligation for you. FO, future obligation. And because it is a future obligation, it will give rise to, as I told you, deferred tax liability. Are you getting my point or not? So now coming back over to this particular point which I was discussing earlier. So you must have noticed I was telling you that this is the difference of 2 lakh. Ultimately, we have to find out whether it is a taxable temporary difference or deductible temporary difference. In order to know, first of all, we will have to check whether it is an asset or liability. It is an asset, number one. Number two, obviously, we will have to now compare the carrying amount and the tax base. And we find that here the carrying amount of the asset is more than the what we call tax base of the asset. So if carrying amount is more than the tax basis, now we reach the conclusion, and we have just seen that it will give rise to what we call taxable temporary difference. And whenever there will be taxable temporary difference, always deferred tax liability will take place. That means this difference, obviously this difference is a temporary difference, number one, and this is a taxable temporary difference. Now I am going to apply simply the tax rate of 30% to this difference, and we can now find out that this 60,000 is nothing but deferred tax, and this deferred tax can be deferred tax liability or deferred tax asset. In this case, it is deferred tax liability. So this is how in this particular standard you will have to move. Is it clear to you or not? Just to make the point a little bit more clear, we will see here, correct, later on we will see here that as far as differences are concerned, obviously the differences may arise, but these differences are basically divided into 2 types. One is known as what we call permanent difference, and another one is known as temporary difference. But remember one thing, that under Ind AS 12, we are concerned only with temporary differences. We are concerned only with temporary differences. Is it clear to you or not? We are concerned with only temporary differences. So, what are permanent differences? Name itself is suggesting, for example, donations. Correct? In accounts, when we are going to pay some amount as charity or donation, we can simply debit it to profit or loss account. But taxation authority will never ever allow us to actually debit it to profit and loss account. And this difference is of permanent nature. It will never ever get neutralized. So permanent differences are not going to play any role as far as this particular standard is concerned. We are going to check whether it is a temporary difference or not. So what is temporary difference? So temporary differences means differences between the carrying amount of an item in the balance sheet and the tax base. This is what we mean by what we call temporary difference. So whenever there is difference between what we call written down value and the tax base, carrying amount and the tax base, that is known as temporary difference, and only temporary differences give rise to what we call deferred tax asset. And that's exactly what I told you earlier, that temporary differences, now I am talking about only temporary differences. By now you are well aware that can be of 2 types, taxable temporary difference or deductible temporary difference. If there is taxable temporary difference, that means in future you will have to pay more tax, and that is the reason it will always give rise to deferred tax liability. But at the same time, if the difference happens to be, if this temporary difference happens to be what we call deductible temporary difference. Deductible temporary difference means in future you are going to get the benefit because it will reduce your income, the income of the organization, or for put it in simple word, from the perspective of the accounts. In future you are going to get some benefit, because in future you are going to get some benefit, it is going to give rise to deferred tax asset. Is it clear to you or not? Just a moment ago, I also told you, ultimately, in the financial account, we have to put tax expenses. I have to put tax expenses. I told you tax expense means the current tax. Current tax means the tax determined by the taxation authority. Now, if there is DTL, I will have to add to current tax to know the amount of what we call tax expense. However, at the same time, if there is a case of deferred tax asset, then I will have to subtract the same from the current taxes. Are you getting my point or not? To know the amount of what we call tax expenses. That means tax expenses is equal to current taxes plus deferred tax liability, or current taxes minus their deferred tax asset. Now, the main crux of this particular standard is that you need to develop this particular art to know whether the difference between the carrying amount and the taxable amount happens to be a taxable temporary difference or it happens to be a deductible temporary difference. Honestly speaking, you need to learn only one rule. You need to learn only one rule with respect to asset. I just told you with respect to asset, if carrying amount happens to be more than what we call taxation base, in that particular case, this becomes a taxable temporary difference. And if it is a taxable temporary difference, indirectly it means it is a future obligation and you will have to pay, or it will give rise to deferred tax liability, put it in simple words. At the same time, if carrying amount of the asset is lesser than the taxable base, in that case, it will give rise to deductible temporary difference. And deductible temporary difference always creates deferred tax asset because it is a future benefit for you. FB, it is a future benefit for you. Is it clear to you? Now, if you know the rules of asset, that is why I'm simply telling you, you simply learn the rule, only one rule with respect to asset, that carrying amount is greater than what we call tax base, and it gives rise to taxable, it gives rise to what we call more taxable amounts. That means you are going to actually give more taxes in future. So that is why ultimately it will result in deferred tax liability. If you are able to get this rule, then ultimately all the other rules can be framed by yourself. For example, if you know the rule that current asset is greater than tax base, ultimately it will lead to what we call taxable temporary difference. So automatically now you can conclude that if carrying amount is lesser than the taxable base, so it will give rise to deductible temporary difference, and deductible temporary difference means future benefits, and you will have a case of deferred tax asset. Now coming over to the liability. Now, if it is a case of liability and carrying amount is more than tax base, so first you try to remember this way, that if it happens to be an asset, and carrying amount happens to be more than tax base, in that case there is a taxable temporary difference. But if it is a case of liability and carrying amount is more than tax base, then the things will change. Now it will be deductible temporary difference, and it will give rise to what we call deferred tax asset. Similarly, with respect to liability, the other rule can be framed. Is it clear to you or not? We have already talked about what is tax based and what some basic terms, isn't it or not? So ultimately you need to know this particular concept, what we mean by what we call tax expense. Now, tax expense, as I told you, current tax, and current tax means tax determined by the taxation authority. So current tax plus deferred tax liability, or current tax minus deferred tax asset. Is it clear to you or not? So these are the points which you need to take care of. And just to give you a slight idea, just to give you a slight idea. For example, let us say there is an entity and it acquires a machine or cost of rupees 1 lakh, and depreciation charged under income tax on this particular machine is rupees 30,000. Now try to understand this. What is given in the question: an entity acquires a machine and it is appearing at a cost of rupees 1 lakh in the what we call financial statement. It means because it is given depreciation charged under income tax on this particular machine is 30,000, and income tax authorities have already charged a depreciation of rupees 30,000. So the point which you need to understand is that if I am going to ask you, find out the tax base. So first of all, you need to understand that carrying amount of the machinery will be considered as 1 lakh as per books of accounts. But as per tax base, the written down value of the machine will be equal to 70,000. Because in accounts, we haven't actually charged any depreciation. So here you can see actually carrying amount of the asset is more than the tax base. And I just told you a moment ago, if carrying amount happens to be more than the tax base, then it is going to give rise to taxable temporary difference. And taxable temporary difference means it will give rise to future obligations. Is it clear to you? So you simply take the difference, multiply it with the tax rate, and the amount which you will get will be known as deferred tax liability. Is it clear to you or not? Just to clear a little bit of an air of doubt, just have a look over this particular case study. Here it is written, an entity acquires plant and machinery of rupees 1 lakh on 1/4/2024 and depreciation per annum on a straight line method as at 31st of 3/2025, depreciation under income tax rules is 30,000. So entity acquires plant and machinery for 1 lakh and it is charging what we call depreciation at the rate of 10%. So by the end of 31st of 3/2025 in accounts, we have charged a depreciation of 10%, while depreciation under IT rule is 30,000. So by the end of the year, we can see actually the carrying amount. Carrying amount means the written down value as per accounts, or you can simply call it as book base. You can also call it as book base. Book base means the base as per the accounts books, and it is known as tax base. So we may say that book base or the carrying amount is 90,000, while under income tax 1 lakh minus 30,000 tax base will become equal to 70,000. Is it clear to you or not? So ultimately we reach the same conclusion because the carrying amount happens to be more than the tax base. Carrying amount is more than the tax base, so it will give rise to taxable temporary difference. Taxable temporary difference means it will give rise to future obligation. And if it is a future obligation, we will have to multiply it with the what we call taxation rate to get the figure of deferred tax liability. Is it clear to you or not? Now, if it is clear to you, then now we are in a position to take up what we call some questions from your module and all the examination questions. Just allow me a second because now I will have to actually open down that particular file. Here is the file. Now we come back to this particular point. So these are the notes actually. Is it clear to you? And so far I was simply discussing the basics, and now because I have already discussed all the what we call basics, now we come straight away to the examination questions, module questions, and your MTP questions. So this is the first question which we are picking up in this particular case, and this is from your MTP Set 1 June 2023. Is it clear to you? This particular question we are picking up MTP Set 1 June 2023. All the notes which I have written, all the handwritten notes cannot be sent to you. If you really want to note them, it is up to you. You pause it and note it down, because these are not paper sheets. These are impaneled sheet, and this time it becomes very difficult to download them. Even if I will download them, the things will not be absolutely clear, and we will get a what we call encrypted sort of what we call figures, and which becomes very difficult to read. So now, here in this particular case, Q Limited has an identifiable asset with a carrying amount of rupees 6 lakh. This question is from your MTP Set 1 June 2023. As I told you, Q Limited is there is an entity by the name of Q Limited, and it is having an identifiable asset with a carrying amount of rupees 6 lakh. In between, I forgot to have the tea right now. Further, it is given in the question, its recoverable amount is rupees 3,90,000. You have gone through this recoverable amount phrase somewhere in your standards. In which standard you have gone through recoverable amount, where we used to apply what we call recoverable amount. If you remember, you have done a standard by the name of impairment losses. Over there, we used to actually face this particular term, recoverable amount. Are you getting my point or not? And a recoverable amount means it is a higher figure between the fair value less cost of sale and value in use. So often you used this particular term. But anyway, so there is an identifiable asset. Its carrying amount is 6 lakh, but its recoverable amount given to you is 3,90,000. This is the point which you need to understand. Is it clear? Further, it is given in the question that tax base of the asset is 4,80,000. Now, tax base of the asset is given to you already, and the applicable tax rate is 30% is also given. Now, further here it is given impairment losses are not tax deductible. As you know, and better than I, actually under income tax, we are not allowed to actually provide for impairment losses. That means if any impairment loss takes place, an entity can debit this impairment loss to the profit or loss account as per the accounting principles. But as per the what we call taxation principles, we are not allowed to debit any impairment losses. Further, it is also written that Q Limited expect to continue earning profits in future. For the given identifiable asset, calculate the deferred tax asset or liability for the period as per the provisions of Ind AS 12. The first thing which you need to understand is that in order to find out deferred tax asset or deferred tax liability, point number one, what I need to find out actually, I need to find out first of all the tax base and the book base. Book base is also known as carrying amount as per books. Now, if I am going to toss up this question to you after having gone through this particular statement, let me know what is the carrying amount of this particular asset. And some of you, in the heat or in the anxiety, correct, give me an answer that carrying amount, sir, it is very clearly written is 6 lakh. Obviously, it is 6 lakh, no doubt about that. The carrying amount is 6 lakh, but in accounts books, this is the carrying amount and the recoverable amount happens to be actually 3,90,000. Out of these two amount, which amount you are going to carry in the financial statement? You have already gone through Ind AS 36, you have already gone through impairment losses. We have already seen that if the recoverable amount of the asset is lesser than the carrying amount, there are impairment losses, number one, and ultimately this asset will be reflected in the books at 3,90,000. So you need to understand this particular point, that even though here it is clearly written that this is the carrying amount, but ultimately which amount out of these two you would carry in your financial in the outer column. So in your financial you must have carried 3,90,000 by the end of the accounting year. So as per accounts, or the book base of this particular item will be considered at 3,90,000 and not 6 lakh. And that is the reason actually why I have written here, as per Ind AS 36, the revised carrying amount of the asset will be equal to 3,90,000. So this will be our carrying amount. Is it clear to you? Now we have to find out the what we call tax base. Now tax base is already given in the question. It is 4,80,000, clearly given. Now in this particular question, you tell me that carrying amount is actually 3,90,000. Carrying amount is 3,90,000. And you have already seen the tax base. The tax base is 4,80,000. Now could you tell me, I'm not asking you what is the difference. Obviously there will be some difference. I'm simply asking you whether this difference will be considered as taxable temporary difference, or it will be considered as what we call deductible temporary difference. Because if it is a taxable temporary difference, if it happens to be a taxable temporary difference, then it will give rise to what we call deferred tax liability. If it is a deductible temporary difference, then it will give rise to what we call deferred tax asset. So that is the reason you need to know actually what this particular difference ultimately will lead to, whether it happens to be a taxable one or deductible one. And in order to know that, I told you the rules. First of all, with a cool mind, try to know whether you are dealing with an asset, and 99.99% you would be dealing with the asset, let me tell you also. Anyway, so you are dealing with the asset in this particular case because we are talking about plant and machinery, number one. Number two, now the carrying amount in this particular case is not higher. If it would have been higher, it would have given rise to taxable temporary difference. But here, the carrying amount is lesser than the tax base. So this time, there is a case of deductible temporary difference. So now you will take the difference between these two. Your difference will be equal to 90,000. And because this 90,000 difference is a deductible temporary difference, deductible temporary difference means in future I will have future benefits. I will have in future some benefits. So I'm going to apply the tax rate to this particular difference and I will get 27,000. This 27,000 will be considered as deferred tax asset. Deferred tax asset. So ultimately, although it is not asked in the question and moreover information is also not given, but just to make the point clear, what will be ultimately your tax expenses? Your tax expenses will be equal to your current taxes. Current taxes means the tax as determined by the taxation authority, and from there on you are going to subtract deferred tax asset. You are going to subtract deferred tax asset to know the amount of what we call tax expense. Is it clear to you or not? So this is how you will have to move in order to solve the question. And this question is from your MTP December 2024. Now in this particular question, what is given to us? Let's have a look quickly. Here it is given company Y follows revaluation model to measure property, plant and equipment. So there is an entity and it follows revaluation model to measure property, plant and equipment. Company acquires an item of property, plant and equipment at a cost of rupees 20 lakh on 1st of April 2022. So this particular entity acquired what we call a property, plant and equipment, and It was acquired on 1st of April 2022. Further, it is given to you that useful life of the said property, plant and equipment as per accounts actually is 10 years with a nil residual value. So as per accounts, you are going to write it off this particular plant and machinery over a period of 10 years. On 31st of March 2023, property, plant and equipment is valued at 28,80,000. Correct? Remember one thing. You acquired this property, plant and equipment on 1st of April 2022 and you acquired it at a cost of rupees 20 lakh on this particular date. And when you are going to reach the end of the accounting year, so that is on 31st of 2023. Obviously, at the end of the accounting year, you are going to provide depreciation, number one. After providing depreciation, there will be some written down value, no doubt about that. But now the question states that on the same date, on 31st of 2023, this plant and machinery is revalued at 28,80,000. It is revalued at 28,80,000. So it could be a possibility, whatever is the written down value, correct? Because now it is being revalued, it may give rise to what we call revaluation reserve, or it may also give rise to what we call fall in value. Anything could happen. Now, further in this particular question, it is also stated that as per Ind AS 16 property, plant and equipment, if an asset's carrying amount is increased as a result of revaluation, increase will be recognized in other comprehensive income and accumulated in equity under the heading of revaluation surplus. You have already done actually Ind AS 16, isn't it or not, wherein we have already discussed this particular point that whether this information is given or not, it is always implied that whenever there would be any revaluation and revaluation reserve will get what we call created, that revaluation reserve is generally transferred to the other comprehensive income under the heading revaluation surplus or revaluation reserve. But that is taken generally to the other comprehensive income. So this information is given to you, but anyway, it is given to you fine, and even if this information would not have been there in the question, still we would have gone through this particular concept. For taxation purpose, the value of property, plant and equipment's cost is actually 20 lakh. Now we acquired this, but this at rupees 20 lakh, and for tax purpose the value of property, plant and equipment is also 20 lakh. However, the useful life for the tax purpose is 8 years. Useful life for the taxation purpose, that means in the eyes of the law, in the eyes of the taxation laws, actually we are having a life of 8 years, whereas as per accounting principles we are having a life of 10 years and with a nil residual value in this particular question. Now question says that examine the amount of temporary difference and the deferred tax, and it is given in the question, consider a tax rate of 30% in the light of what we call Ind AS 12 as on 31st of March 2023 and as on 31st of March 2024. So in this question, you are being asked to compute the what we call deferred tax asset or liability at the end of 31st of 2023 and at the end of 31st of March 2024. You have already gone through the story, just a quick one. On this particular date, you have acquired the what we call this particular plant and machinery, and under accounting concept, we have decided that we are going to write it off over a period of 10 years. But at the end of the first year, we also did a revaluation. So keeping that into memory, now we are going to solve this particular question. Now, how to solve this particular question? As you know, in order to solve the question, most important thing is that we need to know carrying amount, and carrying amount basically means the written down value as per accounts books, and it is also known as book base. And then we need to take into account the tax base. Is it clear to you? These are the two fundamental pillars around which entire the gamut of what we call this particular standard is based. Now, on 1st of April, when we acquired this, on 1st of April 2022, we acquired this machinery and the cost was 20 lakh. So that means in the beginning, although in the beginning we do not need carrying amount, but just to make the point a little bit more simpler. So carrying amount in both the books obviously will be 20 lakhs. Now we are going to charge depreciation as per accounts. If I'm going to charge depreciation as per accounts, how much of depreciation I'm going to give at the end of the year? Because we have already estimated the life to be 10 years. That means 20 lakh divided by 10. So 2 lakh will be the amount of depreciation. So in accounts, at the end of the year, I'm going to charge a depreciation of 2 lakh. Under income tax, as you know better than I, that instead of calling it as depreciation, we call it depreciation tax allowance. So anyway, so depreciation allowance as per income tax will be how much? Because under income tax, we have estimated the life to be 8 years. So 20 lakh divided by 8. So as per taxation laws, our depreciation will amount to actually 2,50,000. Is it clear to you or not? So now we have reached the conclusion that as on 31st of March 2023, that is end of the first year, the written down value or the carrying amount or the what we call book base is 18 lakh of this particular asset, while as per the taxation authority, it happens to be 17,50,000. 17,50,000. It is clear to you or not? 18 lakh. Now you tell me, I just told you, obviously we have to note the difference here. I have made another column, although it is not needed, but just for your better understanding. Now temporary difference. If there is a difference between the what we call carrying amount and the tax base, book base and tax base, it will be a temporary difference. But the important point is that whether this difference is a taxable temporary difference or deductible temporary difference. And in order to figure that out, you will have to actually be very well aware of all the rules. I've already told you, first of all, you are dealing with an asset here in this particular case. And as you can see, the carrying amount is more than the what we call tax base. Now, if carrying amount happens to be more than the tax base, so often now I have told you during the what we call discussion that it will give rise to taxable differences, taxable temporary differences. And if it is a case of taxable temporary difference, it is a case of taxable temporary difference. And if it is a case of taxable temporary difference, that means it is a future obligation, and that means here deferred tax liability will get created. Is it clear to you? So you are going to apply a tax rate of 30%. So that mean first of all, you need to understand 50,000 is the difference, 30% you applied, 15,000 obviously now is your deferred tax liability, as I just told you. Now this deferred tax liability will be reflected in the liability side. I also need not require to tell you, but point here is that on the same date, as I told you, a revaluation was also done. So as on 31st of March 2023, no doubt about that, this is the written down value. This is your written down value. However, because we did a revaluation on this particular date, now, as on 31st of March 2023, once again, we find that carrying amount has gone up to actually 28,80,000 as per what we call accounting concepts. Because in accounts, we did a revaluation, and remember one thing, there is no concept of revaluation reserve under income tax authority. So as on 31st of March, kindly pay attention here, as on 31st of March 2023, you must have noticed, now again, there is a case of what we call carrying amount, and the tax base will remain unchanged at 17,50,000. Tax base will remain at 17,50,000. But again, there is a difference. 28 lakh, now 17,50,000. Again, the carrying amount is more. Difference is 11,30,000. Because this, again, the carrying amount is more than the taxation base. It will give rise to what we call taxable temporary difference, which ultimately means actually future obligation. Again, deferred tax liability will get created. So now, first of all, I am going to apply 30% rate. Deferred tax liability got created at 3,90,000. At 3,90,000. Is it clear to you or not? Indirectly, it means, first of all, as on that means when I will prepare the financial statement, just for knowledge sake, when I am going to prepare my balance sheet as at 31st of March 2023. Actually, on 31st of March 2023, first of all, a deferred tax liability got created to the extent of what we call 15,000. Are you getting my point or not? Because a deferred tax liability got created to the extent of 15,000, so I'm going to write deferred tax liability that is equal to 15,000. Now, point here is that because of revaluation, again we had to do some calculation. Once again, on the same date, we did some calculation, and once again, we found actually that there is a case of deferred tax liability. So logically, on 31st of 2023, the final deferred tax liability which should appear in my books should be equal to 3,39,000. That means that means my deferred tax liability got increased by the difference between these two. I think 3,24,000. 3,24,000. Are you getting my point or not? Is it clear to you? See, whenever we are going to create deferred tax liability, ultimately our P&L will also get debited. So when you created a deferred tax liability initially, you are going to charge it to your profit and loss account. As a professional student, I simply do not want to learn you solve the question, but try to understand the intricacies. Whenever you are going to create deferred tax liability, you are going to charge it to profit and loss account, because obviously it is a sort of loss to you because you have to pay it in future. Now the point here is that when you increased your deferred tax liability, should you again charge this 3,24,000 to your profit or loss account? Logically, your answer is yes, because in India, we are preparing a single statement, single P&L. However, the upper part is known as P&L and the lower part is known as other comprehensive income. But when you are going to write in the examination, suppose if it is asked, in the question it is not asked, but just to make the point clear, 15,000 will be charged to profit or loss account and 3,24,000 now increase in deferred tax liability. This increase in deferred tax liability has taken place due to revaluation. Remember one thing, and because it has taken place due to revaluation, we know that revaluation reserve surplus is reflected under the other comprehensive income. And that is the reason actually here we are going to charge this. Instead of charging it to profit or loss account, we will charge it to other comprehensive income. Actually, I have just told you, in India, we are preparing one single statement, correct? As you know, all the companies which follow Ind AS, they have to prepare their financial statement as per Division 2. And as per Division 2, upper part is known as profit or loss account, lower part is known as other comprehensive. So, under the other comprehensive income, I will reflect this 3,24,000. This is the point I just wanted to tell you. Now, because question has also asked to compute the depreciation as at 31st of March 2024. Now, as at 31st of March 2024, again I will have to find out what we call carrying amount. First of all, you need to understand that originally this asset was acquired and at that time you estimated the life to be 9 years. So that means when you are going to you estimated the life to be 10 years and out of that 1 year has already gone by. So now when you are going to provide depreciation at the end of 31st of 2024, first of all, what will be your depreciation? The point is this. So now 28,80,000 is your value. Just allow me, 28,80,000, correct? 28,80,000. And because now the remaining life is 9 years, see here, this is your revised carrying amount, indirectly you can call it. And we have already done Ind AS 16 and over there we did lots of question on depreciation. So that should not be a big problem because of revaluation. Now this is the revised value. Now this revised value will be divided by 9 because out of 10 years, 1 year is already gone by. So in the next 9 years, if there is no change, in the next 9 years, as per accounting concept, your depreciation amount will be equal to 3,20,000 and carrying amount, now we can safely say that at the end of 31st of March 2024 will be equal to 25,60,000. Is it clear to you? And under income tax, we will keep on charging the depreciation at the rate of 2,50,000. So 15 lakh is what we call this value. Again, carrying amount is more than tax based. So once again, this is the difference. This difference will be considered as taxable temporary difference. Taxable temporary difference means future obligations. So more taxes. So now I'm going to compute the deferred tax liability 10,60,000 into 3,18,000. Remember one thing, this is your deferred tax liability. Now the important point here is that which you need to learn. When I'm going to reflect in my financial statement, when I'm going to prepare my financial statement as at 31st of 2024, what will be the amount of deferred tax liability? First of all, you let me know actually what is the amount right now which is appearing. Right now, you are reflecting a deferred tax liability of 3,39,000. But because on 31st of 2024, your deferred tax liability is now only 3,18,000. So ultimately, you will have to reflect 3,18,000. Ultimately, you will have to reflect actually 3,18,000. Is it clear to you or not? So indirectly, it means your deferred tax liability is falling down a wee bit, and it is the difference. If you are going to take this difference will be equal to, I think, 21,000. This difference will be equal to 21,000. So now your deferred tax liability is getting decreased. This is the point which you need to understand. Is it clear to you? Obviously, you are going to credit it to your profit and loss account, this decrease, because now there is a reduction in deferred tax liability. Actually, with the passage of the time, what happens? The timing differences keep on getting reduced, and ultimately, that is the reason at some or other point of time, our deferred tax liability will reduce and it will be a gain. Whenever deferred tax liability would be created, we are going to charge it to profit and loss account. At the same time, if there will be a reduction in deferred tax liability, you are going to recognize it in your profit and loss account. So this should be the way to actually solve the question, and this should be the way to also understand the question. Now we move over to MQ1. Now MQ1, this is a module question. When I'm saying it is your MQ1, that means it is a module question. But before we start what we call attempting this particular question, just allow me a break of actually 5 minutes, and exactly after 5 minutes I will recommence the session. Is it clear to you or not? Right. And now I was talking about this MQ1. So two or three questions are given in your module. We are covering that also along with that. A company measured accounting profit of rupees 80,000 after charging depreciation of 12,000. Correct? A company measured accounting profit of 80,000 after charging what we call depreciation of rupees 12,000. Pay attention actually. And here now it is written, on interest receivable, income tax is levied on cash basis. As you know, actually there is no place for outstanding expenses and what we call accrued incomes under the concept of income tax. As you know this, are you getting my point or not? Because there are some items under income tax which are always treated on cash basis, but in accounts, we prepare the accounts on accrual basis. Are you getting my point? So under income tax, actually accrued expenses, that means whatever accrued interest income, there was some accrued interest income under the accounting concept. When I'm going to prepare my P&L, I'm going to record what we call even the accrued incomes, irrespective of the fact whether I have received or not. But under income tax, I'm not going to record this income because it is clearly written over here. And moreover, even if it is not written over here, you should be aware of this because you have done a chapter under your income tax by the name of income from business and profession, wherein you are already in the know that there are some items under income tax which are treated only on as per cash basis. Moreover, here it is written that under income tax, you are recording actually only on cash basis. So quite obviously that this income is not recorded under the what we call income tax concept. Now further here it is written, included in accounting profit is interest accrued. I have already told you, while you are going to prepare your what we call accounting statement, you are going to take into account interest accrued. Because you have considered now interest accrued, see here it is given your profit, accounting profit is 80,000. It is given after charging depreciation of 12,000, and now it is also given over here that which is not included in taxable profit is 67,000. Question is telling us that under the income tax actually we haven't written interest accrued, number one, and number two, our profit is actually 67,000, while profit as per account is given to you after charging depreciation of rupees 80,000. Is it clear to you? So this is the scenario of this particular question so far. And now here it is also given in this particular question, tax rate is 30%. Now you are being given for taxation purpose, depreciation admissible is 20,000. Whereas under accounts, we have already seen depreciation is 12,000. And under income tax, it is 20,000. Further, it is also written carrying amount of fixed asset was 68,000. Now carrying amount of fixed asset is also given to you. And tax base of fixed asset is 60,000 before charging depreciation. That means the carrying amount and the tax base of the fixed asset is given to you before charging depreciation. The carrying amount of the fixed asset is given under both the concept before what we call charging depreciation. So lots of questions are asked in this particular question. Question first is carrying amount and tax base of the fixed asset and of interest accrued. We have to find out carrying amount and tax base of interest accrued also besides the fixed assets, and the temporary differences for fixed asset and interest accrued, and current tax expenses and deferred tax expenses, and deferred tax liability and deferred tax assets, if any. So many questions are there, but anyway, in order to solve the question, ultimately we have to give answers to all these questions. So as usual, first of all, I will be writing here carrying amount, then I will be writing here tax base. Instead of carrying amount, you can write also book base. Then we will take into account taxable temporary differences, correct? And taxable temporary differences, and we may also take into account what we call deductible temporary differences. Current tax, deferred tax liability, and tax expenses. Now the important point is this: your fixed asset before depreciation given in the question is 68,000 and 60,000, and under the accounting concept depreciation is 12,000, whereas as per taxation concept the depreciation allowance is actually 20,000. So this balance 56,000, this balance is the carrying amount, and this 40,000 is the tax base. But now you have computed the carrying amount and the tax base. You will take the difference. The difference, should I treat it as taxable temporary difference or deductible temporary difference? First of all, I need to know I am dealing with the asset. Carrying amount of the asset 56,000 is more than the tax base of the asset. So obviously it is a taxable temporary difference. And if it is a taxable temporary difference, I will apply the tax rate, and I can easily find out that my tax liability will be equal to 4,800. Is it clear to you? This is one part of the question. Actually, two questions are clubbed together here. Another one is regarding interest accrued. And we have seen that interest accrued is recorded in accounts. So we may say the carrying amount of the interest accrued is 5,000. But what will be the tax base? I told you outstanding items and accrued items have no place under income tax, correct? So that is the reason tax base of this item will be equal to 0. Again, interest accrued, it is an asset for you. So that means here also you are dealing with an asset, and the carrying amount of the asset is more than the tax base. The difference is 5,000. This difference will be termed as taxable temporary difference. You are going to apply the tax rate. Once again, there will be deferred tax liability. So ultimately, your total deferred tax liability will be equal to 6,300. Your total deferred tax liability, we have given answers to all the questions so far which have been asked. And if you want to know the amount of current taxes, so you need to know first of all, the taxable income, which was given in the question as 67,000. So current taxes will be equal to 20,100. And once you have found out the current taxes, that is tax as per taxable income, which happens to be 20,100, then you will simply add deferred tax liability. You will simply add your deferred tax liability. Your deferred tax liability is 6,300, and ultimately your tax expenses will be equal to this much. Is it clear to you or not? Your tax expenses will be equal to this much, 26,400. So this is how you will have to deliver the answer in this particular question. Now coming over to your MQ2, in this particular question it is given a fixed asset is acquired at 1,50,000 with a life of 5 years and no residual value, and depreciation chargeable at SLM for accounting purpose. That means in accounts you are going to charge depreciation, correct, over a period of 5 years on a straight line basis. For taxation purpose, depreciation admissible is 50,000 for the first 3 years. That means entire 1,50,000 will be written off in the first 3 years under the what we call income tax. So show tax consequences of all the years. So first of all, I have written here 0, 1, 2, 3, 4, 5. Is it clear to you? And even 6th year I have written. Obviously, the cost of the fixed asset is 1,50,000. Cost of the fixed asset is 1,50,000. When in account I will reach the end of the first year, I will charge a depreciation of 25,000. Why? Because it was given in the question that in account the life is estimated. Actually here I have written 5 years. It is actually 6 years. I am extremely sorry. Actually it is 6 years. Kindly write 6 years. Correct? So that is why 1,50,000 divided by 6, I think. Let me check it up. Is it 30,000? Because sometimes, misprints take place, so problem arises, right? 6 years is the correct answer. So 25,000 will be your depreciation at the end of first year as per accounts. And obviously, when I will write here 1,25,000, when I am going to write here 25,000, the carrying amount will become 1,25,000. Actually, this 0 is written here. Correct? It is 1,25,000. This entire amount is 1,25,000. Again, in the second year, I am going to charge depreciation of 25. Ultimately, this will be the carrying amount. Again, 25,000. Now the carrying amount will be 75, and so on. So this is how, under the accounting concept, the carrying amount will get reflected over a period of 6 years. Similarly, now we come over to the depreciation as per taxation purpose, because it is written in the question that we are supposed to charge depreciation only in the first 3 years. So I will charge a depreciation of 50,000 in the first year. So as per income tax, the carrying amount will become 1 lakh. Is it clear to you? Again, I am going to charge depreciation at the end of second year. Carrying amount will be 50,000. And when I am going to charge depreciation at the end of the third year, the carrying amount by the end of the third year itself will become 0. And obviously, there will be no depreciation in 4, 5, and 6 years. Is it clear to you? So no carrying amount also. So ultimately, now I will have to take into account the differences. In order to take the differences, I will have to compare the taxable amount and, the carrying amount and the tax base. If we are going to compare, as you can see here, carrying amount is 1,25,000, tax base is 1 lakh, so the difference is 25,000. Because it is a case of asset, and we have seen that in this particular case, the carrying amount is more. So that is why it will give rise to this difference. 25,000 is there. I'm going to apply taxation rate. I will get 7,500. Taxation rate is 30% given to you in the question. So when you are going to apply 30% to 25,000, it will give rise to deferred tax liability. And similarly, you will compare, once again, you will get what we call, in all the cases, because carrying amount is more than the tax base, in all the cases, there will be a case of deferred tax liability. But point which you need to remember, in the first year, you are going to charge the 7,500 to the profit and loss account, because your deferred tax liability is 7,500. When you reach the what we call end of second year, your deferred tax liability moved to a 15,000. That means it is moving up by 7,500. So in the second year, we will charge to profit and loss account only 7,500. And by the end of the third year, our liability moved from 15,000 to 22,500. That is why in the third year, I am going to actually again charge to profit and loss account 7,500. But here you must have noticed, now your deferred tax liability has reduced. That means at the end of the fourth year, when you are going to prepare your financial statement, your tax liability will get reduced. That is why here I have written negative item. That means I will credit it to profit and loss account. Are you getting my point or not? So this is the point. And again, your liability is falling down. So in the next 3 years, you have seen your liability is falling down, and you are going to credit the same to your profit or loss account. This is how you are going to do this particular question. And there is yet another question in your module. 3 questions are there. All the 3 questions have been wrapped up, besides what we call MTQ question. And one MTP question was asked in the examination, and we have already covered that also. A company creates a provision for gratuity and leave encashment and recognizes liability of 50,000. Remember one thing, there is an entity. Suppose you are in the accounts department of this particular entity, and when you are going to prepare your statement of P&L, correct? Now you tell me, if you are going to create provision, if you are going to create any provision, in this case provision for gratuity and leave encashment to the extent of 50,000, you are going to record it while preparing the statement of P&L. No doubt about that. In accounts, you are going to record it. Now you let me know. If suppose you are preparing a statement of P&L as per taxation department, as per taxation laws, are you going to reflect the provision? Are you going to reflect the provision? Answer is no. As you know, provisions are disallowed under what we call income tax. Is it clear to you or not? So that is the reason you need to understand it. That means when you are doing AS12, Ind AS 12 actually, you need to have a bit of a good idea, not only bit, rather a very good idea of your income from business and profession chapter, which you have done in your earlier phases of education. So further, it is also written, this is the only difference between the taxable profit and accounting profit. So this is the only difference. And why it is a case of difference? Because provisions are recorded in accounts and it is not recorded under income tax. The company measures the current tax at rupees 48,000. It is already given to you what exactly is the tax as per the what we call taxation authority. As per taxation authorities, the tax given to you is actually 48,000. That means the current tax is 48,000 is already given to you. Correct? So either I am going to add if there is a case of deferred tax liability, or I am going to subtract if it is a case of deferred tax asset. Let's have a look over here. So in this case, carrying amount, first of all, you need to understand that provision is an item of liability side. So this time you are dealing with a liability. So carrying amount of liability for gratuity and leave encashment is 50,000 because you have recorded it in your accounts. So that is why we may say that there is a carrying amount. That means provision must be appearing towards the liability side. But under income tax, since we haven't provided any provision, so quite obviously the tax base is actually 0. Is it clear to you? Now it is a case of temporary, the difference is there 50,000. Now first of all, you need to understand that in this case, no doubt it is a case of liability. It is a case of liability. And the carrying amount 50,000 is more than, tax base. Tax base is 0. Carrying amount is more. Now you have to recapitulate the things. I told you to learn only the rules of the assets and derive the rules through those rules with respect to liability. For example, in case of assets, you know that if carrying amount is more than taxation base, I told you it gives rise to taxable temporary differences. Now here it is a case of liability. And here also the carrying amount is more than tax base. But that doesn't mean that this time it will be a taxable temporary difference. It will be a case of deductible temporary difference. This is how you are going to what we call derive the rules. It is a case of deductible temporary difference. Is it clear to you? I told you if it is a case of deductible temporary difference, that means it is a case of future benefits. In future, you will have the what we call luxury of subtracting this item. In the sense, because whenever in future you are going to pay in actual terms, at that time income tax authority will debit that particular expense and your tax liability as per income tax will get reduced. So that is why actually it is a future benefit for you. So ultimately it will give rise to what we call deferred tax asset. And that is the reason actually why I have written here 50,000 into 25%. This time rate given is 25%. So 12,500 will be your deferred tax asset. Current taxes are given in the question as 48,000. I told you this is your current tax. If it is a case of deferred tax liability, I will add it to the current tax. But if it is a case of deferred tax asset, then I'm going to subtract it to know the amount of tax expense, 35,500. So this is your what we call Ind AS 12. Hope so. On such count, we start today. As you can see flashing on your screens, Ind AS 16 that relates to property, plant and equipment. And it's a pretty formidable standard, pretty strong standard, and especially the questions which are contained in your module are absolutely very high profile questions. And we'll see to it that we are going to do each question of your module also, because that was the demand which was forwarded to me through various what we call messages. So we have taken that note of, and definitely we are going to take into account all the module questions. Besides, as usual, we are going to do this particular standard the way we normally do all the standard. That means we are going to start right from the scratches, and we'll see to it that we are able to make it conceptually absolutely clear each and every aspect of this particular standard. Coming over to the what we call straightway business end, we start here now as far as what we call objective of this particular standard, or the principal issues as we call it, which are contained in this particular standard. One is recognition of assets. What does it mean? It means if an entity actually spends some amount, then whether this particular expenditure should be classified as an expense or should be classified as an asset. So this is what we mean by recognition of assets. Is it clear to you? This is the principal issue. And second one is that once you have decided that this expenditure is an asset, then later on the question will unfold at what value you need to carry it in your of what we call financial statement, that when determination of the carrying amount is the second issue which we are going to pick up under this particular standard. And finally, determination of depreciation charges. Of course, there is fourth issue, determination of impairment losses, but the fact is that this standard simply states that impairment losses shall be determined in accordance with Ind AS 36. So technically, actually, first three are the principal issue which we are going to actually study under this particular standard, and the fourth one that will be studied under Ind AS 36. Coming over to the scope of this particular standard, this standard will apply to every property, plant and equipment. Except this particular standard will not apply to any such property, plant and equipment which is held by an entity for the purpose of sale, because that is basically covered by Ind AS 105. And as you know by now very well, actually this particular standard also does not apply to biological assets, correct? And of course, this particular standard will not apply to exploration and evaluation assets, that is covered by Ind AS 106. And besides that, this particular standard will also not apply to mineral rights, reserves like oil, natural gas, and any other such non-regenerative resources. Now, obviously, when we are going to study this particular standard, we need to acquaint ourselves what exactly we mean by actually property, plant and equipment. And property, plant and equipment simply refers to all such tangible items which are held by an enterprise for use in production or for supply or for rental purpose. This is point number one. All such tangible assets which are held by an enterprise either for the purpose of production or for the purpose of supply of goods and services or for rental purpose or for administrative purpose. Now, this word administrative purpose will include administrative purpose. I have written over here separately actually. Administrative purpose, it means if you are holding upon any tangible item and that is meant for what we call selling and distribution. For example, vans, correct? You are having some vans and that vans you are using for the purpose of selling and distribution work. Similarly, finance and accounting like computers, etc. And similarly, personal and other functions. So administrative purpose is a little bit wider term and it includes all such things. So point number one is that actually any tangible item will be considered as property, plant and equipment if it is held by an enterprise for the purpose of production or for the purpose of supply or for the purpose of rental. Is it clear to you? And besides that, any administrative purpose. This is the point number one. And point number two is very important. That is, it is expected to be used for a period exceeding 12 months. Quite obviously. So this is what we mean by property, plant and equipment. Coming over to another important aspect, just a moment ago when we were discussing the scope of this particular standard, over there we discussed that this particular standard doesn't apply to biological assets. First of all, I want to clarify exactly what we mean by biological assets. When we say biological asset, it includes both biological animals and it also includes biological plant. Is it clear to you? Obviously, this particular standard, Ind AS 16, will not apply to what we call biological asset. That means it will not apply to biological animals. That is what we studied under scope, because under scope I simply said that this particular standard, Ind AS 16, doesn't apply to actually biological assets. But biological asset comprises of biological animals, so it will not apply because that will be covered by Ind AS 41. And it also doesn't apply to what we call biological plant. However, here you need to be a little bit more careful. We will see actually the plant can be segregated into two parts. One, other plants. Obviously, this particular standard will not apply to other plants. This standard will not apply to biological animals. It will also not apply to other plants, but it will apply to bearer plants. Bearer plants. What we mean by bearer plants, first of all, you need to understand that. As I have written over here, bearer plant basically is one which can be used in production or for supply of goods of agricultural produce, correct? Number one. And it is expected to bear produce for a period exceeding 12 months. That means you are in a position to use this particular plant for a prolonged period of time. So perhaps that is the reason actually why this standard says that bearer plant should be considered as part of Ind AS 16, because Ind AS 16 basically relates to assets, and as you know, assets can be used for a prolonged period of time, especially when we are talking about property, plant and equipment. They can be used for a prolonged period of time. They can be constantly used, and they can be used again and again, what we call in the purpose of production, or for the purpose of supply of goods and services, or for the purpose of rental. So similar purpose is served by the bearer plant, and perhaps that is the reason actually why this particular standard includes bearer plant as part of what we call property, plant and equipment. That means Ind AS 16 will apply to bearer plant. This is the point which you need to understand. So a bearer plant is one actually which is used in the production or supply of agricultural produce, and it will help you to produce agricultural produce for a period exceeding 12 months. And there is another characteristic, that is, it has a very remote chance of being sold as agricultural produce. For example, if suppose today you are having a bearer plant and it is going to give you returns for a prolonged period of time. So chances are very slim that today you are going to cut the entire plant and sell it off. So chances are very slim, chances are very remote. You are not going to sell it as agricultural produce. Is it clear to you? So these are the three important paramount characteristics of what we call bearer plants. So point is that biological assets comprises of biological animals. Ind AS 16 will not apply to biological animals. And under biological plant, we have other plants and what we call bearer plants. This particular standard will not apply to other plants, but it will apply to bearer plants. And why? I just told you the reason. The next point in this particular standard is the recognition criteria. So how a property, plant and equipment will be recognized by a particular entity. The point number one is that when entity is sure that some future economic benefits from this particular what we call asset will flow to the enterprise. This should be the first criteria. And second one is that the cost of this particular asset can be reliably measured. If both these criteria are met, then we are going to recognize this particular what we call asset as property, plant and equipment. Now the next point is measurement of property, plant and equipment. As you know, when we say measurement, that means we are talking about what we call measurement on the initial date and subsequent date. Initial date means the date of transaction, subsequent means on the reporting date, that is balance sheet date. On the initial date, like a normal asset, every property, plant and equipment will be recognized at cost, and subsequently it can be recognized at cost or on revaluation model. Actually, this choice is offered by this particular Ind AS. Now coming over to the initial recognition, as I just told you, initially we are going to recognize any property, plant and equipment at cost. And when we say cost, the cost of property, plant and equipment will include purchase price. No doubt about that. When we say purchase price, here I have included, it will include all the import duties. It will also include any non-refundable taxes. And if there are any trade discount or rebates, we are going to subtract the same. And similarly, we are going to include any directly attributable cost. Any directly attributable cost means any such cost which is associated in bringing the asset to the present location and to the present condition. Besides that, there is another important point. We need to include the decommissioning or restoration cost. Decommissioning or restoration cost. What does it mean? For example, today a particular entity acquires a plant and machinery, and let us say the cost of this particular plant and machinery is near about 50 lakhs. Correct? Now this entity estimates that we have installed this plant today, and almost after 5 years we will have to decommission it. Correct? We will have to decommission it, in the sense means we have to move away this particular plant from our present location. Perhaps after 5 years of period of time, this plant will lose its what we call utility to us. So this is what is the estimation of the entity, and that is why entity has decided to remove this plant after 5 years. So today we purchased this particular plant at 50 lakh rupees, and entity is estimating that after 5 years we are going to remove this particular plant. Is it clear to you? And when we say we have to remove this plant indirectly, it means we have to decommission it. Commission means we are installing it, and decommission is just opposite of it. So after 5 years, we will have to remove it. And entity estimates that the cost of removal will come to near about, let us say, 10 lakhs rupees. So entity is estimating today, in the beginning of the first year, entity is estimating today that after 5 years, we may have to incur an expenditure of 10 lakh. This 10 lakh will be known as decommissioning cost. Correct? Decommissioning cost. And what we mean by restoration cost, when we are going to install this particular plant, obviously, when we will do the installation, we will have to do lots of construction. And ultimately, when we are going to remove what we call this particular plant, we will have to deconstruct the same. So in order to bring the situation to the original level, that is known as restoration cost. Is it clear to you? So all in all, entity estimates that the total amount of expenditure which it will have to incur at the end of the what we call fifth year, correct? And fifth is the final year of as far as utility of this particular plant and machinery is concerned. So this entity is estimating that we may have to actually incur 10 lakh worth of expenditure, and entity is estimating it today. Now standard says that whatever cost which the entity estimates which it will have to incur, correct, after the end of the life of the plant or the utility of the plant, that cost must also be made as a part of the cost of the plant. That means on the initial date, when you are going to recognize the plant and machinery at cost, you will have to include this cost as part of the cost of the plant and machinery. But in order to include 10 lakh, you will have to compute the present value. This is what this particular standard says. So point here is that any estimation, any what we call decommissioning cost or restoration cost will also be considered as part of the cost of the plant and machinery. This is the point which you need to take care of. Now here are some questions from your module, and most of the students were having a little bit of query that, so kindly do all these questions. Okay, this is MQ1, and MQ1 means module question 1. Entity 9X Limited, I have changed the name, I have a habit of changing the name. 9X Limited sets up a plant at a purchase price of 5 lakh, correct? So this entity sets up a plant at a purchase price of 5 lakh plus GST at 18%, and in the bracket it is written intra-state. And you know better than I the concept of GST, and further it is written freight paid 20,000 plus GST 18% interstate. So when we purchased the plant, we paid a GST of 18% interstate, and besides that, when we incurred freight, then also we paid GST at the rate of 18%. Again, it is an interstate, and further it is written paid 10,000 as employee expenses for installation of the machinery. And further it is written after the plant was put to use, maintenance cost incurred rupees 5,000. After the plant has been used, now we incurred a maintenance cost of 5,000. Remember one thing, later on we will say any routine expenses on maintenance etc. are never ever made part of the cost of the plant. These expenses, these will be treated as normal business expense, and these will be debited to, these are not capitalized, and these will be debited to profit and loss account. Question says that measure the initial cost to be recognized in past journal entry, and further the question estimated dismantling cost is 30,000, and the present value is also given to you. Now in this particular case, you are supposed to actually find out the initial cost of the plant and machinery, and I need not require to tell you what should be the cost of the machinery. First of all, as I told you initially, when we are going to recognize this particular asset, we are going to recognize it at cost, and in order to determine the cost, we'll take into account the purchase price, number 1, then freight, number 2. At the same time, any installation cost which we have incurred, 10,000. I just told you maintenance cost will not be capitalized because it is a general routine expenses, correct? So these expenses will be expensed, they will be simply debited to profit and loss account. And further, any estimated dismantling cost, if you have incurred any dismantling cost, that too, the present value of that cost need to be figured out, which is given in the question as 12,000, and it will also be made as part of the cost of the property, plant and equipment. So initially property, plant and equipment will be measured at 5,42,000. Is it clear to you? Another important point in this particular case, Suppose you must have actually seen in this particular question, there is GST also. Now the GST treatment is made clear. Actually, earlier it was not clear, and in most of the books we have seen actually even GST has been made as part of the what we call property, plant and equipment, but that should not be the case now. The point here is that any GST will always be any GST which the entity has paid in connection with purchase of plant, machinery or equipment. That will be treated separately. It will not be made as a part of what we call as a part of, as I told you just a moment ago, as a part of cost. That means you are going to ignore GST if it is given in the question. Is it clear to you or not? For example, if this question I'm going to face in the examination, first of all, I'm simply going to compute the cost. And just to make the point a little bit more clear, I will simply explain this particular point. Now, you must have seen actually in this case, we are paying GST to the state government and to the central government. You know better than I actually. In the question, it was written that on purchase price of 5 lakh, we have paid a GST or at the rate of 18%. If I'm going to compute 18% of 5 lakh, that will come to near about, I think, 90,000. Isn't it or not? If I'm wrong, that's fine, no problem. But try to understand the conceptuality. So 5 lakh is the purchase price. I'm paying a GST. And I have already told you, I'm not going to consider GST as the part of the cost of the property, plant and equipment. But just to make the point a little bit more clear, GST accounting will be done separately. So as you know, total is 90,000 and half of that amount will move to the state treasury, and while the half of the amount will move to what we call central treasury. So we will compute what we call 18% of 5 lakh, that comes to 90,000, and one half of 90,000 comes to 45,000. So 45,000 will move to state government, correct? And similarly, what we call rest of the 45,000 will move to the central government. Similarly, we paid actually in this particular case GST on freight also. If you remember, the amount of freight was actually 20,000. If I'm going to compute 18% of 20,000, that I think will be equal to 3,600, and one half of it will go to the state government, so 1,800, and 1,800 will move into the pocket of the central government. So 46,800, this will be your entry. Now, suppose if you want to actually pass the entry, you can show it in the examination that first of all, you write a note that number one, GST will not be made a part of the cost of the what we call property, plant and equipment. It will be treated separately, and the treatment will be as follows. Your entry will be input, as you know better than I actually. So, but still, input CGST. Now, total CGST, if you are going to find out, this is equal to 46,800. So 46,800 I will write here, and then I am going to write input SGST. SGST means state GST, that is also 46,800 as we compute it, and we will pass a separate entry for the same. That means it will not be made a part of what we call cost of property, plant and equipment. This is the point which you need to keep in your mind. So this is how you are going to do this particular question. It is not a tough one. You can easily manage this one, isn't it or not? Now coming over to module question 2. Now as far as module question 2 is concerned in this particular case, and this question also is struck in the examination also, almost similar question, but I think the figures were halved or doubled. I do not know exactly, but same question was there. Entity 10 Limited has incurred the following transaction in respect of acquiring a plant. Correct. So this particular entity 10 Limited is there. It has incurred the following transaction in respect of acquiring a plant, and this plant has been acquired through exchange of an old plant. This is the point which you need to understand. That means in this particular question, the entity is acquiring a new plant. For simplicity's sake, I will call it NM, that means the new machine, and we are exchanging our old machine. That means this entity is departing with what we call old machine and acquiring a new machine. Further in the question, it is given that the old site was dismantled at a cost of 8,000. Since we were already having an old machine, so when we are acquiring a new machine, so what we did actually, we dismantled the old machine. And further it is written, no estimated dismantling cost was capitalized for the old plant. Correct. So at the time of what we call, when we might have actually purchased the old plant, at that time this cost of dismantling was not capitalized. The question says that. But anyway, the point here is that this information is irrelevant, to be very honest with you. Now in this particular question, first of all, I will show this, although I have solved this particular question, but still I would like you to actually understand it in a comprehensive manner. So when you are going to actually dismantle your old machine, so your entry will be old machine account debit to cash account. That means in connection with old machine, you are incurring some expenditure because you are dismantling the old machine. So that is why the entry will be old machine account debit to cash account. This is the entry which you are going to write. Is it clear to you or not? Correct. Further, the question says that scrap from the old site was sold at rupees 1,000. So when we are dismantling, obviously there might be some scrap material and we sold it out and we got actually 1,000 against the same. So the entry for the same will be cash account debit to old machine account, because we are selling off the scrap which we have through what we call dismantling of the old machine. So entry will be cash account debit to old machine account. So how in this particular case, you must have seen actually we have received 1,000 rupees through sale of scrap. This is the entry you are going to pass. So far, no problem. Further, it is given in the question that new site was constructed at a cost of 48,000. Now the question is that why you are actually constructing a new site? Why you are constructing a new site? Because you are acquiring a new machine. You want to store the same, so you are constructing a what we call new site. That means this particular amount you are spending actually in connection with the new machine, and that is the reason actually your entry in this particular case will be new machine account debit. New machine account debit. You are going to pass this particular entry, new machine account debit 48,000, correct? And to cash account. So you have spent 48,000. This expenditure is in connection with what we call in connection with new machine, because you are constructing a new site. Further in the question, it is given the supplier of the new machine agreed to take away the old machine at a fair value of 1,26,000. Now, you might have purchased the new machine. So far, it is not given to us actually at what value we have acquired. Till up to point number C, this information is not given to us that at what value we are acquiring a new machine from the supplier, but whatever it might be. It is given initially in the question itself that we are acquiring the new machine through exchange of old machine. Now the supplier has taken over your old machine at a fair value of 1,26,000. So your entry will be like this in this particular case. Obviously, you are giving your old machinery to the supplier. So your entry will be supplier account debit. Since supplier is taking over this particular machine at a valuation of 1,28,000, he is taking over at a valuation of 1,26,000, sorry. But the point is that you need to know what is the value at this particular moment of your old machine. So you will have to find out the value of your old machine. So what is the value of your old machine? In order to know the book value of old machine, what you will have to do, what was the cost of your old machine? Now it is given in the question. The carrying amount, actually it is given in point number D. Now further it is also given in point number D that new plant price was 3,20,000. This is also given. And this is also given that carrying amount of the old plant is actually 1 lakh. So point is that we are giving actually our old machine to the supplier, and supplier is taking it over at a valuation of 1,26,000. First of all, I need to know actually what was the value of the old machine on the date on which actually supplier is taking it over at a valuation of 1,26,000. So we can determine the cost. We can determine the cost of the old machine. Cost, I should not write actually cost. In fact, I should write the book value of the machine or the carrying amount of the machine. So carrying amount of the machine will be, just give me a second, carrying amount of old machine. Carrying amount of old machine. So I can find out the carrying amount of old machine. Carrying amount of old machine. How can we determine the carrying amount of old machine? In order to determine the carrying amount of old machine, it is given in the question now that your cost of the old machine was 1 lakh. Correct? Your cost of the old machine is 1 lakh. Now you have passed these entries and just pick up actually where old machine is figuring in the entry. Now in point number 1, we have seen old machine account debit to cash account. So it will increase the cost of the old machine because this expenditure which you incurred in connection with dismantling of the old machine, obviously it will be debited to old machine. So the cost of the old machine will move up. Isn't it or not? And then you wrote this entry cash account debit to old machine. So it will reduce the cost of the old machine. Isn't it or not? So you must have noticed the day on which actually we are giving our what we call old machine to the supplier, we may say that cost is actually cost or the carrying amount of this particular machinery is 1,07,000. So now we can say easily in this particular question that this supplier was given old machinery having a cost of 1,07,000, but he took it at 1,26,000. So quite obviously it's a gain to you, isn't it or not? So that is the reason actually why I'm going to write this particular entry. Entry will be supplier account debit to old machine account. Now old machine having a carrying amount of 1,07,000 will move out of the business, number one. And second, you are going to have a gain, and this gain obviously will be credited to profit and loss account, statement of profit and loss account, that is 19,000. And in the very next line, it is also written that new plant price is 3,20,000. Actually, the new plant price is 3,20,000, but you have to be cautious here in the sense you are acquiring this plant from supplier. So don't write this particular entry immediately, new machine account debit to cash account, correct? So you are going to write the entry NM, new machine account, that is 3,20,000. We are acquiring a new machine for 3,20,000, and I'm going to write here to supplier account. Is it clear to you or not? To supplier account, that is equal to 3,20,000. Now you must have noticed You have given a credit to the supplier of 3,20,000 because you acquired a what we call property, plant and equipment worth rupees 3,20,000. That means your entity is supposed to actually give 3,20,000 to the supplier. Indirectly, your entity owes 3,20,000 to the supplier. But at the same time, the supplier has to give you, the supplier from whom actually you are acquiring this particular machinery, he is debited over here. That means he is supposed to pay you 126. Now supplier is supposed to pay you 126 and you are supposed to pay him 3,20,000. So now the net amount will be settled. So now in order to pass the net entry, you will have to write the supplier account debit. The difference will be paid off to supplier account debit to cash account. So 3,20,000, as I told you, you are supposed to actually pay to the supplier, but at the same time, supplier is also supposed to pay you 1,26,000. Now the difference of 1,94,000 will be paid off to supplier. This is how you are going to write the entry. Supplier account debit 1,94,000 to cash 1,94,000. Is it clear to you or not? Is it clear to you? Right, sir. Absolutely clear. Now further in this particular question, we are being also given some more information. The more information is present value estimate of dismantling the site is 16,000. Now present value is also given to you in this particular question. So because the present value is also given to you in this particular question, logically your entry will be new machine account debit, because all these expenses are related to the new machine. So new machine account debit to, actually we write here to provision for dismantling, to provision for restoration you can write, or decommissioning you can write. To provision for restoration and 16,000. Further, wages paid for installation of the plant is 4,000 and trial run is 1,600. Even these expenses are in connection with the new machine. So entry will be new machine account debit to cash account. So we will write here to cash. That is wages 4,000, trial run 1,600. That comes to 5,600. I am going to write here 5,600. Then question says that freight paid 8,000 rupees. So again, I am going to write here to cash. In bracket, I can write freight and the amount is equal to 8,000. Amount is equal to 8,000. Now in this question, point number H states that GST applies on supply of plant. We are going to ignore this particular information completely and comprehensively. Even in this particular question, it is given that GST has been paid on purchase price and on freight at the rate of 18%. You can show that treatment separately as I showed you in the last question. Now further in this particular question, it is written loss was paid loss of 40,000 for low capacity utilization of the plant after installation. Remember one thing, unless and until you have started production commercially, because initially on trial run you may have to actually incur some expenditure. So initially you may incur some loss. That loss will be debited to profit and loss account. It will never be capitalized. Is it clear to you? So it will not be made as part of the cost of the plant. Further, it is also given 10,000 was paid as cost of launching the product to be produced from the plant. So sometime entity incurs very heavy expenditure in launching the product. Such expenditure will never ever be capitalized. It will be debited to profit and loss account. So these last 3 points will not impact the what we call cost of the new machine. So when you are going to write this, your amount will be 16,000 plus 5. That is, I think, equal to how much? 29,600. So new machine account debit to provision for restoration, to cash, that is wages and trial run expenses, and to cash 8,000. You can also show the cost separately as this question has shown. So see here, first of all, you write the cost of new plant is 3,20,000. You can also find out the cost of the plant. Here we can say what is the cost of the new plant, because new plant first of all coming over here, then again you have written here. So 48,000 you are going to add, and then you are going to add all these expenses. So this will become your cost of what we call new plant, which I have shown here separately. So ultimately your total cost will be equal to 3,97,600. Is it clear to you or not? So it is not Tough question. And as far as GST treatment is concerned, see, entries portion I have already shown you, because your institute has written combined entries, so sometimes it becomes difficult for you to understand the same. Now GST treatment will be similar to the last one as I told you, so no problem in that particular case. Now coming over to what we call, but you simply write in note that GST will be treated separately. In fact, in the examination, even if you are not going to show the separate treatment of GST, that is not going to impact the solution. Correct? Coming over to next question, and this question is a pretty tough one, no doubt about it. Now we pick up MQ3, and this is pretty important and formidable question. Entity Level Limited purchased an aircraft at a price of 6,300 crores that requires major inspection and overhauling every 4 years. Correct? So this particular entity purchased an aircraft at a cost of 6,300, and further it is stated in the question that every 4 years entity will have to incur some expenditure on its overhauling and inspection. Further, it is given to you that estimated life of the aircraft is 15 years. And the aircraft was purchased in 2019, in fact. So in 2019, exact date is not given to you. It is given that you acquired this particular aircraft in 2019. In 2019, we acquired this particular aircraft, and now it is given major inspection and overhauling made in 2024 at a cost of 100 crore. And further, it is given in this particular question that in 2024, you spent some amount on its overhauling. Overhauling expenses are always capitalized. So in 2024, remember one thing, in 2019 actually you purchased the aircraft. That means your first year will end in 2020, and further your second year will end in 2021, and your third year will end in 2022, and your fourth year will end in 2023. Your fourth year will end. And obviously that means after the end of the fourth year you spend in 2024, it is given that you spent 100 crore on the overhauling. And further here it is also given in 2025 this entity spent further amount on repairs and maintenance in the engine to raise the capacity by 10%, amounting to 70 crores. In 2025, it is also stated that this particular entity spent some expenditure on repairs and maintenance. Some expenditure on repairs and maintenance was spent, and the amount of expenditure actually given to you is 70 crores. Honestly speaking, repairs and maintenance expenses are always treated as revenue expenditure and generally debited to profit and loss account. Whatever expenses are incurred on repairs and maintenance, even when we did MQ1, over there also I told you that repairs and maintenance expenses are generally charged by the entity to the profit and loss account. However, it may so happen that an entity might have incurred some expenditure on repairs and maintenance, but sometimes such expenditure enhances the production capacity, enhances or increases the production capacity. So whenever any expenditure is incurred by an entity on the asset, and that particular expenditure results in enhancement of the production capacity, so irrespective of the nature of the expenditure, such expenditure is generally capitalized. So that is the reason, even though repairs and maintenance expenses generally, as I told you, are always treated as revenue expenditure and charged to profit and loss account. But in this particular case, it is stated in the question that entity spent on repairs and maintenance in improving the engine capacity, and the engine capacity increased by 10%. So that is the reason you are going to capitalize even repairs and maintenance expenditure which you incurred in 2025. Correct? Further, it is also given that in 2025, one worn out component in the wing was replaced in 2025 at a cost of 80 crores. Replacement basically means, and in 2025, besides repairs and maintenance, it is also stated in the question that a replacement cost is being incurred by the entity. When we say replacement cost, indirectly it means cost of new component. That means we are replacing the old component. Indirectly, instead of old component, now we are putting up a new component. That is what we mean by replacement cost. So replacement cost or cost of new component is actually 80 crores, which is given in the question. Remember one thing, replacement cost is always capitalized. Replacement cost is always capitalized because you are replacing an old component with the new component. Quite obviously, it will result in enhanced capacity, enhanced production capacity. So that is why replacement cost is always capitalized. So that means whatever cost you have incurred in replacing the new component, in replacing the old component with a new component, it will be capitalized. But because you are replacing the old component, that means now the old component will have to be de-recognized. And because you are going to de-recognize the old, unless you are going to actually de-recognize the old component, you cannot replace it. So replacement is possible only when we are going to de-recognize the old, what we call component. So indirectly, it automatically leads us to the conclusion that old component is de-recognized. And here it is written, carrying amount of the old component is 30 crores and scrap value realized, what we call 20 crores. Because now old component is being replaced by a new component, so we will have to pluck out the old component. Indirectly, we will have to de-recognize it. When we are going to de-recognize the old component, it will decrease the cost of the asset, number one. And when we are going to de-recognize it, because it is of no use, now we are going to dispose it off, and it is stated in the question, scrap realized, is its scrap value realized actually 12 crores. So that means there is a loss on the disposal of the old component to the extent of 18 crores. Is it clear to you? Now in this particular question, what exactly is the demand? Question is asking us to recognize expense and the carrying amount of the asset at the end of 2023, 2024 and 2025. So we have to reflect what exactly is the amount of expense and what exactly is the amount of carrying amount at the end of 2023, 24 and so on. So first of all, we take into account year 2023. I just want to know in 2023, how much expenses entity incurred, number one, and what is the carrying amount of the asset. In order to compute the same, first of all, I need to write the cost of the aircraft. Now, cost of the aircraft which is given in the question is 6,300. Obviously, I will have to now charge depreciation on it. Now, what is the amount of depreciation? 6,300 is the cost, and residual value is given almost at the end of the question. The aircraft's residual value is estimated at 300 crores. So I'm going to subtract 300 crores. Now, I'm going to divide it by the life. Life is equal to 15 years. It is stated estimated life of the aircraft is 15 years. But it was stated that you acquired this particular plant in 2019 and now you are computing the carrying amount at the end of 2023. So first of all, you need to understand that you acquired the plant, you acquired the aircraft in the year 2019. That means your first year will end in 2020, second year will end at 2021, third year will end at 2022, and in 2023, we are doing the computation. That means at the end of 2023. So that means 4 years time period has already gone by. So that means in order to know the carrying amount of the asset at the end of 2023, I will have to charge depreciation of 4 years. Now 6,300 minus 300 divided by 15, this is depreciation for 1 year. So 1 year depreciation is 400, but I want to compute the depreciation for 4 years because since the purchase 4 years time period has elapsed, so I will have to compute a depreciation of 4 years, which comes to 4,600. So we may say that at the end of 2023, the carrying amount of the asset is 4,700. Is it clear to you or not? This is the carrying amount. And what will be my answer? The answer is total expenses incurred by entity. Total expenses incurred by entity in the form of depreciation in 2023 is equal to 400. In 2023, amount of depreciation is 400 because these are the total expenses of what we call 20, 21, 22 and 23. But for the year 2023, depreciation expense will be 400, but depreciation of last 4 years will be equal to 1,600, and this will be considered your carrying amount. This is how you have to actually reflect the answers. Is it clear to you? Now we move over to what we call year 2024. We have already computed the carrying amount at the end of 2023, so we may say that on 1/1/2024, the carrying amount is 4,700. Now in 2024, as I told you, it was given in the question that this particular entity incurred 100 crores worth of expenditure on overhauling. And I also told you overhauling expenses are always capitalized. So you will not treat them as an expense, you will capitalize them. So I will write here overhauling expenditure. So overhauling expenditure will increase the cost, correct? 100 crores worth of expenditure you have incurred. So when you are going to increase the cost, carrying amount will increase to 4,800. Now I will charge depreciation for the year ended 2024. We have already seen that depreciation on aircraft is 400 per year. We just computed. So in 2024, again, I will have to charge a depreciation of 400. But point is that in the year 2024, I have capitalized this amount. When I'm capitalizing something, it means I'm treating it as an asset. If I'm treating it as an asset, I will have to charge the depreciation also. So the question is, how much on overhauling expenditure I need to charge depreciation? What will be the amount of depreciation on overhauling? Because it is stated in the question that overhauling expenditure need to be incurred by the entity almost after every 4 years. So you can safely assume that life of this overhauling expenditure is 4 years. So I'm going to divide it by 4. So depreciation per year will be equal to 25, and that is why 425 will become your total depreciation for the year 2024, and carrying amount will be equal to 4375. So your answer for 2024, I need not require to tell you, total expenses in the form of depreciation will be equal to 425, and carrying amount, as I just told you, will be equal to 4375. So this is how you need to actually write the answers. Is it clear to you or not? And now finally we need to find out all these things for the year 2025. So year 2025, now we have already reached the end of 2024. So first of all, on 1/1/2025, I will write carrying amount of this asset 4375. It was given in the question that in the year 2025, this entity is spent actually 70 crores on repairs and maintenance. So first of all, I am going to write here repairs and maintenance. And repairs and maintenance expenses, it was given in the question, amounted to actually 70 crores, isn't it or not? So, and I told you, generally the repairs and maintenance expenses incurred by an entity are always charged to profit or loss account. But in this case, repairs and maintenance expenses will be capitalized simply because of the fact that it was given in the question that these expenses are resulting in the increased production capacity, and that is the reason why we are capitalizing it. Further, it was also stated that in 2025, actually I have written it over here initially, in the year 2025, entity spent 70 crores on repairs and maintenance. Further, it was given that entity incurred 80 crores in replacing the what we call old component with a new component. So cost of new component will always be capitalized. Cost of new component. So new component, NC, new component 80 crore, I will capitalize it. I told you a moment, when I am replacing old component with a new component, that means I am plucking out the old component. Indirectly, it means I will have to de-recognize it. So that is why I will write here old component, OC, de-recognized. De-recognized. Old component will have to be de-recognized. And the cost of the old component is 30. Are you getting my point or not? Cost of the old component is 30. So, in the year 2025, you have already seen lots of activity has taken place. So, if I am going to add 70 plus 80 and I will have to subtract 30. So far, the carrying amount is equal to 4,495. This is your carrying amount so far till up to this particular stage. Now, I will have to provide the depreciation. When I am going to provide the depreciation, remember one thing. As I told you, on aircraft, original aircraft, your depreciation per year you have already computed, that is equal to 400. Now, because in the current year, and besides that, you will have to write here overhauling expenditure, depreciation on overhauling amount, because you incurred some amount in 2024 on overhauling, correct? And you capitalize this, so that is why you charge the depreciation on it in the year 2024. So in the year 2025 also you are going to charge the depreciation, and the depreciation amount will be 25, correct? Same amount. For the next 4 year, depreciation on overhauling will be 25 only. And in the current year, we have capitalized repairs and maintenance, and replacement, cost of new component. I will write here new component, NC. Now total expenditure on repairs and cost of new component is 150. So I will have to depreciate it also because we capitalized it. Indirectly, when we are capitalizing something, we will have to provide depreciation on it. But problem is that what will be the amount of depreciation? Now 70 plus 80, their cost is actually 150. You need to understand here that you have already reached the year 2025. See, in 2019, actually, you purchased this particular aircraft. Since then, now you are here, 2025. In between, 5 years time period has gone by. 5 years of time period has gone by. And original life was 15 years. That means out of 15 years, correct, 5 years have already elapsed. So that means 10-year period is remaining. Are you getting my point or not? 10 years are remaining. 10-year period is remaining. Is it clear to you? So point here is that when you are going to charge depreciation on repairs and new component, their total capitalized amount is 150. You will have to divide it by the remaining life, and the remaining life now will be considered as 10. That is the point which you need to understand. So the depreciation will be equal to 15. Depreciation will be equal to 15. Are you getting my point or not? Right, sir. So total depreciation till up to this stage is coming to 440. But very important point. In the current year, you de-recognize this particular item. If you are de-recognizing this particular item, need to understand, you are de-recognizing this particular item and it will decrease the cost. Because we have already computed earlier, this component was part of the aircraft. And in the current year, when I am writing 400 as depreciation, that means I am giving depreciation on the entire aircraft, including this component. But fact is that now this particular old component is no more cost of the asset. So separately, I need to find out the depreciation on this old component. What will be the depreciation on this old component? 30 is the cost. Now the remaining life is 10. So the depreciation on the old component will 3. Because I have charged a depreciation of 400, actually I will now have to subtract 3 as depreciation, because out of total depreciation of 440, I need not require to give a depreciation of 3 crores because this 400 includes depreciation on this also. But this component is no more a part of the aircraft. So that is the reason your total I will write here old component. So that means now your total depreciation in the current year will be equal to 437. And this is the trickiest point. Only such questions can be done by us. So that is the reason. So you need to actually pay attention. Correct? It is not easy to comprehend the entire gamut of this particular question. So I have tried my level best to make it as easy as possible. Correct? So 437 will be the total amount of expenditure in 2025. And now you are in a position to find out the what we call carrying amount. Your carrying amount will be equal to 4058. Your carrying amount will be equal to 4058. Is it clear to you or not? Right, sir. So very interesting question. And this is the only standard in your module actually where some questions have been given. Otherwise, in most of the standard illustrative case studies, or as far as case studies are concerned, that is absolutely almost like a desert. Correct? Anyway, and now we move over to the next question. And next question is not a tough one. MQ4. In this particular question, you are being given that Entity 12 Limited purchased a machine at a price of 1,200 lakhs. Ultimately, you have to find the total cost of the machine, so 1,200, and it paid a freight of 40 and installation cost of 80 lakh. I need not require to tell you that you are going to include the freight, and you are also going to include the what we call installation cost. And further, it is given in the question, IGST you have paid 18%, but so many times now I have already told you that IGST, GST you will have to exclude it because separate treatment will be done. And share of general overheads, ascertained for the trial run for the machine is 30 lakhs. So I have already told you general overheads are also ignored. So that is why general overheads will not be considered. And further, it is given that labor cost and direct expenses for trial run is equal to 60. You are going to actually consider this particular cost, so you are going to include it as a part of the cost. Also given in the question that machine has been put to use on 1/4/2026. Okay. Estimated dismantling cost of the machine at the end of its useful life is 400 lakhs. Now, it is given that at the end of the 10th year, this machine will have to be dismantled, and the total amount would be on this dismantling would amount to actually 400 lakhs, and discounting rate is applied at 5%, and it is also given to you estimated present value is 246 lakhs. So estimated present value, you are going to include present value of estimated dismantling cost. I told you it will be included as a cost of the asset. And further, it is given that machine requires major overhauling every 2 years at a cost of 26 lakh. So, in this particular question, it is also given that almost after every 2 years, this machine will require overhauling expenses of 26. Correct? Almost after every 2 years. After every 2 years, you need to understand this. So initial cost, so your initial cost till up to this particular stage is actually 1626. Your initial cost is 1626. Is it clear to you? So actually your answer will be only till up to this particular point. Your answer will be only till up to this particular point. Is it clear to you? Your total cost till up to this particular point is 1626 because we need to find out the cost of the asset. So, but just to make the point a little bit more clear, in this particular question, you need to understand that 1626 is the cost of the asset. And further, it is given in the question that every 2 years, this entity will have to incur on overhauling cost. Correct? So, if I am going to subtract 26, that means the real cost of the machinery is actually 1600. And 26 is overhauling cost, because it is written in the question that every 2 years we will have to incur 26 on overhauling cost. So that means company will have to depreciate 1600 over 10 years, and because overhauling cost need to be incurred every 2 years, so it will be depreciated over a 2-year period of time. So that means depreciation on the machine cost will be equal to 160 per year, while the depreciation for 2 years, each year depreciation on overhauling cost will be equal to 13. That means in the first year, company will charge a depreciation of 160. But in the second year, because at the end of the second year, company will have to incur overhauling expenditure. In the second year, my depreciation will be equal to 1613. That's the point. Actually, you need to reflect the answer only till up to this particular stage. This is just for your understanding. Now, next question is another question, and it is also a very strong question. It is not an easy question. In this question, it is stated that Alpha Limited has a machinery at a cost of 4,800 lakhs. So there is a company and it is having a machinery at a cost of 4,800 and a provision for depreciation of 1,600 as on 1/4/2027. So, as on 1/4/2027, this is the scenario as far as this particular question is concerned. Further, in this particular question, it is given that on that date, the remaining life of the machine is 6 years with a residual value of 800. So, this information is also given to you that the remaining life of the machine on this particular date happens to be 6 years and the residual value happens to be what we call 800. On the same date, one component of the machine is replaced. And the price of the new component is 600 and the cost of the old component was 500 with accumulated depreciation of 200. As you know, so many times I've already told you, when you charge depreciation on a particular asset, correct? When you charge depreciation on a particular asset, your entry will be, generally we pass the entry depreciation account debit to asset account, and ultimately this depreciation which you have charged is generally debited to profit and loss account. Generally this is the entry we pass, and when we pass this entry indirectly, it means we are charging the depreciation directly to the machinery, and machinery is being reflected at net of depreciation in the balance sheet. However, Whenever in the question it is given that there is accumulated balance or there is provision for depreciation, indirectly it means this entity is not directly charging the depreciation to the asset. Indirectly it means the asset is being reflected in the financials at cost, and depreciation expenses are accumulated in this manner. Instead of charging the depreciation to the asset, we are simply writing this entry, provision for depreciation. That means we are accumulating the depreciation in a provision for depreciation account. This is the entry we are passing. So point here you need to understand is that this time in the question it is stated to you that this machinery is appearing at a cost of 4,800 and total provision for depreciation is 1,600. It means till up to this particular date, on total cost of 4,800, total depreciation accumulated is 1,600. That means this particular machinery is maintaining the asset at cost, and maintaining the asset at cost indirectly means we are actually preparing provision for depreciation account or accumulated depreciation account separately. And this is the scene on that particular date, the remaining life is 6 years, 800 is the residual value, it is also given. On the same date, one component is replaced with a new component and the cost of the old component was 500 with accumulated depreciation of 200. As you know, when I'm going to replace the old component with the new component, now I will have to actually, as I keep on saying, pluck out. Indirectly it means de-recognize the old component. So the carrying amount of the old component, how will you compute? The carrying amount of the old component, it is given that cost of the old component is 500 and total accumulated depreciation on the old component is 200. That means the carrying amount of the old component is 500 minus 200, that is equal to 300. And now it is also given that supplier of the new component took the old component at a fair value of 360. So that means the old component which you are de-recognizing, it is having a carrying amount of 360 and it is being taken over by a supplier. So, and supplier took it for 360. So that means there is a gain on the disposal of what we call old component. Now on 31st of 3/2028, machinery is revalued as per the policy of the company. So this machinery was revalued on this particular date at rupees 5,000. And further it is given on 31st of 3/2029 an impairment loss of 900 has been recognized for the machine. And it is also given that pass entries and show the accounting treatment to be made in the financial statement for the year ending so and so. Is a clarity for the year ending 28, 29, 2030, your module question, but I have simply changed the dates as I keep on doing that. So this is a scenario in this particular question. Now, just to make the point, although I have solved it, but still just to make the point a little bit more clear, just pay attention. Now, first of all, what is given in this particular question, this is MQ5. In this particular question, it is given that on 1/4/2027, it was given to you that cost of the asset. The cost of the asset is actually 4,800, it is given to you. Further, it was given to you that accumulated depreciation or provision for depreciation, PFD I have written here, 1,600. And for simplicity's sake, I am simply writing CA, it means carrying amount. So cost 4,800 minus 1,600, we can also find out the carrying amount 3,200. So this asset is being reflected at a cost of what we call 4,800 on 1/4/2027. This is the scenario, correct? On this particular date, cost is 4,800, total accumulated depreciation happens to be 1,600, and obviously now the carrying amount is 3,200. Further, it is given in this particular question that on that date, this entity incurred some expenditure on replacement, and the expenditure on replacement was 600. So instead of writing replacement cost, I am writing new component. Obviously, when I am spending on replacement, that means I am replacing the old component with a new component. So new component cost, it is given to us in the question is 800. So 600. So I will write here 600. As you know, new component, that is replacement cost, will always be capitalized. So I'm going to add it to the carrying amount, isn't it or not? At the same time, it is also given in the question that old component. Now the old component first of all, you need to find out the carrying amount of the old component. Now, what is the carrying amount of the old component? The total cost of the old component was 500. Are you getting my point? And total accumulated depreciation is 200. Now this old component is being de-recognized. That means the original cost of the asset will decrease and total accumulated depreciation, which you are keeping a separate account for, that accumulated depreciation will also be decreased, because now this component is no more a part of your what we call asset. Are you getting my point or not? So anyway, this will tell you that the total carrying amount of this particular component is actually 300. So this 300 is the carrying amount of this particular old component. Further in the question, it was also given that this old component was taken over by a supplier. First of all, let me write here, because I just want to make the things a little bit more clear. I will write here machine account debit to supplier account. Why I am writing machine account debit to supplier account? Because we have acquired a new component. You can write in bracket new component. This new component will be capitalized, correct? And we purchase this new component for 600. We are presuming that we are purchasing it from the supplier, correct? We are purchasing it from the supplier. Now it is also given that supplier from whom actually we have acquired new component for 600, this supplier has taken our old component at a valuation of 360. So I will write here supplier account debit. In bracket I will write here old component, and 360 is the amount which is given to us. So this supplier took our old component at a value of 360, but we just saw that the old component, actually I will write here machine, and in bracket I will write here old component. The carrying amount of the old component is actually 300, correct? And now there is a gain also. This gain will be taken to profit and loss account, that is equal to 60. This will be the entry. And ultimately, indirectly, it means we are supposed to pay to the supplier 600 rupees, but at the same time we are supposed to receive actually 360 from the supplier. So the net amount now we will pay him off. So entry for the same will be equal to supplier account debit. Difference between 600 and 360 will be equal to 240. So you are going to write supplier account debit to cash account. This is the entry which you are going to pass here, 240, 240. Is it clear to you or not? This is how you are going to pass the entry. Now, important point is that if I am going to ask you at the end of what we call this particular year 1/4/2027, what is the scenario? Now, what is the carrying amount? 3,200 minus 600, 3,800 minus 300, that comes to 3,500. I will have to charge a depreciation also this year. When I am going to charge the depreciation, what will be the amount of depreciation? How you are going to provide the depreciation? See, your carrying amount is 3,500. 3,500, and it was stated in the question very clearly that the residual value on this particular date was written somewhere 800. Remaining life is 600 and residual value is 800. So 3,500 minus residual value 800 divided by remaining life. Remaining life question says that 6 years. So my depreciation for the current year will amount to actually 450. My depreciation will be 450. So we may safely presume that carrying amount at the end of this particular year is 3050. 3050. Is it clear to you or not? Also, because this depreciation which you have actually, this depreciation which you have charged in the current year, what will be your entry? Actually, 2 more entries in the current year you need to reflect in the examination in case entry is asked. Correct? Your next entry will be provision for depreciation account debit. Sir, you are debiting provision for depreciation. Yes, I am debiting provision for depreciation. Why? I will tell you. Provision for depreciation account debit to machine account. Why I am debiting this provision? Actually, this provision for depreciation is related to old component. See here, because old component is now being de-recognized and it is no more part of our assets fraternity. So I will have to decrease the total accumulated provision on this particular component. I will have to decrease the provision for depreciation account. Is it clear to you? Because this particular component is no more what we call asset of our company. So when we are disposing of this old component, so indirectly whatever accumulated depreciation which got accumulated on this particular machinery or component, I will have to decrease it. So that is the reason. Is it clear to you or not? So I will have to pass this particular entry, provision for depreciation account. Second point is that in the current year, actually, we provided a depreciation to the extent of 450. So I will have to pass the entry, and I must pass. Entry will be depreciation account debit. Depreciation account debit, that is equal to 450 to provision for depreciation account. This is the entry which I need to pass in the current year. Just for your better understanding, that means in the current year, how much I am going to debit to statement of profit or loss account. Obviously, the depreciation. In the current year, we have charged a depreciation of 450. And further, you must not also forget that in the current year, there is a profit also. Because there is a profit also, so your entry will be, the profit was 60 actually. So your profit or loss account will get credited by profit on sale to P&L. Your P&L account will also get credited by 60. If you really want to reflect the whole panorama of the entries, this will be the scenario. So in the current year, this is the scene. Now we move over to the next year. In the next year, what is happening? It is stated that on 31st of 3/2028, as per the policy of the company, this particular asset was revalued and it was revalued at 5,000. So now we come over to 31st of 3/2028. So on 31st of 3/2028, what is happening? 31st of 3/2028. Correct? So first of all, because we have already computed the carrying amount at the end of 31st of 3/2027, so that means on 1/4/2027, the carrying amount is 3040. Carrying amount is 3050, sorry. 3050, no? Right, 3050. This is the carrying amount, correct? Now in the current year, what is happening? First of all, it is given to us that this asset was revalued and it was revalued at rupees, what we call 5,000 at the end of 31st of 3/2028. So at the end of 31st of 3/2028, this asset was revalued at 5,000. So because this asset was revalued at this value, correct, on 31st of 3/2028, it was revalued at this value, that means a revaluation reserve got created and it got created to the extent of 1,950. So this will be the amount. Is it clear to you? I need not require to tell you what will be the entry for what we call creation of revaluation reserve account. As you know, the entry which you are going to pass will be, because when you are going to create the revaluation reserve, the value of the asset will increase and your entry will be asset account debit or machine account debit, whatever it is, to revaluation reserve account, and this entry you are going to pass with 1950. So at the end of 31st 3/2028, this 5,000 will be considered as your revised carrying amount. Because of revaluation, now the carrying value has been revised and it is now 5,000. So at the end of the current year, when you are supposed to charge the depreciation, what amount of depreciation you are going to charge? So depreciation, when you are going to charge depreciation, because your revised carrying amount is 5,000, and don't forget to subtract the residual value. There is no change in residual value. Residual value is 800. And now the remaining life, because earlier the remaining life in the last year was 6 years and 1 year has gone by since then. So your remaining life will be equal to 5 years. So now the depreciation in the current year will be equal to 840. And the entry for this depreciation will be equal to, as I told you, depreciation account debit to provision for depreciation account. Provision for depreciation account. This will be the entry which you are going to pass for 840. Is it clear to you? So after charging the depreciation, now we can say that at the end of 31st of 3/2028, your value, your carrying amount is equal to 4160. Is it clear to you? Your carrying amount is equal to 4160. Now it is also given in the question that on 31st of 3/2028-29, there is an impairment loss of 900 also. There is an impairment loss of as on 31st of 3/2029. So because we have already reached at the end of 31st of 3/2028, so this is the carrying amount. So we can also say that this is also the carrying amount as on 1/4/2028, 31st 3/2028 or 1/4/2028, one and same date. Now we will move over to 31st of 3/2029. Now, as it is stated in the question, there is an impairment loss. Question is stated that there is an impairment loss. So first of all, you are going to take into account impairment loss. So impairment loss is 900. And whenever there is an impairment loss, what will happen? Your entry will be impairment loss account debit. Your entry will be impairment loss account debit to machine account or asset account, whatever it is. So this will be the entry for impairment loss, 900. After subtracting the impairment loss, now we will get a value equal to 3,260. 3,260. Now, because now we have given effect to impairment loss, again this 3,260 will be considered as revised carrying amount. It will be considered as revised carrying amount. Revised carrying amount. And whenever the carrying amount will get revised, you will have to provide revised depreciation. So that is the reason you will provide depreciation in the current year, that is at the end of 31st of 3/2029, your depreciation amount will be 3,260 minus residual value 800. Now the remaining life is 4 years, correct? So your depreciation will be equal to 615, if I'm not wrong. So we may say that at the end of 31st of 3/2029, finally your value is coming to 2645. At the end of 31st of 3/2029, or what we call 1/4/2029, this is the carrying value. And I have already shown you. And for this depreciation, your entry, I need not require to tell you, your entry will be depreciation account debit to provision for depreciation account. Provision for depreciation account. So this is how you need to do this particular question. Is it clear to you or not? So, most important part of this particular standard is already done, correct? And you can surely expect a question out of this, and we will now do the next topic, correct? And it is related to property, plant and equipment exchange, as property, plant and equipment acquired in exchange. So property, plant, equipment acquired in exchange, as you know, an entity actually can acquire property, plant and equipment by way of exchange also. So under such a situation, you need to take care of this particular fact that in case of exchange transaction, if commercial substance exists, if there is a commercial substance, we use a word commercial substance. If there is a commercial substance, what is the meaning of commercial substance? I am going to explain it in a short while. Then it will be recorded. Then the property, plant and equipment which you are acquiring by way of exchange, and instead of word exchange, we also use the word trade in, isn't it or not? So whenever property, plant and equipment an entity would acquire through trade-in or through exchange, in that case, if there is commercial substance, then we are going to actually record the new asset at the fair value. We are going to record the asset acquired at fair value if there is a commercial substance. At the same time, if there is no commercial substance, then the new asset which you are acquiring will be recorded at carrying value of the asset given up. New asset will be the new asset which is flowing into the entity. The new asset will be recorded at carrying amount of asset given up. Is it clear to you? Asset given up. This is the point which you need to understand. So these are the two vital points in order to actually face the case studies. The first case study we take, and this is a case of there is no what we call commercial substance. There is an entity by the name of TMX, and it exchanges car X with a book value of 13 lakh, and it is having a fair value of 13 lakh 25,000. So right now, as far as this entity TMX is concerned, it is having a car, and the book value of the car, as you can see, the book value of the car is actually 13 lakhs. Book value of the car is 13 lakhs. But it is having a fair value of 13 lakh 25,000. It is having a fair value of 13 lakh 25,000. So this car is moving out, no doubt about that. This car is moving out, and against this car, and the name of this car is car X. And now this entity is exchanging this car with a new car, and the name of the new car is car Y. And it is given in the question that this entity will exchange this car. That means I am going to provide this car of 13 lakh 25,000, and I am going to receive 15,000 in cash, and at the same time I will receive a car which is having a fair value of 13 lakh 10,000. That means this entity is exchanging this car which is having a fair value of 13 lakh 25,000, but against the same, this entity is going to actually receive cash rupees 15 lakhs. Cash rupees 15 lakhs, and also a car Y having a fair value of 13 lakh 10,000. You must have noticed in this case, when we say commercial substance, what we mean by commercial substance. Commercial substance, see here, in order to check whether there is a commercial substance or not, what you are going to check? You are going to check the inflows and the outflows. What we mean by the inflow? The inflow is the amount of cash and the new car. Your entity is going to receive cash of 15 lakh. And car Y, which is having a fair value of 13 lakh 10. So your total inflow is equal to 13 lakh 25,000, isn't it or not? Your total inflow happens to be 13 lakh 25,000. But at the same time, your outflow is also equal to 13 lakh 25,000, because the car with which your entity is actually departing, you are departing with this car which is having a fair value of 13 lakh 25. So even outflow will be considered as 13 lakh 25, and inflow is 13 lakh 25. And if inflow and outflow are same, we say that there is no commercial substance. So in this particular case, there is no commercial substance. There is no commercial substance. And if there is no commercial substance, I told you that new asset which you are acquiring will be recorded at carrying amount of old asset. The new asset which we are acquiring will be recorded at carrying amount of asset given up. Asset given up. Now you need to understand, you are giving up car X, and the book value or the carrying amount, book value is nothing but the carrying amount. So the book value of the asset which you are giving up is actually 13 lakh. So that means the new asset which we are acquiring will be recorded at 13 lakh. And how we are going to record? See here, because we are giving up car X, so car X is moving out, because we will have to pass the entire entries now with this particular value. Is it clear to you or not? So car X is moving out, and in total we are receiving 13 lakhs, because we have to record the new assets at the book value of the asset given up. Book value of the asset given up is 13 lakh. So the new asset, there are two new assets. One is cash and one is what we call car Y. And both these new assets will be recorded at a value of 13 lakh. And out of 13 lakh, cash is obviously 15 lakh. Then rest of or the balance amount will be allocated to car Y. This is how you are going to pass the entry in this case. Is it clear to you or not? Similarly, now we are going to pick up case study 11.2, and in this particular case study, what is given to us? On March 31st, 2022, ZX Limited traded in means exchange an old machine having a carrying amount of 1,68,000. So in this case, there is an entity by the name of ZX Limited. And this ZX Limited is having an old machine, and the old machine is having a book value of 1,68,000. 1,68,000. Of course, this entity is all acquiring a new machine. Traded in mean we are exchanging our old machine with a new machine, but it is given in the question that and paid difference of 60,000 for the new machine having a total cash price of 2,05,000. Now it is stated in the question that we are acquiring a new machine, and it is also given that the fair value of the new machine is 2,05,000. Total cash price is nothing but fair value. Total cash price is actually 2,05,000. Logically, if I am acquiring a new machine for 2,05,000 and I am departing with my old machine of 1,68,000, so logically this difference is actually 37,000. I need to pay only 37,000 more, because the new asset which I am acquiring, it is having a fair value of 2,05,000, and I am giving up my asset, and that asset is having a book value of 1,68,000. Technically, I need to pay 37,000. But it is stated in the question that we are acquiring a new asset and we are not paying 37,000, rather we are making a payment of 60,000. It is written in the question the difference is paid. The difference is settled by 60,000. Now, if I am going to subtract 60,000 from 2,05,000, indirectly it means the difference 1,45,000. Indirectly it means my old machine was taken over at a valuation of 1,45,000. Are you getting my point or not? See, actually, we are acquiring in this particular case new machine to the tune of 2,05,000. I'm acquiring a new asset of 2,05,000. I'm giving an old machine, and besides that, I'm giving a difference of 60,000 in cash. So difference of 60,000 in cash indirectly means my old machine was considered only worth rupees 1,45,000. That means my old machine was taken over at 1,45,000. Are you getting my point or not? So in this particular question, you need to understand that you are acquiring a new machine of 2,05,000. I have already written over here. And also, entity is giving up the old machine 1,68,000 along with the cash of 60,000, and we are acquiring a new machine of 2,05,000. So indirectly it means our old machine is moving out only at a valuation of 1,45,000. Of course, the difference between 168 and 145 is a loss to us, because our old machinery 168 was considered at 1,45,000. So in this case, actually entity is receiving a new machine to the extent of 2,05,000. These are the inflows to us. But if I am going to compute the outflow, in order to compute the outflow, I will see that my old machine, which was having a book value of 1,68,000 and plus 60,000, my total outflow is equal to 28,000. So this time there is difference between the cash inflows and outflow. So because there is a difference between the inflow and the outflow, we may say that commercial substance is existing. If commercial substance would exist, I told you the new asset which you are acquiring will be recorded at the fair value. So the fair value of the new machine, the cash price is nothing but the fair value. So the cash price of the machine 2,05,000 is given to us. So that is also the fair value. So we are going to record the new machine at a fair value of 2,05,000, and we are giving up 60,000 worth of cash, and our old machinery was considered at 1,45,000 only, and that is why there is a loss. So that we can pass another entry, statement of profit and loss account debit to old machine account. So this is how we will do this particular question. Now the next part of this particular standard is measurement after initial recognition. After the initial recognition, actually under Ind AS 16, an entity has a choice. They can measure. See, initially the assets are measured at cost. But after the initial measurement, after the initial recognition, later on the reporting date, the entity has a choice. Entity can use cost model, or entity can even go for revaluation model. What we mean by revaluation model, in order to understand that, just pay attention over here. In this particular case, just to explain the point, I have written that suppose a firm acquires property, plant and equipment at a cost of 5 lakh on 1/4/2027. Correct? On 1/4/2027, entity acquires property, plant and equipment at a cost of 5 lakh. So I will write here 5 lakh. Presuming firm does first time revaluation on 31st/3/2029. So after 1/4/2027, our first year will end on 31st/3/2028, but entity did its first revaluation on 31st/3/2029, and on this particular date its value was estimated at 7 lakh. See, actually it is the policy of the company. That means revaluation policy, entity can have any policy. Entity may have a policy of revaluing the asset almost annually, or that is every year, but sometime entity think it is better to get the assets revalued almost after 2 years. So in this case, entity did the first revaluation on this particular date after acquiring this particular asset. And on this particular date, we found that the value has gone up to 7 lakh. So on this particular date, my entry will be property, plant and equipment account debit. That is equal to 2 lakhs, because from 5 lakh to 7 lakh, the value has gone up. And obviously I will write here to revaluation reserve account. You must understand that revaluation reserve account is always transferred to OCI, other comprehensive income. Anyway, so this is the entry. And now the asset will appear at 7 lakh on this particular date. In this particular case study, what I have shown you, suppose a firm acquires a property, plant and equipment worth rupees 5 lakh on 1/4/2025. Now this time you are acquiring property, plant and equipment on 1/4/2025. Again, the cost is actually 5 lakh, which is given to you. And again, similar to the last question, here also it is written that firm does the first time revaluation on 31st/3/2027. So on 31st/3/2027, we did the first time revaluation. And because there is an appreciation on this date, this entity is going to pass this particular entry, property, plant and equipment account debit 2 lakh to revaluation reserve account, that is equal to 2 lakh. This is the entry this entity is going to pass at the end of 31st/3/2027. But what is written now further, and values it at rupees 6 lakh. Sorry, on 31st/3/2027, it was valued at 6 lakh in this particular case. So your amount of revaluation reserve will be equal to 1 lakh. And then it is stated in the question further, and again on 31st/3/2029. So on 31st/3/2029, this entity again revalues the asset. But now it found that the fair value is only 4,90,000. So on this date, now the fair value is 4,90,000. As we have seen that on this particular date, now the carrying amount of this particular asset is 6 lakh. Now it has fallen to actually 1 lakh. It has fallen by 1,10,000. Now it is fallen by 1,10,000. Normally the fall in value is always charged to profit and loss account. Normally, whenever there is fall in value, we always charge it to profit and loss account, and we normally write the entry profit and loss account debit to relevant asset account. Asset account here, property, plant and equipment. Now value has fallen down by 1,10,000. Technically, I should charge 1,10,000 to the profit and loss account, but at the same time, as you know better than I also, If there is a balance in revaluation reserve, then the fall in value, first of all, will be adjusted against the revaluation reserve. So that is the reason out of 1,10,000 worth of loss, 1 lakh will be charged to revaluation reserve account and rest of the loss will be charged to profit and loss account. This is the point which you need to understand. Is it clear to you? Similarly, in 12.23, it is stated in the same way that a firm acquires property, plant and equipment at 5 lakh on 1/4/2025 and firm does the first time revaluation on 31st of 3/2027 and fair value on this particular date is 5 lakh. Initially, when I bought the asset, it was 5 lakh. But later on, after 2 years, when I did the revaluation, I found the fair value as 4,50,000. So this time value has fallen. So obviously this time value has fallen. So I'm going to charge the entire fall in value to the profit and loss account because this is my first revaluation and there is no balance in the revaluation reserve. So entire fall in value will be charged to profit and loss account. Is it clear to you? In 12.4, it is given, suppose a firm acquires property, plant and equipment on 1/4/2023. So on 1/4/2023, you acquire the property, plant and equipment and entity does the first time revaluation on 31st/3/2025 and determine the value at 450. This is your first revaluation. So on 31st of 3/2025, you are going to charge the fall in value to the profit and loss account because there is no balance available in revaluation reserve. Correct? And on 31st of 3/2027, subsequent revaluation done, and now we found that value has gone up from 4,50,000 to 5,25,000. There is an increment of 75,000. Generally, if there is an increase, as we just saw, whenever there is an increase, generally we take the increase to the revaluation reserve. So when there is an increase, obviously the asset account will be debited, but entire amount I'm not going to take to the revaluation reserve because standard also says that if there is appreciation in the value of the asset, you can use that appreciated amount in offsetting the depreciation which you provided earlier. Now earlier there was a fall in value 50,000. So this fall in value which we charge to profit and loss account, we can revert it. That means there is appreciation of 75,000. So I will not take entire 75,000 to the revaluation reserve. Rather, out of 75,000, I will credit 50,000 to the profit and loss account. That is to the extent I debited P&L earlier. I debited P&L earlier by 50,000, so I can revert it now. And if there is any balance, then only I am going to credit it to revaluation reserve account. Is it clear to you or not? Then there are some other points in this particular, what we call a standard. I have already told you regarding this cost of day-to-day servicing expenses, etc. So day-to-day or routine nature expenses are always charged to profit and loss account. I need not require to tell you. I have already talked about replacement cost. If there is any replacement cost, that will always be considered as what we call part of cost of the asset. It will be capitalized. If there are any major inspection or overhauls, we have already seen, it is also always capitalized. Is it clear to you? This is case study 13.3.31. It is, you can easily manage this particular case study. I need not require to tell anything. In this case study, I have talked about that replacement cost is always capitalized and the component which is being replaced will have to be de-recognized. Now we come over to cost of self-constructed asset. Cost of self-constructed asset. The standard says that the cost of self-constructed asset will always be reflected at actual cost and not at notional cost. What do we mean by that? In order to comprehend this particular point, let's have a look over this particular case study, 14.1. In this particular case study, I have given a company has made addition to its factory building by its own workmen at a cost of 5 lakh for wages and material. So what is happening actually? In this particular case, an entity is making some addition to its buildings, correct? So some additions to building is being made by the entity. Additions to building. Additions to building. Some additions to building is made by the entity. An entity is spent on what we call material. Although it is written material and wages, entity total amount spent is equal to 5 lakh. But important point is that entity used its own workmen. Entity used its own workmen to do these additions to the building and the total cost came to near about what we call 5 lakh. Now further it is given that lowest estimate from an outside contractor to carry out the same work was for rupees 6 lakh. Now instead of what we call using our own workmen or our own workforce, if we would have hired the workers from third party, in that case still we may have to pay actually 6 lakh. Actually what entity is trying to tell is that instead of what we call getting the work done through our own workmen, if we would have hired a third party, in that case our cost would have been actually 6 lakh. The directors contend that they are fully entitled to employ an outside contractor, and it is reasonable to debit the factory building account with 6 lakh. Indirectly, actually, the directors are claiming that they want to reflect the building at rupees 6 lakh. But important point, as I told you, buildings will be reflected at 5 lakh, correct? The 6 lakh is the what we call notional cost, and in accounts we do not have any place for what we call notional amount. So therefore the contention of the company to reflect the asset at 6 lakh is incorrect. The asset must be reflected at actual cost of 5 lakh. There is another case study similar to the earlier one, 14.2, you can manage it. And then there is what we call this part, depreciation part. Regarding depreciation, I need not require to tell you, each one of you know that depreciation depends upon useful life, residual value, cost of the asset. And what we mean by depreciable amount means cost minus what we call residual value. Standard says that depreciation amount should be allocated on useful life, on a systematic basis over the useful life. Residual value, useful life and depreciable amount of an asset should be reviewed annually at each reporting date. So everything you know about all these things, and if there are any changes in residual value, depreciable amount and useful life, then these are considered as changes in estimates and are always accounted for prospectively, not retrospectively, always prospectively. Depreciation is charged to statement of profit and loss account. We all know that depreciation is always charged to profit or loss account. However, depreciation can be included in the carrying amount of an asset. It can happen. How it can happen? For example, suppose you are constructing a very huge plant, and in order to construct this huge plant, let us say you have taken on lease some cranes. So in that case, whatever depreciation which your entity will have to provide on these cranes, that depreciation cost will be added to the cost of this what we call project. Are you getting my point or not? So if a particular asset is being used in the construction of a big plant or huge plant, in that case, depreciation on that particular asset will be charged or capitalized to the cost of that particular project. So it may happen, but generally the depreciation is charged to profit or loss account, no doubt about that. Depreciation begins when asset is available for use, no doubt about that. So these are the things. So in this particular case, there are some questions which you can manage it by yourself also, to be very honest with you, and that should not pose any difficulty. But still, it is given that a company acquired a machine on 1/4/2026 for 5 lakh. The company charged depreciation up to 2028-29 on SLM basis with working life of 10 years and a scrap value of 50,000. So far, till up to this particular point, the cost of the asset is 5 lakh, residual value is 5 lakh. Because it is given that the working life of the asset is 10 years, I am going to divide it by 10 years. So total depreciation per year will be equal to 45,000. Now, if I want to compute the written down value at the end of 28-29, because we have acquired the asset on 1/4/2026, we will reach the end of 27, we will reach the end of 28, then we will reach the end of 29. That means at the end of 31st of 3/2029, 3 years have gone by, so I will have to subtract from the cost 3 years depreciation, and 3 years depreciation will be equal to 45,000 into 3, 1,35,000. So we may say that at the end of 28-29, that is 31st of 3/2029, the written down value of this particular asset is 3,65,000. Now the question says that from 29/30, that means from this date onward, the company decided to change the depreciation method at 20% reducing balance method. As we saw earlier, that any change in useful life or depreciation method are considered as changes in estimate. and changes in estimates are implemented prospectively and not from retrospectively. So when we will reach the end of the next year, in the next year, the depreciation which we are going to charge, 3,65,000 is the written down value, and I will simply apply 20% to it. So 73,000 will be the amount of depreciation for the next year, that is 2930. Is it clear to you? So that should not pose any difficulty. Similarly, as far as case study 15.2 is concerned, you can manage it also. In this case, it is given a computer costing 60,000 is depreciated on a straight line method, and assuming that life is 10-year, working life is nil, and residual value is also nil. First of all, so far in this particular question, we are being given that there is a computer which is what we call costing 60,000. Depreciation is being charged on a straight line basis, assuming 10 years as working life, and nil residual value for 3 years. That means for 3 years we have already charged the depreciation. So 60,000 is the cost, correct? 60,000 is the cost, and your depreciation will be 60,000 divided by 10 into 3. Correct? That means your per year depreciation 60,000 divided by 10, that is equal to 6,000. You multiply it with 3. 6,000 into 3 will be 18,000. So 18,000 minus 60,000, that means your written down value at the end of the 4th year will be equal to 42,000. Now question is asking us that the estimate of the remaining useful life after the 3rd year was reassessed at 5 years. See, actually the original life of the asset is 10 years. And out of 10 years, 3 years have already elapsed. Technically, the remaining life should be 7 years. But now, at the end of the 3 years, we found actually remaining life is not 7 years, rather only 5 years. So there is change in what we call useful life. So I will have to revise the depreciation. And in order to find out the revised depreciation, what I am going to do, revised depreciation now will be carrying amount 42,000. There is no residual value. If there would have been residual value, I would have subtracted. There is no residual value. Now I am going to divide it 5 to get what we call 8,400 as the depreciation per year. Is it clear to you? Case study 15.3. Here in this case study, it is given V7 Limited purchased a machinery on 1/4/2018 for rupees 15 lakh. Further, it is given that company charged a straight line method of depreciation based on 15 years working life estimate, and residual value is 3 lakh. So in this particular case, so far the situation is that cost of the asset is actually 15 lakh and 15 years is the life, and residual value is equal to 3 lakh. Now it is given that at the beginning of the 4th year, the company, by way of systematic evaluation, revalued the machinery upward by 20% of the net book value as on that date, and also re-estimated the useful life as 7 years and scrap value as nil. Originally, the life of the asset was 15 years in this particular question. Originally, the life was 15 years. But after 3 years period of time, logically 12 years are remaining, because 3 years have already gone by. The company, it is written in the question that V7 Limited purchased the machinery on 1/4/2018. Company charged straight line method depreciation, and residual value is 3 lakh. At the beginning of the 4th year itself means actually 3 years have gone by. So that means technically the remaining life is actually 12 years. But now it is given in the question that after the end of the 3 year, remaining life is not 12 years, rather only 7 years. So there is change in what we call remaining life. And further it is given the scrap value, it will be nil. So it was estimated after the end of the 3rd year that revised life will be 7 years and residual value will be nil. So that means after the end of the 3rd year, you will have to compute the revised depreciation. Correct? So far, this is the situation. Cost of the asset, it is given to you 15 lakh on 1/4/2018. Now 15 lakh minus 3 lakh divided by 15, this is your per year depreciation. And till up to 21 for 3 years, depreciation will be 80,000 into 3, 2,40,000. So after subtracting 2,40,000, we may say that this is the carrying amount as on 31st of 3, 2021 or 1/4/2021. See, 31st of 3, 2021 is the end of the third year. So now we have entered into the beginning of the fourth year. This is the beginning of the fourth year. In the beginning of the fourth year, that is on 1/4/2021, the value is 12,60,000. Now, it is given in the question that in the beginning of the fourth year, at the beginning of the fourth year, the company, by way of systematic evaluation, revalued the machinery of Word by 20%. It is given and estimated the useful life as 7 years and scrap value as nil. So that means in this particular year, first of all, there is an up valuation. So up valuation of 12,60,000, 20%. So 12,60,000 into 20%. So up valuation is 2,52,000. This is revaluation reserve, correct? So now your revised book value in the beginning of 1/4/2021 will become 15,12,000 because revaluation was done in the beginning of the fourth year. So 15,12,000 is the revised value. Now we will have to compute the revised depreciation. In order to compute the revised depreciation, because this is the revised value. So I will take into account the revised value. There, it is also stated in the question that it was estimated that revised value will be considered as 0. So 15,12,000 revised carrying amount minus revised scrap value, which is 0, divided by remaining life, which is 7 years. So my depreciation comes to 2,16,000. My depreciation comes to 2,16,000. See, we are in the beginning of 1/4/2021. From the beginning of 1/4/2021, when I am going to charge depreciation for 21-22, I will charge a depreciation of 2,16,000, correct? Similarly, I will charge another depreciation in 22-23, then another. That means in the next 4 years, I am going to charge a depreciation of 2,16,000 into 4. Why I am computing depreciation for the next 4 years, I will tell you. So that means when I am going to charge depreciation for the next 4 years, so we may say that the book value of this particular asset will be on 31st of 3, 2025 or 1/4/2025, that is beginning of the 8th year. Now we have reached the beginning of the 8th year. That means we have reached the end of the 7th year. In total 7th year, remember one thing, don't get confused. At the end of the 3 years, still there are 7 years remaining, as it was estimated that at the end of the third year, remaining life will not be of 12 years, rather of 7 years. So after the end of the third year, we have already charged the depreciation for 4 years, as I told you. So that means 7 years have gone by. So we have reached the beginning of the 8th year. Is it clear to you or not? Because after 3 years, there are still 7 years remaining. Don't forget about that. So only 4 years, that means in total, 10 years are there. 3 plus what we call 7 is equal to 10. So including these 3 years, now we have reached the beginning of the 8th year. So in the beginning of the 8th year, actually, the value is equal to this much, 6,48,000. Is it clear to you or not? On 1/4/2021, the book value is 15,12,000. 15,12,000, correct? And I have charged depreciation at the rate of 2,16,000 for 21-22, for 22-23, 23-24, and 24-25. That is for next 4 years. And the total depreciation is 8,64,000. So this is your book value, and this is your book value at the end of the 7th year or in the beginning of the 8th year. Why I am telling so? Because this question has some more information. The increase in net book value was credited directly to revaluation reserve, and we always do that. Depreciation on a straight line method later on was charged to profit and loss account. Obviously, the depreciation is always charged to profit and loss account. But at the beginning of the 8th year, and that is the reason why I computed depreciation for the next 4 years, because I want to reach the beginning of the 8th year. At the beginning of the 8th year, company decided to dispose of the machinery and estimated the realizable value to be rupees 2 lakh. Now we know that 6,48,000 is the value in the beginning of the 8th year, and company has decided to dispose it off. and company has decided to dispose it off for rupees 2 lakh. So that means there is a loss of 4,48,000. And here, what is the demand of this particular question? The demand of this particular question is you are required to ascertain the amount to be charged to profit and loss account in the beginning of the 8th year with reference to this particular standard. Now, most of the student in a hurry, actually, they maybe tempt to write that this loss will be charged to profit and loss account, and that will be a wrong. That will be an incorrect answer. Why? Because out of 4,48,000 worth of loss, you will charge, there is a balance in revaluation reserve, and balance in revaluation reserve was 2,52,000, isn't it or not? So out of 4,48,000, first of all, revaluation reserve, you are going to offset 2,12,000 worth of loss to revaluation reserve, and balance of the loss will be charged to profit and loss account. This is incorrect, and this will be considered as the correct answer. And this is quite an important question, so you need to take care of this particular question. Is it clear to you or not? Interesting one. And then rest of these two questions are not tough to crack. You can easily manage case study 15.5 because this question is similar to this one, and even 15.6 you can manage these two questions of your own. Now another part is acquisition of property, plant and equipment at consolidated price. Acquisition of property, plant and equipment at consolidated price. Correct. Now we are going to take up this particular part, and in this particular part, what is there? It's an interesting part, some technical. So acquisition of property, plant and equipment at consolidated price. What does it mean? Sometime what happens, an entity acquires cluster of property, plant and equipment at a single price. Now the question arises, how the entity now going to allocate the consolidated amount which entity has paid to acquire several assets. So how under such circumstances the price is allocated? This is the point here. So in order to understand the same, let's have a look over here. K99 acquired 3 plants at a consolidated amount of rupees 100 lakhs. We acquired 3 plants, but we paid a lump sum money of 100 lakhs. Right now, we are unaware of what exactly is the price of one particular plant. So fair value of these plant is 60, 70 and 120 respectively. This is the fair value. Fair value is given in a segregated manner, determined by the competent valuer. Show the cost of each plant. So how we are going to show the cost of each plant, or in other words, how we are going to allocate what we call consolidated price of 100 among these 3 plants. P1, P2, P3. We will take into account the fair value. We will take into account the ratio of the fair value. And on the basis of this ratio, we will allocate this particular price. That means the consolidated price will be allocated on the basis of the fair value of the plant to find out what we call the cost of it, but each particular plant. So we may say that out of total cost of 100, 24 will be considered as cost of P1, and P2's cost will be estimated at 28, while P3 will be allocated a cost of 48. Correct? Next is de-recognition of property, plant and equipment. When property, plant and equipment need to be de-recognized, obviously when no longer it is expected to generate future economic benefits, or when it is disposed of, whichever happens earlier. Correct? And of course, if there will be any gain or loss, that gain or loss will be transferred to the what we call profit or loss account. Another point is subsequent price adjustment. What we mean by subsequent price adjustment? A company has purchased a plant and machinery in 2019 and 20 for 90 lakhs. A balance of 10 lakhs is still payable to the supplier for the same. So when we acquired this particular property, plant and equipment, we must have, or we might have acquired it on credit from the supplier, and the amount was 90 lakh, and it is written that 10 lakh is still payable for the same. So at that time, we might have acquired this particular plant from the supplier. This plant might have been acquired from the supplier, and we must have passed this particular entry, and that is why actually it is written in the question that we are supposed to pay to the supplier actually is still 10 lakh. That means to the supplier till up to this particular date, we must have paid 80 lakhs only. Is it clear to you? That is why 10 lakh is the remaining balance. Indirectly, it also means that this particular plant this entity must have recognized at a value of 90 initially. Further, it is written that supplier waived off the balance amount during the financial year 2023. Now, suddenly, this particular supplier, he got a feeling and simply told us that you need not require to pay us the balance amount, it's okay. That means we are waiving off the 10 lakh. Now, this 10 lakh is a gain to you. Technically, this gain should be transferred to profit or loss account, but the standard says that now, because the supplier has waived off, so you need to adjust the purchase price. That is why it is known as subsequent price adjustment. That means instead of transferring this balance to the what we call profit or loss account, we will adjust it from the price, and now we will consider the cost of the plant as 80 lakh. This is the point which you need to understand. Another small topic is deferred credit. What we mean by deferred credit, let's have a look over here. P13 Limited purchased a car on 1/4/2027 for 18 lakhs from his supplier, and who normally offers 3 months of credit facility. If suppose I would have bought this particular car from the supplier, he would have given me 3 months credit facility because he normally gives what we call 3 months credit facility. However, P13 Limited acquired it under an agreement whereby it would pay the amount of the car after a period of 2 years. But this time we are buying this particular car today, and we are buying it and we are supposed to make the payment after 2 years, and after 2 years we'll make a payment of 18 lakh. Further, it is written that presume borrowing rate as 10% and show the amount of the car. So how the cost of the car will be reflected under such circumstances? So generally we call it in language of accounts, cost of the car shall be equal to cash price equivalent. And what we mean by cash price equivalent basically means the present value. So I will take into account the present value. In order to find out the present value, I will take into account the discount factor 10 years and the period is 2 years. So at present value factor of 10%, 2 years present value factor is 0.826. So that means this particular car, when you are going to recognize, initially you are going to recognize at a value of 14,86,800. However, at the end of what we call second year, you will have to pay an absolute amount of 18 lakh. So the difference of these two amounts will be considered as interest, and this interest will be written off to profit or loss account in these 2 years. Is it clear to you or not? So this is the point which you need to understand. And here are some disclosure requirement of this particular what we call standard. And now we take some questions from MTP. Question number June 23, I have already covered this particular question. When you will look at MTP 3 or 2, this is a similar question to that one, so you can manage this question of your own, no problem in this particular question. But the question which struck in June 23 paper, it was extremely tough, very formidable, and I need not require to tell you I was the only faculty who gave the solution to this particular question, because institute only gave what we call net answers. So let's have a look over this particular question. In this particular question, it is given that Paramatma Tulsi Limited provides you the following information. The first information is that on 1/04/2015, your entity borrowed 5 lakh at the rate of 12% per annum to construct 10 machines and incurred 8 lakhs on material, 2 lakhs on labor, 50,000 towards freight and insurance, rupees 20,000 towards carriage inward, and 10,000 on site preparation and what we call installation. I need not require to tell you that you will have to add all these expenses. Your purchase price of the 10 machine is 8 lakh, total 8 lakh, and then you incurred some expenditure. Actually, it is given that you purchased 10 machine and incurred 8 lakh on material, and then labor 50,000, freight and 50,000 towards freight and insurance 20,000. You are going to add all these expenses in 10,000 also. So your entry, see here, I have prepared a machine account here, and on 1/1/2015 I have written here 2 material cost, 2 labor cost, 2 freight, and this to this. So I have added all these items. Is it clear to you? So this is the cost of the machine so far. And secondly, it is written that estimated total physical life of the machine is 10 years, but the company consider it is likely that it will sell the property after 4 years. It will sell the property after 4 years. Very important point here is that it is also written that company borrowed 5 lakh at the rate of 10% per annum to construct 10 machine. To construct 10 machine, we have taken a loan. And we have already gone through Ind AS 23. And Ind AS 23 says that any expenditure on acquisition or for that instance any production or construction of an asset need to be capitalized. Borrowing cost. Now what is borrowing cost? Borrowing cost will be interest. So you will have to compute the borrowing cost, and when you are going to compute the borrowing cost, 5 lakh into 12% will be 60,000 for the current year. So 60,000 interest for the whole year, you are going to capitalize it and you are going to make it as part of the cost of the asset. So at the end of the first year, your asset will get reflected at 11 lakh 40,000. Is it clear to you? So in the beginning of 1/4/2016, I will write here 11 lakh 40,000. And now, after this, it is written on 01/10/2016. 01/2016. That means your next year has already started on 1/4/2016. And of course, your next year will end on 31/3/2017. Sorry. Your first year has ended on 31/3/2016. Okay, the next year will start from this date and end on this particular date. And we have already seen that in the next year, actually, when I'm going to write here, I will write balance brought down. So in the beginning of 1/4/2016, I'm having a balance in the machinery account to the extent of 11 lakh 40,000. So I'm going to write here 11 lakh 40,000. 11 lakh 40,000. This is the amount I'm going to write over here, isn't it? Now it is written that on 1/10/2016, on 1/10/2016, now it is written machine became ready for trial run production after incurring expenses on trial run rupees 20,000. And it is also given sale proceeds of the goods produced during the trial run is equal to 5,000. If you remember, actually, when I started off this particular chapter, I told you if you are going to incur any trial run expenses, then trial run expenses will also form part of the cost of the asset, but at a net value. You incurred expenditure of 20,000 and 5,000 was the scrap, so only 15,000 actually you are going to incur. Another important point is that in the next year, the next year has started on 1/4/2016, and now on this particular date, this particular plant is now ready or completed because trial runs have already started. Now you have already started trial run. That means only till up to this particular phase in the current year, that means in this particular year, 16 and 17, you are going to capitalize interest, but only for first 6 months. So for the first 6 months, when you are going to compute the interest will be equal to 5 lakh into 12% into what we call 6/12. That means 30,000 worth of interest will be capitalized. And that is the reason actually I have written here on 1/10/2000. Actually, I should write here on 1/10/2016, because till up to this date, from 1/4/2016 to 1/10/2016, you are going to capitalize the expenditure. Correct? This was given in this particular point. Further, it is also given on 1/1/2017. And remember one thing, 1/1/2017, this date will also lie in this particular accounting year itself. So on 1/1/2017, it is written here, now it is written here that machine became ready for commercial production. Now the machine has become ready for the commercial production. Number one. Further, it is also written that estimated residual value is estimated at rupees 2 lakh. Number one. Number two, it is also written government grant received for these machines is equal to 2 lakh. So that is the reason actually why I have written on 1/1/2017, you have received a government grant of 2 lakh. Obviously, it is going to reduce the cost of the machinery. Number one. And now we see actually here that the carrying value will become equal to 9 lakh 80,000. Is it clear to you? So after 9 lakh 80,000, I will write here on 1/4/2017, 9 lakh 80,000. Now, here what is happening? Here it is written on 01/10/2017. Now actually our next year has started on 1/4/2017. Your third year has started and it will end on 31/3/2018. At the beginning of this particular year, you are having a carrying amount of 9 lakh 80,000. 9 lakh 80,000. So you will write here 9 lakh 80,000 in the beginning of 1/4/2017. Now it is written in the question that company does not begin using the machine until 1st of April 2017. So some of you might be wondering actually why I did not charge the depreciation here, even though it was written that machine was ready for use. But important point here is that it is clearly given in the question, company does not begin using the machine until 1st of April 2017. So after this, it is written, put the machines to commence the commercial production. So once the machine become ready for commercial production, we should from that particular point start depreciating the machine. Correct. So in this year, I am going to actually provide the depreciation, no doubt, but also it is written on 1/10/2017, company sold one machine for 93,500. That means on 1st of October 2017, one machine out of 10 machine is sold and sold for 93,500. Now in this accounting year, I will have to do the treatment of this disposal of one machine, and I will have to charge the depreciation also. Correct. So in order to do this, first of all, have a look over here. How to find out the, obviously now, first of all, I need to know the book value of the machine which I am disposing of. So in order to find out the book value of the machine sold, first of all, what I am going to do, I need to find out the depreciable amount or depreciable amount. What we mean by depreciable amount, that is cost of the machine less residual value. Now depreciable cost of 10 machine. Now we have already seen that cost of the machine is 11,40,000, which we did in the very first year. 11,40,000 is the total cost. Residual value is 2 lakh. That means total amount which we have to write off is actually 9,40,000. So depreciable cost per machine, actually 9,40,000 divided by 10 comes to 94,000. So this is the depreciable amount of one machine. Is it clear to you? So depreciation per machine will be equal to, because this is depreciable amount of 10 machines. This is depreciable amount of 10 machine, because this is the cost of actually, this is depreciable amount of 10 machine, isn't it or not? So depreciable cost per machine will become 94,000. So on one machine, how much depreciation you are going to actually write? See here, in order to find out the depreciation, because it is given in the question that this entity may sell the machinery for 4 years. So you will have to compute the depreciation for 4 years. This is the depreciable cost of one machine. And now you will consider not life as 10 years, rather you are going to consider the life as 4 years, and that is why your depreciation will become 23,500. Is it clear to you? Per year depreciation is 23,500. Now here, you must have noted that on 1/10/2017, this machinery was sold. That means from the start, if I am going to compute the months, I think it will be equal to 6 months. So for 6 months depreciation, I will have to compute on this particular machine. On one machine, depreciation is coming to 23,500. Is it clear to you or not? First of all, I found out the depreciable cost of all the machine. Depreciable cost of all the machine is equal to 9,40,000. Now I am taking into account cost of one machine. What is the cost, that is depreciable cost, which I need to depreciate? Cost of one depreciable machine is 94,000, and one machine need to be depreciated over a period of 4 years. Don't forget, don't write here 10. So your depreciation is coming to 23,500. If 23,500 on one machine, actually this is per year depreciation. I have to compute the depreciation for 6 months. It is coming to 11,750. So I may say that the machine which I sold off, the depreciation in the current year will be equal to 11,750. So on the date of sale, what is the cost of this machinery? 94,000 is the cost of one machine, which we have already computed, and depreciation for the 6 months, 11,750. So book value on the date of sale will be 82,250, and we sold it for 93,500, and there will be a profit of 11,250. So this is why I'm going to write in the machine account here. On 1/4/2017, the balance brought down is 9,80,000. And on 1/10/2017, I sold one machine for 93,500, and depreciation on this particular machine till up to 1/10/2017, 11,750. and at the same time we have a profit of 11,250. Now I have to provide the depreciation on the remaining machine. So whatever remaining machines are there, you can compute the depreciation on remaining machine, because you have already computed depreciation on one machine 23,500. So remaining 9 machine, the depreciation will be equal to this much. You can straight away compute this one, or you can use this methodology. I have already told you on remaining machines. Now cost of 10 machines is 94,000. I have already told you. So depreciable amount of remaining machine will become 9,46,000. So this is depreciable amount of remaining 9 machine, and remaining 9 machine need to be depreciated over a period of 4 years. So depreciation on remaining 9 machine is 2,11,500, or you can compute it simply this way around. Is that clear to you? So 2,11,500 will be the what we call depreciable amount, and balance carried down, actually it is coming to 6,74,500. I have intentionally written here 6,75,000 just to make it in the multiples of what we call thousands. Otherwise you can simply write 6,74,500, no problem. On 1/4/2018, balance brought down 6,75,000. Now our next year is starting on 1/4/2018, as we have seen. 1/4/2018 is the next year, and this year will end on 31/3/2019. Now in this year, what is happening? Nothing is happening, because it is given that on 31/3/2019, remaining useful life of the property is reassessed as 4 years, and the residual value is re-estimated at 2,20,000, and the property is revalued upward by 45,000. So on 31/3/2019, when I'm going to provide the depreciation, I will take into account this particular picture. So in order to take this particular picture, first of all, you need to understand it is given that the value has gone up, because in this particular question, it is given on 31/3/2019, machineries were overvalued by 45,000. So when there is an upvaluation, value of the machine will increase. So I am going to write towards the debit side, asset revaluation reserve 45,000. Is it clear to you? Now how much depreciation you are going to provide? See here, on 31/3/2019, book value of the remaining machine is 6,75,000. How you compute it? Because that was the balance carried down, 6,75,000. So I'm going to add 45, correct? And I'm going to subtract the revised residual value, which comes to 2,20,000. So the revised book value 6,75,000 plus 45 minus 2,20,000 comes to 5,00,000, and remaining life is 4 years only. So depreciation per year will be equal to 1,25,000. So in this year, I am going to charge a depreciation of 1,25,000. Is it clear to you? My balance carried down will be equal to 5,95,000. Now on 1/4/2019, balance brought down is 5,95,000. Actually in this year nothing is happening, so I'm going to charge a depreciation, is it clear to you, of 1,19,000. So balance carried down is coming to 4,76,000, because your revised depreciation per year is actually in this year, I think there is some information is given. Let me have a look. Right, actually it is written on 31/3/2020. The company decided to adopt written down value method of charging the depreciation. Actually now on 31/3/2020, depreciation methodology has been changed. Now, so it is on now written down value. So 20% of 5,95,000, 1,19,000. That is why depreciation is 1,19,000. So balance carried down on 31/3/2019 will become 4,76,000. So that means now we have reached in the beginning of 1/4/2020, correct? And in the beginning, this is the value in the beginning of 1/4/2020, 4,76,000, correct? Actually in this year there is no information, and so you are going to provide a depreciation of 20%, which will be 95,200, and balance carried down will be equal to this much. And finally now we will come over to the beginning of 1/4/2021. Your balance is 3,80,800. Now in this year, what is happening? Pay attention here. In this year, it is given that on 31/3/2021, machines became idle and retired from the active use. On 31/3/2021, it is given machine became idle and retired from the active use but not held for disposal. still the machine have been retired, but still actually these machines haven't been classified as held for sale, because Ind AS 105 states that once you are going to classify a machine as held for sale, correct, then depreciation will not be charged. Actually, as per Ind AS 105, which deals with non-current asset held for sale, if an entity actually classified non-current assets as held for sale, then depreciation will be stopped. But here, even though these assets have been retired, but still the entity hasn't classified them as held for sale. That is why on 31st of 3/2021, you are still going to provide the depreciation on these machines. Is it clear to you or not? So on 31st of 3/2021, that is why we have provided what we call depreciation here, and that is why the book value at the end of 31st 3/2021 is this much. So now we have come to the beginning of 1/4/2021. As I told you, 3,80,800 is the book value. Now here it is written on 31st of 3/2022, the idle machines are held for disposal, but the machine could not be disposed of till the end of the year. So till the end of the year, you could not dispose of the machine. However, he says that at the end of the year, realizable value of the machine is 75% of the carrying amount, subject to 10% realizable expenses. Subject to 10% realizable expenses. What does it mean? That means at the end of 31st 3/2022, when I am going to reach, this is the beginning, and I am going to reach the end of the year. Now question says that this is the carrying amount in the beginning of the year. Now question says that the realizable value, now at the end of the year, these machines have been classified as held for sale because it is given in the question. So now I am not going to charge the depreciation, but it is written in the question that now the realizable value of these machine actually is only 75% of this. So that means I will have to carry the machine at these depreciation. Actually 75% of this is coming to 2,85,600, and it is also given in the question there will be some realizable expenses. So this is a net realizable value, this is the realizable value. You will have to subtract the what we call realizable expenses, which is 10% of 2,85,600. So net realizable value. So this will become the carrying amount at the end of the year, and you are not going to charge any depreciation because now the asset has been classified as held for sale, correct? So there is a loss because 3,80,800 worth of asset is now being classified as held for sale, and carrying amount actually is 2,57,040. So the loss will be debited to profit and loss account. Is it clear to you? And in the next year, in the beginning, you are going to bring down this particular value, and question has stated that you have sold this machinery at 75%. So 75% of 2,57,040 will be this amount, and then whatever balance will be there, that will be treated as loss. So this is the most comprehensive discussion which I have given to you. All module questions, all MTP questions, all examination questions have been well and truly covered. So today, as you can see flashing on your screen, that is Ind AS 21. So Ind AS 21, it's a pretty what we call dreaded standard, but don't worry about that. As always, we on our part shall leave no stone unturned in seeing to it that you get the crystal concept clarity of this particular standard also. So coming over to the theme of this particular standard, first of all, you need to understand and comprehend it quite well. In your earlier phases of education, you have already studied and standard by the name of AS 11. The basic difference between AS 11 and Ind AS 21 is that under AS 11, we presume let us say there is an entity, and this entity is operating in India. Correct? This particular entity is operating in India. We further presume that this particular entity has a foreign operation, let us say foreign branch, and the branch is, let us say, situated in Japan. Branch is situated in Japan. As we know, the currency of the Japan is yen. Quite obviously, it's a foreign operation. That means it is functioning independently. It is going to prepare its financial statement in the foreign currency, that is yen. While the head office, we presume that head office is in India, as we have already presumed, and we know that reporting currency of India, in fact, the national currency of India is actually rupee. Now, as per AS 11, because AS11 stresses upon reporting currency. And what is the reporting currency as per AS11? Reporting currency is the currency of the nation. Please and kindly pay attention towards these things. Reporting currency happens to be the currency of the nation in which the head office is located. Now, because in this particular question, we are presuming that head office is located in India, and that is why, and the currency of India is rupee, so that's why reporting currency will be considered as rupee. Because as per AS11, reporting currency is currency of the nation in which the head office is located. So that is why we have to actually now construe that reporting currency in this particular case happens to be rupee. So quite obviously, the financial statement which our foreign operation must have prepared in foreign currency, that is yen, that must be translated into what we call reporting currency, and the reporting currency is rupee. Is it clear to you? This is the concept of AS11, that how we can actually translate the financial statement of the foreign operation into the reporting currency. This is the concept of AS11. Now, presuming we will take the same story in the light of now Ind AS 21. Now, if I am going to take the same story as per what we call Ind AS 21, now in this case, everything is same. Let us say foreign operation is situated in Japan or located in Japan, and obviously the national currency of Japan happens to be what we call yen. So this particular foreign operation must have prepared its financial statement as per this particular currency, that is yen. Now, in the light of Ind AS 21, how we are going to translate the financial statements? Again, even Ind AS 21 also tells the same thing. Ind AS 21 also tells the same thing, that financial statement of the foreign operation must be translated into reporting currency. Although Ind AS 21 never use the word reporting currency, I will tell you later on that instead of reporting currency, we will use another word that is known as functional currency. Functional currency. Actually, the concept of Ind AS 21 is based upon functional currency. But in order to make the things a little bit easier, actually, you presume actually functional currency is nothing but it is reporting currency. But only difference is that under Ind AS 21, reporting currency is not the currency of the nation in which head office is located. We are presuming, because we are taking the same example, so we are presuming that entity or the head office is located in India, and we also know that national currency of India is rupee. As per Ind AS 20, as per what we call existing accounting standard AS11, the national currency of the nation in which head office is located is considered as the reporting currency. But Ind AS 21 doesn't say so. Ind AS 21 doesn't say that the national currency of the nation in which head office is located should be treated as reporting currency or functional currency. As I've already told you, instead of reporting currency, Ind AS 21 simply used the word functional currency. Now, functional currency is similar to reporting currency, but with only difference is that under AS 11, reporting currency or functional currency is the what we call currency of the nation in which head office is located. But as per Ind AS 21, functional currency could be national currency, or could be some other currency. Now, what we mean by actually functional currency then? Suppose if we presume that this particular entity is expressing all its sales, all its cost, all its expenses, and even the product prices, all these things are expressed in rupee. If this is the case, then only the functional currency will be treated as rupee. Are you getting my point or not? Even though head office or headquarters is located in India, we simply blindly will not tell that the reporting currency or functional currency is rupee. We will have to take into account what exactly is the functional currency is. Now, functional currency generally is decided by these factors. If the sales of this particular entity or all the cost, all the expenses associated, and even the product prices are what we call impacted by Indian currency rupee, then we will say its functional currency is rupee. But at the same time, suppose this particular entity is expressing its sales and cost and expenses in US dollars. In that case, the functional currency could be US dollar also. This is the point which you need to understand. I hope you got a bit of understanding. So under Ind AS 21, the reporting currency or the functional currency. I am telling you time and again, actually, reporting currency word is not used by Ind AS 21. Just to make the point a little bit clear, actually, I'm talking about reporting currency. Reporting currency actually is functional currency. So, reporting currency or functional currency could be the national currency of the nation, or it could be some other currency, depending upon the what we call these criteria. Now, we suppose that functional currency is rupee. If the functional currency is rupee, all the transactions, all the what we call foreign operations, financial statement will be translated as per what we call this currency, that is what we call rupee in this particular case. However, if this particular entity, as I told you, its functional currency, let us say, is dollars, in that case, financial statements will be translated on the basis of US dollar. Is it clear to you or not? Is it clear? So that is the basic difference between Ind AS 21 and AS 11. Once this particular difference is clear, let's come over to the next point, foreign currency. Quite obviously, under AS 11, all currency other than the rupee will be considered, generally will be considered as what we call foreign currency, but that is not the case in case of Ind AS 21, as I just told you. In case of Ind AS 21, all the currencies other than the functional currency, presuming that functional currency is dollar in this particular case, this entity is operating in India, its headquarters is in India, and presuming that even though the head office is in India, all the sales, cost, expenses, prices are expressed in what we call US dollar. So the functional currency will be considered as what we call US dollar. And in this case, all currencies other than functional currency will be treated as foreign currency. So foreign currency means the currency other than the functional currency. And remember one thing, functional currency is nothing but reporting currency, but with only difference is that it is not necessary that reporting currency will be the national currency. Reporting currency under Ind AS 21 could be some other currency. Is it clear to you? As we call it functional currency, instead of reporting currency, we will use the word functional currency under Ind AS 21. Now, in order to make this particular point a little bit clear, F6 Limited is an Indian company. Now, F6 Limited is an Indian company and its functional currency is US dollar. It is given to you, even though it is an Indian company, it is operating in India, its headquarters is in India. But in spite of that, its functional currency is not rupee. It is given that its functional currency is US dollar. And how this functional currency could be US dollar, as I told you, depending upon what we call expression of its sale, product prices, cost, and what we call expenses. So, it could be a possibility that all the majority of the sales are being expressed in US dollar, or what we call its prices are being influenced by US currency, US dollar. So that is the reason actually its functional currency is US dollar. So in this particular case, and moreover it is given in the question also that all of its revenue and cost are denominated in US dollar. That is why its functional currency is US dollar. So in this particular case, even though it's an Indian company, number one, its functional currency or reporting currency will be treated as US dollar, and all currencies other than what we call US dollar will be treated as foreign currency. Is it clear to you? Now, obviously, accounting of foreign currency transactions. What are foreign currency transactions? Suppose if my functional currency is rupee. If my functional currency is rupee, then all currencies other than the functional currency will become what we call foreign currency. Is it clear to you or not? All currencies other than rupee will be what we call foreign currencies. Correct? However, if my functional currency is US dollar, then all currencies other than what we call US dollar will become foreign currency. Is it clear to you? Right, sir. It is absolutely correct. For simplicity's sake, suppose if I presume my functional currency is rupee. Let us say I am an Indian company and most of my sales and revenue are being expressed in rupee, because that will be the more chances, because I am an Indian company. So it could be a greater possibility that most of my sales or transactions are being expressed in rupee. So that's why my functional currency is rupee. Now in this case, all the transaction will be treated as foreign currency. And let us say I have got some foreign currency transaction. Foreign currency transactions means transaction in currencies other than rupee in this particular case. Let us say I'm having some export imports with the US clients. Quite obviously in that particular case, the transaction must be taking place in dollars. So that will become foreign currency. So all such transactions which are done by an entity in foreign currency, how the accounting will be done now, that's the main question. So let's have a look over this. And remember one thing, 2-3 questions which have been asked in the examination from this particular standard are from this particular topic only. how the foreign currency transactions are initially recorded, this is the first point. Now, in order to comprehend this particular point, let's have a look. Let us say F15 Incorporation is an Indian company. Now, there is a company by the name of F15 Incorporation. It is an Indian company and it is clearly given. Never presume in advance that if it is an Indian company, its functional currency or reporting currency will always be rupee. No, never presume this way. It is given in the question that its functional currency is rupee. Now we are sure that its functional currency or reporting currency is rupee, and further reason is also given because its sales, revenue and cost are denominated in rupees. So that is why its functional currency or reporting currency is rupee. That is actually here what happens actually when we put our typed notes. When we put our typed notes into this iPad, so problem is that sometimes the rupee symbol doesn't get expressed. Actually, it is rupee. That is rupee. Correct? Now, what is given to you in this particular question? Let us say on 1/4/2028, the accounting year is beginning. And on 1/1/2029, obviously this particular accounting year will end on 31st/3/2029. So 3 months prior to the end of this particular accounting year, what happened? This entity F15, let us say, sells goods to a client in USA for $10,000. Because this time goods are being sold in US dollar and our functional currency is rupee, so dollar will be considered as what we call foreign currency. So it is a transaction in foreign currency. Now, exchange rate on that particular date, it is given for simplicity's sake, $1 is equal to rupees 50. So $1 is equal to rupees 50. Now, first of all, how the foreign currency, remember one thing, we are trying to learn actually how the initial recording with respect to foreign currency transaction is being done. So it is very simple. On the date of transaction, whatever will be the exchange rate, on the basis of that exchange rate, this particular transaction will be recorded. Are you getting my point or not? So how we are going to record this particular transaction? First of all, let me write here, let me tell you here, foreign currency transaction. Monetary or non-monetary, I will explain the meaning of monetary and non-monetary later on, are recognized in functional currency by applying the exchange rate on the date of transaction, as I told you. So all the foreign currency transaction, whether of monetary item or non-monetary item, they will be expressed and recorded by applying the rate, foreign exchange rate as we call it, which is prevailing on the date of the transaction. Now, in this particular case, because we have sold the goods, our entity has sold the goods, so entry will be foreign debtors account debit or simply debtors account debit. Since goods were sold for $10,000 and $1 is equal to rupees 50, so we have translated it into what we call functional currency. So 5 lakhs. So entry will be foreign debtors account debit to sales account. So this is the first point. All the foreign currency transaction initially will be recorded through applying what we call rate of exchange, which is prevailing on the date of the transaction. This is the first point which you need to take care of. Coming over to the subsequent recording. What we mean by subsequent recording? Generally, subsequent recording means after the initial recording. And generally after the initial recording, we reach the what we call end of the reporting date. On that date, when we do the accounting, it is known as subsequent recording. Now here in this particular case, you need to take care of this particular fact that when on the reporting date or the closing date or the balance sheet date, when we are going to what we call do the accounting for the foreign exchange transaction, in this particular case, you need to know the difference between monetary items and non-monetary items. If you remember, actually, even in the last session, we talked about monetary item, and I told you that in the balance sheet, actually, most of the items are of monetary item. Monetary item, in simple words, means such items which are carrying in the balance sheet at a particular amount, and we expect to receive or pay the same amount. Is it clear to you? While in case of non-current asset, generally it is not possible. For example, property, plant and equipment is appearing in the balance sheet at 50 lakhs. So I'm not certain that how much amount I am going to receive through sale of this particular item. So such items are termed as non-monetary item where there is no fixed determinable amount. But where there is fixed determinable amount, such items, and most of the items like debtors, like bills receivable, like cash, etc., all these items are termed as monetary item. So at the end of the balance sheet date, when we are going to do the accounting for the foreign currency transaction, we need to take care of this particular fact that all the monetary items, as I told you, debtors, creditors, bills receivable, bills payable, cash, etc., all monetary items are translated as per the exchange rate which is prevailing on the date of what we call balance sheet, also known as closing rate. Is it clear to you? All monetary items. However, on the reporting date, non-monetary items will be carried at historical cost. That means we need not require to express the non-monetary item at revised rate. So initially, at whatever value non-monetary items have been recorded, it will remain unchanged even on the reporting date. This is the point. Is it clear to you? Quite obviously, when monetary item will be translated using the closing rate, and obviously the closing rate will be different than the rate which was prevailing on the date of the transaction. So obviously we may have what we call some differences. That differences may be loss or gain, and such loss or gain, needless to add, actually will be transferred to profit or loss account. So in this particular case, all monetary items are recognized in functional currency by using the closing exchange rate, that is rate on the reporting date. This is exactly what I told you, and in order to explain this particular point, let's have a particular look over this particular question. Now, there is an entity by the name of F16 Incorporation. Once again, it is an Indian company. Its functional currency is rupee, and its functional currency is rupee. The reason is also expressed over here. Is it clear to you? Similar to the last question, the accounting year is starting on 1/4/2008, and on 1/1/2029, it is already given to you that F16 Limited sells goods to a client for USA for $10,000. On this date, the exchange rate was 50, correct? However, at the end of the year, that is on balance sheet date or reporting date, what we find actually exchange rate happens to be $1 is equal to rupees 60. So in this case, because rupee has devalued in the sense because now in order to acquire $1, earlier we were paying 50 and now we have to churn out rupees 60. So there is devaluation. It is unfavorable change. Is it clear to you? So on the reporting date, as I've already told you, all monetary items are recognized in the functional currency by applying the exchange rate. And as I told you, further any loss or gain thereof will be transferred to the statement of profit or loss account. Just to make the point clear, on 1/1/2029, when we did the transaction, my entry will be foreign debtors account debit to sales account because that is initial recording. Initially, we are going to record the transaction through application of rate which was prevailing on the date of the transaction. So on the date of the transaction, $1 is equal to rupees 50, so $10,000 will be equal to rupees 5 lakh. So this is the entry which I am going to actually pass initially. Now when I am going to reach the end of the accounting year, what entry I am supposed to pass? Now in this particular case, as I told you, because out of these two items, foreign debtors and sales, only debtor is monetary item. Remember one thing, number one. So monetary item debtor will be translated as per the closing rate now, because now the closing rate actually, what will be my entry? Because now foreign debtors, which I recorded earlier, is equal to 5 lakh. But now at the end of the year, $10,000, because the rate is equal to 60, that means my debtors amount must be equal to rupees 6 lakh. Rupees 6 lakh. Actually, in this case, because of devaluation, actually I am gaining. I'm gaining in the sense because earlier I am supposed to receive 5 lakh from the debtors. Now by the end of the year, I find actually my debtors amount has gone up to rupees 6 lakh. So there is a gain of rupees, you can say 1 lakh rupees. Is it clear to you? So at the end of the year, I will have to pass an entry so that in the financial debtors now appear at rupees 6 lakh, and at the same time reflection of gain is also there. So in order to increase the debtors by rupees 1 lakh, I will have to write foreign debtors account debit 1 lakh, and then this gain will also be taken to the profit and loss account. When I will pass this particular entry, now my debtors will appear at the end of the year at rupees 6 lakh. Is it clear to you or not? So that means there is a gain. You can also say we are gaining per $10. That means $10,000 into 10. Because my closing rate is 60 and earlier it was 50, so we are gaining by rupees 10. So that is why there is a gain, and this gain will be transferred to profit and loss account. While at the same time, at the end of the accounting year, when I am going to prepare my balance sheet, debtors are going to appear in the balance sheet at rupees 6 lakh. This is the point which you need to understand. I have already told you the non-monetary items. All non-monetary items shall be recorded on the reporting date at historical cost, and there is no need to remeasure the same. So non-monetary item, whatever value you have attached to them, initially at the same value they will appear on the reporting date. Now case study 3.22. Now in this particular case study, it is given F17 is an Indian company, its functional currency is rupee. Correct? Its functional currency is rupee. Again, the accounting year starts from this particular year on 1/4/2028, and this time the transaction, earlier in the first two cases we were selling the goods, but this time it is written F16 acquires plant from a client in USA for $10,000. So this time we are acquiring a plant. Correct? An exchange rate on the date of the transaction is rupees 50. So initially how I am going to record this particular transaction, because I am purchasing, so I will write here purchase account debit, and I will write to foreign supplier account. This is the initial recording, and initial recording will be by rupees 5 lakh, because on this date particular exchange rate is 50. Now when I am going to reach the end of the accounting year, it is written in the question, my exchange rate has gone up to $1 is equal to 60. Now, because the exchange rate has gone up, and out of these two items, purchases and foreign supplier, only supplier is monetary item. So that means at the end of the year, I will record the supplier at this particular value, $10,000 into foreign exchange rate which is prevailing at the end of the accounting year, that is equal to rupees 60. So ultimately foreign creditor or my liability has this time gone up to rupees 6 lakh. Because my liability has gone up to rupees 6 lakh, there is a loss to me. Are you getting my point or not? So in order to increase the liability and at the same time in order to book the loss, I will have to pass this particular entry at the end of the accounting year. Profit and loss account debit to foreign supplier account. So entry will be like this, and this entry you are going to pass down over here. Is it clear to you or not? As I told you, now plant will appear in the balance sheet at the same value at which it was appearing earlier. That means on 31st/3/2029, plant will appear at same value. In this case, we purchased a plant. I have written here purchases. It should be plant account. Extremely sorry. It is plant account debit to foreign supplier account. So plant will appear at the same value of rupees 5 lakh at the end of the accounting year. We call it historical cost. Is it clear to you? So such sort of question have been asked in the examination only from this particular topic, although this standard is pretty vast standard. But in spite of that, examiners of actually taking into account only this particular topic for tossing up the questions in the examinations. So not a very tough one at the same time, considering the level which you are having at this particular moment. However, you need to have a bit of idea regarding what we call functional currency. I have already given you some sort of hint, actually, how the functional currency is decided of an entity. Correct? Remember one thing, functional currency is reporting currency. But how this functional currency or reporting currency is decided as per what we call in the light of Ind AS 21. So there are some indicators before you decide upon your functional currency or reporting currency. There are some primary factors. Primary factors or indicators, you may call them. For example, if the currency which is influencing the selling price of goods and services, that means such currency which is influencing not only the sale prices of goods and services but also the sales transactions. Correct? For example, we presume that US dollar is influencing the sale prices. Then it is one indicator that why you should have functional currency US dollar. Similarly, currency of the country whose market forces and regulations are responsible in determining the selling prices. Correct? So currency, let us say most of the things which I am producing are being imported by the US dollar. So quite obviously, in this particular case, I would say that market forces, correct, US dollar, the currency US dollar basically is responsible for fluctuating the market conditions because they are the biggest importers from us. Similarly, currency which influences the labor, material and other cost. I've already told you, so these are the three criteria. Besides that, sometime it may happen that all these three criteria are missing and you are not in a position to find out what exactly is your functional currency or what should be your functional currency. So in that particular case, we take use of secondary indicators, additional indicators. Additional indicators will be taken use of only when primary indicators are missing in the question. Generally, you are not going to get any such question out of this particular topic, but still we have to play safe. Remember one thing. So currency in which financing activity take place, for instance, issue of debt of equity. Suppose I am an entity and Even though, let us say, I am an Indian entity, but most of the financing I take place in euro. So in that case, euro will become my financial currency. Similarly, currency in which receipts from operating activities are receipts. So these are some additional factors which are generally taken into account in practical life to decide upon the functional currency or the reporting currency. Remember one thing, Ind AS 21 never used the word reporting currency. I am using it just for simplicity's sake. Just to explain one particular point, let us say there is an entity by the name of F1 Limited. It is situated in India and it manufactures product, but its sales are denominated in rupee. Product prices are affected by market demand and forces and regulations of India. So that means in this particular case, obviously the rupee will be our functional currency. Correct? Also, all factors of production and inputs are sourced from India. Now question is asking you, assess the functional currency. I've already given you the answer. The functional currency will be rupees. Why? Because your sales are being denominated in what we call Indian rupee. Selling prices are denominated by the market forces of India and cost of input is expressed in rupee. So as seen, all the primary indicators are being satisfied. So without an iota of doubt, in this case, rupee will become your functional currency. Now we take another case in this particular case. Let us say there is an entity by the name of F2 Limited and it is engaged in extraction of oil from Oman. And we presume, I think it is correct that currency of Oman is Riyal. Is it clear to you? So there, this time entity is situated or located in Oman. Now where the national currency of Oman is Riyal. But the point is that we want to decide upon the functional currency. Let's see actually how this particular entity is going to decide upon its functional currency. It is given to you in the question, let us say sales are denominated in local currency of USA, that is dollar. That means most of the sales are being denominated in US dollar. Further, it is given sales are affected by global demand and global supply. However, USA accounts for 50% of the global demand. That means majority of the what we call sales are to USA, and that is why even though its sales are affected by global demand and supply, yet it is the USA which is playing a major role. So keeping into account all these things, we may say that in this particular case, Riyal will not be the Riyal, the national currency should not be considered as the reporting of functional currency. Rather, functional currency should be US dollar. So this is how you have to do the questions. Now these are the questions from your what we call MTPs. So most of the questions which are given in your examinations paper or what we call MTPs are simple question. To be very honest with you, see here. Here it is written, Utkarsh Limited declares the following information and exchange rate is also given to you. Exchange rate of US dollar and Indian currency. It is given to you that purchased goods on 12/3/2022 for US dollar rupees 1 lakh, and on this particular date the exchange rate is equal to 78.60. So quite obviously initially you are going to record this particular transaction at 1 lakh into 78.760. Correct? This will be your initial recording. And your entry will be purchases account debit to foreign creditors account, although the question is not asking you the entry. Further, it is given exchange rate on 31/3/2022 is 79. Now, when you are going to reach the end of the year, that means your foreign creditors, your liability will increase now because your liability has gone up to 79 per dollar. So this is the total liability at the end of the year. This is at the end of the year and this is the initial or on the date of transaction. So that means your liability has gone up by this particular amount, that is 1 lakh into 0.40. So this will be your loss. In fact, question is asking you what will be the gain or loss which the entity is going to book for the year 21 and 22. Actually, what is happening in this particular question, let me actually explain it through a diagram. So that you better comprehend the question, because right now most of you are not having the notes. I know this particular thing. Actually, our accounting year is starting from 1/4/2021 and it is ending on 31/3/2022 in this particular question. And now it is given that on 12/3/2022, on 12th of March 2022, that means just prior to the end of the current accounting year, we purchase the goods. Correct? And in this case, on that particular date, the exchange rate $1 was equal to 78.60. So I'm going to pass this particular entry. While at the end of the year, it is given that exchange rate is actually 79. And one more rate is given in this particular question, date of actual payment. But actual payment is made in the next year, that is, date of actual payment is 12th of April. Now 12th of April, on this date you made the actual payment. Remember one thing, this is the date of actual payment. When you are making the actual payment, question says that you have a further loss in the sense because rate has moved up to 79.50. First, let me explain, because question is asking only up to this particular stage. So question is asking how much of loss or gain we are going to book. So at the end of the year, I am going to book a loss of this much. So this is a loss to us. So in the financial year 21 and 22, I am going to book a loss of, so whatever figure you are going to get, most probably it will be equal to 40,000. So 40,000 you are going to get the loss. But the important point that, even though the question is not asking, just to make the point a little bit clear, when we are going to make the actual payment, because on this particular date, now my liability is appearing at 1 lakh into 79, that is almost 79 lakh, correct? Isn't it or not? 79 lakh. But when I am going to make the payment, I will have to make the payment as per the rate which is prevailing on this particular date, that is 1 lakh into 79.50. Now, because when I am going to make the payment, I am going to make this much of payment. While on the balance sheet, you have recorded your total liability as 79 lakh, 1 lakh into 79, as I told you. And you are going to make a payment of, I think, 79 lakh 50,000. So that means from the end of the accounting year till the date of the payment, there is another loss. There is another loss, and you will have to write this entry, profit and loss account debit to foreign creditors account. Are you getting, or if you do not want to write this entry, you can also write this way. Because now you are making the payment, so your entry will be foreign creditors account debit. You can straightway write this particular entry, 79 lakh 50,000, presuming my calculations are correct. Don't actually message me. Whatever calculations you get, you write that particular figure. Foreign creditors account debit, correct? We have to make a payment. But we have so far recorded on the balance sheet actually foreign creditors at 79 lakh. So you can pass a single entry, 79 lakh foreign creditors, but you are making a payment of 79 lakh 50,000. So you are going to write here two banks, 79 lakh 50,000. So there is a further loss. So you can write here profit and loss account debit 50,000. So on the date of payment, you can pass down this particular entry. Is it clear to you or not? So that means, even though question is not asking, but in the next financial year, that is 22-23, I am going to recognize further a loss of rupees 50,000. In this accounting year, I am going to recognize a loss of rupees 40,000, as I told you already. So such sort of questions you are getting in the examination. Yet another question, this has been taken from MTP June for your June 24 term. On 1st of January 2023, it is given that P Limited purchased a machine for rupees 2 lakh. So on 1st of January 2023, entity purchased a machine for $2 lakh, and it is given functional currency of P Limited is rupee. It is clearly given in the question that functional currency of our entity, correct, is rupees, is rupee. At that date, the exchange rate was 68. So at that date, the exchange rate is 68. So quite obviously, my initial recording, when I am going to do my initial recording, because we have purchased a machine, so my entry will be machine account debit to foreign creditors account if you want to write entries. It is not necessary, to be very honest with you. So because we purchased the machine for $2 lakh, so I am going to multiply it with rate, and rate on this particular date is 68. So this will be the amount in lakhs, rupees in lakhs. So machine account debit to what we call foreign creditors account. This is the entry you are going to write. Is it clear to you? This will be your initial recording. Further, it is given P Limited is not required to pay for the purchase till the 30th of June 2023. Actually, we are acquiring it on 1st January 2023. Because this transaction is taking place, you need to keep track of the accounting year. It is of paramount importance when you solve the question, especially in the examination. Because it is given that transaction has taken place on 1st of January 2023, Quite obviously, after some time, your accounting year will come to an end. That is 31st of 3, 2023, your accounting year will come to an end. And you are supposed to make the payment in the next year, because now the next year will start and you are supposed to make the payment in June 2023. This date is going to fall in the next year. Are you getting my point? So you have passed this particular entry on 1/1/2023. This is the entry which you have passed. Now further it is given in the question, rupee is strengthened against the dollar in the next 3 months following purchase, and by 31st of March 2028, the exchange rate $1 is equal to 65. Now when we are going to reach the end of the accounting year, that is on 31st of 3, 2023, now it is given that exchange rate is 65. Now if exchange rate is 65, my foreign creditors, because foreign creditors, see, I need not require to make any changes in the machine, because machine is a non-monetary item and machine will keep on appearing at the same value. Is it clear to you? So only thing is that foreign creditor is monetary item, and the values of the monetary item will be taken into account, any changes if exist. So because now foreign creditor, which we earlier must have recorded at this particular value, now we will have to record it at the rate of what we call 65. So 2 lakh US dollar into what we call rate on the reporting date. So this will be the value of foreign creditors. Quite obviously, this value will be lesser than this value. So there is a gain to me. That means on 31st of 3, 2023, my foreign creditors, my liability will decrease, and at the same time, there is a gain to me. So you can compute the gain by taking into account the difference of these two, or you can simply compute it straight away, 2 into, because now there is a decline of rate by rupees 3. So this will be your gain. Is it clear to you? This is how you are going to pass the entry. I'm telling you through entries way, and further it is written CFO of P Limited, Chief Financing Officer of P Limited, feels that these exchange fluctuation would not affect the financial statement. Now, Chief Financial Officer of this particular entity is extremely expert. He says that no problem, even if there is change in what we call exchange rates, so there is no problem, because his asset and liabilities are denominated at the same value, because he thinks that we have purchased a machine and along with there is a liability, one is asset, another is liability, correct? So even though some fluctuations has taken place on account of what we call changes in the foreign exchange rate, so it will impact the asset, it will impact the liability, so difference will get neutralized. So he is extremely expert, people. I do not know actually how come he is the CFO of this particular company, but anyway, this is his version. Further it is given, he also feels that P Limited depreciates the machine over 4 years, so the future end amounts will not be the same. He also gives his own version. He tells ultimately we are depreciating this particular asset. Are you getting my point? We are depreciating the asset over a 4-year period of time. So why we need to make so many changes? This is the version of what we call CFO. Now, examiner is asking you, examine the impact of this transaction on the financial statement of P Limited for the year ended 31st of 3, 2023. That means when your accounting year will end, you have to actually show the impacts. Actually, I have already shown you the impact, but how to write the answer? As per Ind AS 21, the effects of changes in foreign exchange rate, the assets and liability will be initially recognized at the exchange rate which is in force on the date of the transaction, that is on 1st of January. So on 1st of January, as I've already told you, initially we are going to record the amount at $2 lakh into 68, and that comes to actually rupees 136 lakhs. So at this value, we are going to record 136 lakh. Is it clear? The liability is a monetary item. As I told you, all the monetary item on the reporting date must be translated by using the what we call exchange rate, which are prevailing at the end of the reporting date. So the liability is monetary item, so it will be retranslated using the rate of exchange in force as at 31st of March 2023. And this makes the closing liability. As I told you, my closing liability will be now equal to 2 into 65, that is 130 lakhs. So it is given that 130 lakhs, or 2 lakh into $2 lakh into 65. So obviously it is a gain because you recorded your liability earlier at 136. The gain on retranslation of rupees 6 lakh, 136 lakh minus 130 lakh, this is a gain and it will be recognized in the statement of profit and loss account. Now coming over to the machine. Now as far as machine is concerned, it is a monetary item and it will appear at the end of the accounting year at the same value. Is it clear to you? At the same value. However, we need to charge a depreciation on it. So depreciation will be charged because it is given in the question that the policy of the company is to write off the machinery over a 4-year period of time. Over a 4-year period of time. It is given to you in the question. That means their depreciation rate is this much. But you should not forget, when you are going to provide the depreciation for the first year, only 3 months have elapsed so far. So what will be your depreciation? Because you have initially recorded the machinery at 136 lakh. So depreciation from 1st of January till the accounting year will be equal to this much into 1 by 4. This is depreciation for 1 year. Correct? This is depreciation for 1 year, but I need to compute depreciation for 3 months only. So 3 by 12. And the depreciation will be equal to 8,50,000. So this will be the depreciation. So at the end of the accounting year, your machinery will appear at this particular value, 136 lakh original cost minus depreciation. At this value, machinery is going to appear. So this is today Ind AS 23 borrowing cost. Of course, this standard is not very painful in the sense because you have already gone through in your earlier phases of education, correct, through this particular standard, because you have already studied AS 16, which also dealt with borrowing costs. And there is hardly any difference, to be very honest with you. And you know the crux and the theme of this particular standard. But just to make the point a little bit more clear, actually, because we have a habit of starting right from the scratches. We presume that there is a particular organization, and this particular organization on 1/4/2025, let us say, raises a loan of rupees 100 lakh. Raises a loan of rupees 100 lakh, and we further presume that the loan has been raised at an interest rate of 12% per annum. Correct? And we also presume that this particular entity is interested in constructing a very huge plant, construction of plant. This particular loan, this particular entity has raised in connection with what we call construction of this particular plant, or for that instance any asset, correct? And loan has been raised on this particular date. So on such presumptions we move further, correct? So on 1/4/2025 loan has been raised. Obviously our first accounting year will come to an end on 31st of 3/2026. Our accounting year will come to an end on this particular date. We further presume that even though the loan has been raised on this particular date, but the construction activity actually commenced only on, let us say, 30th or 1/7/2025. In this case, my first question is how much interest company will ultimately pay in this particular accounting year, if I'm going to ask, because the loan has been raised on 1/4/2025 and the amount of the loan is 100 lakh. So for the whole year, total interest paid by the company will be equal to how much? Total interest paid by the company will amount to 1,20,000. No doubt about that. 1,20,000. Correct? So interest paid by company actually is 1,20,000. But out of this particular 1,20,000, for the first 3 months, we have seen actually no construction activity took place. In fact, on 1/7/2025, as I told you, construction activity, CA, construction activity commenced. Construction activity commenced. On this particular date, actually, our construction activity commenced. So even though we have raised the loan on 1/4/2025, but the construction activity actually got underway from this particular date, 1/7/2025. So in such a scenario, actually, the interest for the first 3 months, so whatever interest will be related to the first 3 months, that means 30,000, obviously 1,20,000 into 3 by 12. So interest for the first 3 months will be charged to profit and loss account. It will be expense. It will be charged to profit and loss account. And after this, whatever interest which we have paid on this particular loan, correct? Because on this particular date, now the construction activity has got underway construction got started, and till the end of the accounting year, we presume that construction activity is still on. So during this particular phase, when the construction activity is on, so in that case, we will say that interest for the 9 months will be charged to asset account. Interest will be charged to the cost of the asset. Indirectly, it means the interest will be capitalized, or in the language of the standard, we will call borrowing cost will be capitalized. Actually, our borrowing cost is 1,20,000. Out of 1,20,000 for the first 3 months, because no construction took place during this particular phase, that's the reason for the first 3 months we are going to charge the interest cost as normal expense. We'll debit it to profit and loss account. While once the construction activity gets underway, after this, if the construction activity remains in force or continues during that particular phase, whatever interest the entity is going to churn out, that is going to be capitalized. Capitalized means we are going to debit it to the what we call cost of the asset. Indirectly, capitalization means you are making it as a part of the cost of the asset. Is it clear to you or not? Presuming further, now our next accounting year will start. Our next accounting year, let us say, starts on 1/4/2026. On 1/4/2026, and we will reach the end of 31st of 3/2027. Now we further presume that whole year the construction activity continued. In this particular period, the construction was underway because ultimately we are constructing a very huge plant, as I told you initially. So obviously it will take time before it gets what we call completed. So next year, for entire 12 months, the construction activity was on. So during this particular phase, whatever interest which you have paid, needless to add, will be capitalized, will be added to the cost of the asset, or will be capitalized. It will be charged to asset. Is it clear to you? Now, we further presume our third year starts on 1/4/2027. And obviously it is going to end on 31st of 3/2028. Now for the first 3 months, our construction activity were going on very smoothly. But suddenly on 1/7/2027, our construction activity got hampered or obstructed, or active development. Active development means the construction activity. The construction activities were put on hold, let us say, for another 3 months. Construction activities were put on hold from 1st of July till what we call 1st of October, till 1st of October 2027. So during this particular phase, our construction activities, construction activity got interrupted. Got interrupted means got obstructed, or construction activity were stopped temporarily or were paused for a while. And these activities were paused for a while, let us say, due to some reasons which were beyond our control. If your construction activity or active development gets interrupted due to reasons which are beyond your control. For example, let us say we were constructing this particular plant on a particular site, and the local people actually started protesting the construction of this particular what we call activity. So there was, let us say, some political unrest. That means there were some reasons which were not in our control. So if the construction activity gets interrupted due to reasons which are beyond control, in that particular case, now, before I move further, also let me also tell you, actually, in this particular accounting year, my total interest paid will be 1,20,000. Obviously, we have taken a loan. Each year, we must pay actually 1,20,000. For the first 3 months, I'm going to charge the interest to the asset account because during the first 3 months, construction activity was on. No doubt about that. But what about this particular period? Because in this particular period, that means the next 3 months, in the next 3 months, our construction activity got stopped, got interrupted, got obstructed, got hampered, correct, were paused temporarily, it means, and due to reasons which were not in control. If the construction activity gets stopped or interrupted due to reasons which are not in control of the entity, in that particular case, standard says that capitalization of borrowing costs should be suspended. So capitalization of borrowing costs should be suspended. What we mean by that? Should be suspended. In that particular case, construction activity must be suspended. Suspended means should be temporarily stopped. capitalization of borrowing cost should be stopped. And when we say capitalization of borrowing cost, indirectly it means we are charging the interest to the what we call cost of the asset. That means we are charging the interest to the asset account. But now the standard says that capitalization of borrowing cost should be stopped or suspended temporarily. Suspended means temporarily stopped. So during this particular period, now I am going to charge the interest to profit and loss account. If I am saying capitalization of borrowing cost should be suspended, indirectly it means now I should not charge it to asset account. I will charge the interest to the profit and loss account. Is it clear to you? And we further presume that after this particular point, again the construction activity resumes. And if the construction activity would resume, then for the next 6 months, whatever interest you have paid will again be debited to what we call asset account. Is it clear to you or not? Now we presume that our next accounting year starts from 1/4/2028. Our next accounting year starts from 1/4/2028. Obviously, now the accounting year will end on 31/3/2029. Now, in this particular accounting year, from the beginning till the 30th of June, 2028, that means for the first 3 months, once again, active development is stopped. When we say active development is stopped, when we say, it means our construction activities are paused or interrupted or disrupted, whatever word you may like to use, correct? Active development is stopped. Active development is stopped. And active development is stopped. This time, construction activity is stopped due to reasons. Now pay attention. Due to reasons which are necessary for such stoppage, which are necessary for ultimate completion of the task, 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 ultimate completion of the task or of the project, whatever you may like to say. Try to understand this particular point. Now, again, this time in the first 3 months in the next year, actually first 3 months as I am writing over here, that first 3 months our construction activity or the active development is stopped. But this time the activities are stopped because stoppage of these activity becomes a necessary part so that we are able to complete the task. What does it mean? You will be able to understand it better actually when I will give you an example. For example, let us say there is an entity. And this entity, let us say, is constructing a bridge on a river. And this is the river. My drawing is not very good, as you know. Actually, this is the river. Is it clear to you? And this entity is constructing a bridge on this particular river. This is the bridge entity is constructing on this particular river. Now, during this particular period, from 1/4/2008 till 30th of June, this is the period in the area actually when there are high water conditions or wind blows at a supersonic speed. That means conditions are not very conducive for the construction. Are you getting my point or not? Our entity, let us say, constructing a bridge in that particular area. And I just told you, during this particular period, especially in that particular area, we find actually there are high water situations because of what we call supersonic speed of the winds. So that means conditions are not very conducive for the active development. So it is better to stop the work so that no untoward incident take place, no casualty take place. So to be on the safer side, it is better to stop the work for a particular period of time and restart it later on when the situation becomes conducive. So this time, try to understand, this time we have stopped the work because such stoppage is necessary for the ultimate completion of the task, because we have to stop it so that later on we are in a position to complete the task smoothly. Is it clear to you or not? You must have seen the difference between the earlier interruption and this particular interruption. So if the work is stopped or what we call gets interrupted, or active development gets stopped, but due to reasons which are considered as necessary condition for such stoppage so that ultimately we are able to complete the project, in that particular case, the standard says that capitalization of borrowing cost should not be suspended. Capitalization of borrowing cost should not be suspended. So during this particular phase, you should not suspend capitalization or borrowing cost. Capitalization or borrowing cost should not be suspended. Should not be suspended. This is the point which you need to understand. Should not be suspended. Should not be suspended means we should continue actually charging it to asset account. That means whatever interest which we are going to pay during this particular period, correct, even that particular interest this time will not be charged to profit and loss account. Rather, we will continue charging it to asset account. We will continue what we call capitalizing it. We further presume after this particular date, the construction activity resumed. And ultimately, when we reached on 31st of 12, 2029, the construction got completed. Now, construction got completed. Construction got completed. So again, from 30th June till the point asset get actually completed, because construction activity was on. So whatever interest we must have paid during this particular period will again be charged to asset account or will be capitalized, one and same thing. But once the asset will become completed, obviously after that, you will have to now stop capitalizing the borrowing cost. We call it cessation. Cessation means complete stoppage. Cessation of borrowing cost. That means now we should stop charging or capitalizing the borrowing cost. We should stop charging the what we call interest to the asset account. Henceforth, after this particular point, now asset will be charged. After this particular point, the asset will be charged to profit and loss account. Is it clear to you or not? So this is the point which you need to understand in this particular case. Now, it is also important for you to understand that when we start actually capitalizing, when we started capitalizing, when the construction activity got underway. Is it clear to you? When the construction activity got underway, directly or indirectly, we kept on charging the interest. We kept on capitalizing the interest till the point actually asset get completed. Indirectly, it means we will keep on capitalizing the interest till the asset is under the phase of construction. And this phase indirectly can be termed as qualifying. That means if the asset is under the construction stage, that means it is a qualifying asset. And if the asset is qualifying, obviously whatever interest during this particular period you are going to pay, obviously you will have to capitalize it. You will have to charge the interest to the asset account. But once the asset will get completed, we call it asset has now become qualified. And once the asset will become qualified, after that particular point, you are not going to charge the interest to the asset account. After that, you are going to charge it as normal expense and you are going to debit it to profit and loss account. Is it clear to you? You must have also noticed that in this particular period, the asset actually got completed almost after 2.5 years. Isn't it or not? Or 3.5 years, whatever it might be. Generally, an asset is considered as qualifying asset. Generally, an asset is considered as qualifying asset when it takes a substantial period of time. When it takes a substantial period of time for ultimate completion. Substantial period. Actually, this particular standard hasn't prescribed any limit. 12 months, 13 months, etc. The standard simply says that that particular asset on which you are incurring the expenditure or in connection with which you have raised the funds actually, that qualifying asset, an asset is considered as qualifying only if it will take a substantial period of time before it gets what we call qualified or before it becomes what we call completed. So substantial period basically means actually, even though standard hasn't, I've already told you, standard hasn't clarified what we call any time limit, but generally we consider it as a period of 12 months. So if a particular asset takes a period of more than 12 months before it becomes completed, that means if the asset takes a substantial period of time before its completion, then only it will be considered as qualifying asset. Is it clear to you or not? Generally, we find actually qualifying asset, I will give you some examples also. Qualifying asset I must have written somewhere. For example, like intangible asset under development. For example, an entity has raised a very big loan, huge amount of loan to develop what we call an intangible asset. Quite obviously, in order to develop the intangible asset, lots of time get consumed. So that is the reason it is generally considered as a qualifying asset. Such inventories, other than normal what we call inventories, there may be some inventories which takes lots of time before they get mature, and even such inventories will be considered as qualifying asset. Likewise, what we call power generation plant, what we call generating plant, and investment properties, etc. Generally, these are considered as your qualifying asset. Is it clear to you or not? Now, I have already told you, basically, there are three important phases in this particular chapter, and I have already talked about those. When to begin the capitalization of the borrowing cost, we have already seen. When to suspend the capitalization of borrowing cost. When to suspend, when your active development gets stopped, but because of reasons which are not in your control. In that particular phase, actually, you are not going to actually charge the interest to the asset account, because you will have to suspend now. Suspend capitalization of borrowing cost. Indirectly, it means during this particular phase, you are not going to charge the interest to the asset account. Rather, you are going to debit it to profit and loss account. Then we also talked about what we call when to cease the capitalization of the borrowing cost. Of course, when the asset will get completed, now we will stop what we call charging the interest or capitalizing the borrowing cost, because now the asset is completed. Henceforth, whatever interest the entity would pay on such raised funds will be charged to what we call profit and loss account. Is it clear to you? I have already talked about these two examples. Example 1, when I talked that construction got interrupted because of what we call reasons beyond control. So under such circumstances, I have already told you capitalization of borrowing cost will be suspended. Now during this particular phase, the interest will be charged to profit and loss account. Then another example I gave to you wherein I talked about this particular fact that entity is constructing a bridge over a river. I told you this time the construction activity is getting what we call stopped on account of such reasons which become necessary to stop the active development, so that later on we are able to complete the project. So during this particular period, when active development gets stopped due to such reasons, during that particular phase, you will keep on continuing the what we call capitalizing the borrowing cost. And when to suspend the borrowing cost, I have already talked about this particular fact. When your asset will no more remain qualifying, it has become qualified, that all the necessary conditions to complete the asset are now completed. So obviously now you have no reason available with you to keep on capitalizing the what we call interest cost. So now henceforth you will stop it, you will cease it. Cease means completely, comprehensively you are going to stop it now, capitalizing the interest. Now, we will pick up this particular case study. Now, in this particular case study, I have written here on 1/4/2027, accounting year starts. And on 1/5/2027, entity took a loan for construction of a building. Remember one thing, this time entity has taken a loan not on 1st of April. Entity has taken a loan on 1st of May. And now the question says that on 1/1/2028, the construction activity completed and building put to use. And building is put to use. And accounting year ends on 31st of 3/2028. Now, just to make the point clear, in this case, entity took a loan for construction of the building on 1/5/2027, and almost 3 months before the end of the current accounting year, construction activity got completed. Actually, out of 12 months, you must have noticed, out of 12 months, in the first month, loan was not raised. Loan was raised on 1/5/2027. That means we are now having 11 months in the year. And in these 11 months, we must have seen actually construction activity got completed 3 months before the end of the accounting year. Is it clear to you? Before the end of the accounting year. That means during this particular phase, this asset or the construction activity were on. Now in this particular case, it is given in the question itself that interest paid by the company for the entire year is actually 25 lakhs. So first of all, you need to understand that in this particular case, because it is given in the question that entity took a loan for construction of the building and the loan has been taken on 1/5/2027. So logically, this particular interest is for 11 months. This is interest for 11 months. This 25 lakh is for 11 months. Isn't it or not? Because we took a loan on 1/5/2027. That means this interest of 25 lakh is related to 11 months. Out of these 11 months, I have already told you, if we are going to compute the period from 1/5/2027 till what we call 1/1/2028, it comes to 8 months. So out of this 11 months interest of 25 lakh, 8 months interest will be capitalized. So in this particular case, I will say interest to be capitalized for the period, for this particular period, that is from 1st of June 2027 to 1/12/2027, that is 25 lakh into 8 by 12, that comes to actually 18.18 lakh. Is it clear to you? And rest of the interest, when the asset got completed on 1/1/2028, after this particular point, whatever interest you have paid for the remaining 3 months of the year will be what we call charge to profit and loss account. So this is the point which you need to understand. Now we come over to this particular point, special borrowing. When we say special borrowing, it means the special borrowings means the borrowings which the entity has raised in connection with acquisition or construction or production of the asset. Particularly, we have raised the loan specifically for construction activity or what we call acquisition of the asset or for the production of the asset. Is it clear? That is specific means particularly this loan has been raised for this specific purpose. The purpose could be acquisition, could be production, or could be construction. So how to actually treat such interest? The point is this. In order to comprehend this, let's have a look over this particular case study. Here it is written on 1/4/2027. Entity raised a loan of 1,000 lakhs at 10% per annum for the construction of a plant. And it is also given on 31st of 3/2028, the construction activity is still on. The construction activity is still on. Further, it is given 800 lakhs used for construction and 200 lakhs invested temporarily in the securities. Now, sometime it happens actually because we have raised a very high amount of loan. You must have seen it is given that you have raised a loan of nearly 1,000 lakhs. 1,000 lakhs worth of loan your entity has raised. This is given in the question. And further, it is also given this loan has been raised at 10% per annum. So it's a pretty huge loan. So whatever amount of loan which you have raised, it is not necessary that the moment you are going to start the construction, you are going to spend this entire amount. Slowly and steadily, as and when the construction activity would demand expenditure, you are going to spend the amount. You are not going to spend the entire amount straight away. Isn't it or not? So in this question, it is written that out of 1,800 lakhs you are using for the construction activity, and rest of the 200 lakhs actually you invested somewhere. Obviously, because you have taken a loan, you have to repay the amount, you have to repay the interest. So sometime entities thinks actually we are not able to utilize the entire amount. So why not? And why should it remain idle? Why not we should actually invest somewhere else and earn some interest? So this is exactly what happened in this particular case. Out of 1,800 are used for the construction activity while 800 were invested somewhere else. And now it is also given in the question that interest and dividend income, interest and dividend received on the same is equal to 20 lakh. So when we take loan specifically for the construction, acquisition or production of the asset, in that case, what we mean by actually a specific loan and its capitalization. Obviously, on such loan, I will have to actually give some interest, provide some interest. So quite importantly, you need to understand in this case that you have raised a loan of 1,000 and 10% is the interest. So your actual cost of borrowing is coming to 100 lakhs. No doubt about that. But the point here is that out of 100 lakh worth of interest, you are spending 100 lakhs as an interest, but at the same time you are earning 20 lakh as interest income because you invested the idle fund somewhere else. So your net interest which you are going to capitalize will be considered as 80 lakh. This is the point which you need to understand. That means your actual net interest will be capitalized, not the gross interest. Is it clear to you? Now in case study 4, it is given that on 1/4/2027, construction is still on. Correct? On 1/10/2027, entity raised a loan of 20 crores. Actually, this construction activity, I think this is wrongly printed. This is the beginning of the accounting year 1/4/2027, because it is written over here that on 1/10/2027, entity raised a loan of rupees 20 crores at 10% per annum for the construction of the plant. And now it is written construction activity is still on till the what we call end of the accounting year. Further, it is written 15 crores were used for construction and remaining 5 crores invested temporarily in the what we call securities, and you have received what we call interest and dividend income of 0.5 crore. You must understand that you have raised a loan of 20 crore. Number one. Number two, out of 20 crore, 15 crores you have used in the construction activity and 5 crores you have invested temporarily. From there on, you have earned an income of 0.5 crore. First of all, what is your actual borrowing cost? Actual borrowing cost will be 20 crores into 10%. You must understand that you have raised a loan on 1st of October. So quite obviously, if I am going to compute the period from this particular date till the end of the what we call year, it will be 6 months. So on this particular date, we have raised a loan. Is it clear to you? So because we have raised a loan, and in the first period, our total interest will be on 6 months period. So I will compute 20 crores into 10% into 6 by 12. That means total interest paid by or will be payable by my company will be equal to 1 crore. But out of 1 crores, I am going to subtract the income from temporary investment. Now, income from temporary investment is 0.5 crore, which is given to you. So your net actual interest, which you are going to use for the capitalization purpose, will be equal to 0.95 crores. This is the point which you need to understand. Now we pick up case study 5, and in this particular case study, it is given to you on 1/4/2028. V5 Limited is a company, and it is engaged in the construction of a business, and it obtained a loan of 32 crores. Is it clear to you or not? Further, it is given in this particular question, this entity is engaged in the construction activity. Number one, it is also given, and the amount of loan, number two, is given to you as 32 crores. Now, it is given that this entity utilized 32 crores for the construction of a sea link between two cities. Let us say this is the sea, and there are two cities, X and Y. And in between there is a sea, and entity, let us say, is constructing a bridge, let us say. So here it is written construction of a sea link. That means entity is constructing a link so that both these cities can get linked. So construction of sea link across two cities. Now just to confuse you, actually, here it is written work held for a month during the year due to high water delays. I just told you earlier, a moment ago, if your construction work gets stopped due to such reasons which are necessary condition, that means which is a necessary condition, means such stoppage becomes necessary, correct? So that you are able to complete the task actually smoothly and ultimately. So even in this particular period, as I told you earlier, even though the work has been stopped for a while, for 1 month, you are not going to what we call stop the capitalization of the borrowing cost. As I told you earlier, in this phase, capitalization of borrowing cost should not be suspended. That means you will keep on capitalizing. So this particular line is not going to make any difference. So total amount out of 32 crores, you have spent 25 crores in the construction of a sea link. Further, out of 32 crores, you have used 3 crores in purchase of equipment and machinery. And then another what we call 2 crores in working capital. Another 50 lakhs in what we call purchase of vehicle. And you have given some advance money for tools and cranes. This is advance given, 50 lakh, and purchase of technical know-how, 1 crore. And further, it is given to you in the question that total interest paid by the company for this particular accounting year 28 and 29 is actually 80 lakhs. So we have to find out the amount of interest which the entity would actually charge to profit and loss account and would capitalize. So first of all, you need to understand that construction of sea link between two cities, because the construction activity is still on, so whatever interest which is related to what we call this particular activity will be capitalized. No doubt about that, because our total interest is 80 lakh. 32 crores is the total amount of funds which the entity has borrowed. And out of 32 crores, we have seen 25 crores are being used for the construction of the link. So on 32 crores, we have seen there is an interest of 80 lakhs. So what will be the interest on 25 crores? So you can easily compute it this way around. Whatever figure you are going to get, in fact, 62 lakh 50,000 you are going to get. So 62 lakh 50,000 worth of interest will be capitalized. Is it clear to you? How? Because it is a qualifying asset. Now, purchase of equipment and machinery cannot be classified as qualifying asset because I told you a qualifying asset is one which takes a substantial period of time because they are already ready to use, because we have purchased an equipment, so they are ready to use. We need not require to do anything to them. So that is why they will not be treated as qualifying asset. And if they are not going to be treated as qualifying asset, so whatever interest which you are going to apportion to their cost, because out of 32 crores you have spent 3 crores on purchase of equipment, so you can easily compute the interest portion on 3 crores, which will come to 7,50,000, and it will be charged to profit and loss account. Working capital. Now, working capital cannot be qualifying asset, as you know, because it is a capital, it is a current asset. 5 lakh will be the interest, because out of 32 crores, 2 lakh is the proportion of the working capital. So what will be the interest which you will apportion to 2 lakh? That will be equal to 5 lakh. It will be charged to profit and loss account. Likewise, purchase of vehicle, it is not a qualifying asset because it is already ready to use. No substantial period of time is needed. Similarly, advance. Any current asset will never be treated as what we call qualifying asset. And similarly, purchase of technical know-how, because no substantial period is there. So that means whatever other things are given besides the construction of C-Link, interest on them will be treated as revenue expenditure and you are going to charge to profit or loss account, while interest of 62 lakh 50,000 will be capitalized. Is it clear to you or not? Now we come over to the general borrowing part. In order to comprehend the general borrowing part, allow me to have a sip of tea first of all. General borrowings. As you know, we have already talked about what we call special borrowings. Sometime it happens actually, company might have raised a loan to construct a particular asset. Because loan has been particularly raised to construction, for construction of a particular asset, it will be termed as a specific loan. It is a specific loan, no doubt about that. But sometime an entity raises loan generally for general purpose, correct? For various activities. So company might actually raise some loan. So that will be known as non-specific loan. It will be known as non-specific loan, and it is a specific loan. Is it clear to you or not? So if in the question there is some general loan, then what impact it will have in the calculation? Remember one thing, the calculation complexities will come into play only if the entity will utilize some general loan. If entity is going to utilize some portion of the general loan in the for the purpose of construction, acquisition, or production of the asset, then only complexities will arise. Otherwise, there are not going to be any complexities, isn't it or not? So here we are going to pick up this particular case study to understand the intricacies of this particular concept, and it is not a tough one, let me tell you. E15 Limited began a construction of new building on 1/4/2028. It is given to you. Further, it is given that it obtained a loan of 1 lakh, and this is a special loan. A special loan means specific loan. In order to start the construction of a new building on 1/4/2028, entity took a special or specific loan of 1 lakh to finance the project, to finance the construction of the building. And this loan was raised at 10% per annum. It is also given to you. And now it is given to you that this company is also having 2 other outstanding loans which are non-specific loan, that mean not for any particular purpose. And there are 2 such loans, non-specific loan. 2 such loans are there. One loan is of 5 lakh and it is carrying an interest along with it to the extent of 11%, while loan amount of 9 lakh is also there, but its interest is 13%. And your problem will aggravate with it if you are having more than one general loan. In this case, you are having more than one general loan. General loan means non-specific loan. 2 types of loan and their rates of interest are different. Then your problem will little bit aggravate. Don't worry about that. Now further, it is given to you in this particular case that expenditure that was made on the building project was as follows. Now on the building project, you have made an expenditure phase wise. On 1st of April 2028, you spent 2 lakh. On 1/7/2028, then another 2,50,000, and on 1/10/2028, another expenditure of 4,50,000 has taken place, and on 1/3/2029, you spent 1,20,000. And building was completed by 31st of 3/2029. Now in this particular case, calculate the amount of interest to be capitalized in past entries. Now in this case, we will have to calculate the interest, correct? So in order to compute the interest, so first of all, you need to take into account this particular fact over here. Whenever in the question it will be given to you that you are spending the amount in a phase-wise manner. For example, you have spent some amount on this particular date, some amount on this particular dates, and similarly, in 4 stages you are spending the amount. So first, your first target will be to actually compute the average expenses. Average expenses. What we mean by average expenses? Calculation of average accumulated expenses, or simply average expenses. For example, in the first phase, it is given to you that on 1/4/2028, on 1/4/2028, our entity has spent actually 2 lakh rupees. It is given to you. You have spent 2 lakh rupees. Is it clear to you? Now, if I want to compute the average expenditure, indirectly it means I will divide it by 12. If I am dividing it by 12, that means it is giving me an average per month. That means per month expenditure is this much. You can say so. If I am going to divide 2 lakh by 12, that means that whatever the figure I am getting is actually per month figure. And because this expenditure was done in the beginning till the end of the accounting year, that means for 12 months. So whatever monthly figure is there, I am going to multiply it by 12. Are you getting my point or not? Average accumulated expenditure, ultimately I am going to get 2 lakh, no doubt about that. And here I have written 2 lakh. Likewise, in the next phase, I spend the amount on 1st of July. On 1st of July, we spent actually 2,50,000. First of all, you need to average it. When you are averaging it, it is showing you the per month expenditure. Now you take into account the time period. The time period will become 9 months because on 1st of July, actually you have spent. So per month expenditure is this much. So on 9 months expenditure will be equal to this much. This is what we mean by average expenditure and so on. Similarly, 4,50,000 and you will divide it by 12, multiply it with 6, correct, as per the time period. And last amount 1,20,000 was spent on 1st of March. That means only for one month you have used it. So 10,000. This is how first of all you are going to compute the average expenditure. Another point you must have noticed actually, your expenditure on building on an average is coming to 6,22,500 in this particular accounting year. But problem is that if you have noticed very carefully, it was given in the question that your entity has raised a loan of only 1 lakh, a special loan of 1 lakh. A special loan means specific loan. And besides that, it was given in the question, this entity is having 2 general loans or non-specific loans. And the amount of general loans given to you were 5 lakh and 9 lakh. 5 lakh and 9 lakh. 5 lakh and 9 lakh. Isn't it or not? This is what given to you. Now, important point is that when you have computed the total average expenditure, the next question will arise, how could you spend 6,22,500 through your special loan? You cannot. That means in order to finance 6,22,500, quite obviously now we can actually conclude that in this particular case, our entity must have financed 6,22,500, 1 lakh through what we call a special loan, which I have written over here, and quite obviously the balance 5,22,500 must have been financed through what we call general loans. Are you getting my point or not? But problem, why there is a problem? Now we have analyzed that out of 6,22,500, 1 lakh must have been financed through specific loans, and balance 5,22,500 must have been financed through general loans. But the problem is that one general loan is carrying an interest of 11% and another general loan is carrying an interest of 13%. And it is not given actually whether 5,22,500 has been financed out of 9 lakh or 5 lakh. So total amount of general loan is actually 14 lakh. So this is the problem which I am going to face, that what interest I should allocate to 5,22,500. So in order to overcome this particular factor, to determine the interest, at what rate I should charge the interest on 5,22,500, I will have to compute the weighted average rate of interest. In order to compute the weighted average rate of interest with respect to non-specific loans, I will first of all write here non-specific loan or general loan, 5 lakh, and rate of interest is 11%. I will compute the amount of interest. Similarly, non-specific loan, I will compute the interest at 13%. So total interest is 1,72,000 and total of the general loan is 14 lakh. So basically I am taking the average, but I cannot take the simple average. I will have to take the weighted average. So 1,72,500 divided by 14 lakh will tell me the weighted average, that comes to 12.85%. That means now I can say that I have used 5,22,500 worth of general loan at an interest rate of 12.285%. And quite obviously 1 lakh, because rate of interest was given to us as 10%. Is it clear to you? So now I am in a position to capitalize. So now your next step is to know what amount of interest you are going to capitalize. In order to compute the same, first of all, you need to write here specific borrowings. Now you need to find out how much of amount of specific borrowings you have used. Quite obviously 1 lakh, and the rate of interest given over there is 10%. So 10,000 will become your interest. And out of general borrowings of total 14 lakh worth of general borrowings are there, but you have used only 5,22,500 in the context of construction of this particular asset, and you have computed the what we call weighted average rate of interest. And now you are going to actually apply this particular rate of interest on this amount. You are going to get 64,189. So that means the total interest which you are going to charge will be equal to 74,189. The question may ask you also to compute the total capitalization of the cost. Total capitalization of the cost, how we are going to compute it. First of all, I will have to find out the cost of the building. Now, in order to find out the cost of building, don't commit this mistake of telling this amount. This is your average expenditure. So in order to find out the cost of the building, you will have to actually add all these items. 2 lakh, 2 lakh 50, 4 lakh 50, and 1 lakh 20,000. This is exactly what I have done here. 2 lakh, 2 lakh 50,000, 4 lakh 50, and 1 lakh 20,000. So the total cost of the building is 10 lakh 20. And the amount of interest which we have capitalized, as I just told you, is equal to 74,189. So the total cost of the building which will appear in the books will be 10,94,189. Is it clear to you or not? So this is the point which you need to understand. Similar is the case study 7. Now here in this particular case study, it is given to you that Formations Limited began construction of a new plant on 1/4/2028 and obtained a special loan of 4 lakh to finance the construction of the plant. So in this case, you must have noticed that amount of a special loan is 4 lakh and the rate of interest on loan is 10% given to you. Similar to the last question, here also it is given that company made the expenditure in this manner. On 1/4/2028, company spent 5 lakh. On 1/8/2028, company spent another 12 lakh. On 1/1/2029, amount of expenditure is 2 lakh. Now you are being given that this company is also having one non-specific loan of rupees 23 lakh at an interest rate of 12%. Now this question is easier in comparison to the last one. Why? Because in this question there is only one non-specific loan. You have a specific loan and there is only one non-specific loan. There is only one. Your specific loan which you have taken is actually 4 lakh, which is given in the question, and your general loan or non-specific loan is 23 lakh. And rate of interest on a specific loan is given to you as 10%, and non-specific loan, because this time you are having only one general loan, so you need not require to compute the weighted average. In this case, there is no need. You can, if you are going to utilize some amount out of what we call general borrowings, then you are going to apply a rate of 12% to know the amount of capital expenditure. Is it clear to you? Now it is given that plant was completed on so and so date. So you have completed the plant on 31st of 3, 2029. So in this particular question, similar to the last one, first of all, what I am supposed to do, I need to actually find out the average expenditure, and how and why we find it. I have already told you, whatever amount you spent on 1/4/2028, 5 lakh, you will divide it by 12, multiply it by 12, you will get actually 5 lakh. 12 into 12 divided by 12 it is actually, and then 1/8/2028, 12 lakh, because you spend the amount on 1/8/2028, that means remaining period is 8 months, you will multiply it with 8 divided by 12 to get this particular figure, and so on. So after having accumulated the expenditure, average expenditure, which comes to 13,50,000, that means out of 13,50,000, I can say actually I must have utilized special financing, must have been done this way. 4 lakh worth of financing must have been done through a special loan or a specific loan. And whatever balance is there, if I am going to subtract 4 lakh from 13,50,000, I think it will be equal to 9,50,000. So 9,50,000 I must have utilized from general loan or non-specific loan. Is it clear to you or not? Clear? So in this case, I told you there is no need to compute the what we call general loan. Weighted average. So your weighted average will be 12% only. Now you can easily find out the amount of interest which you are going to capitalize. In order to capitalize the interest, first of all, because you have utilized 4 lakh out of a special loan, you will write a special loan 4 lakh into 10%, that comes to 40. And as I told you, your general borrowings amount is 9,50,000. Into 12%. Now their rate of interest 12% was given, no need to compute weighted average. So 1,14,000 will be the amount of what we call your interest. So ultimately this 40 plus 1,14,000 will show you the total capitalization 1,54,000. And now you will write the total capitalization. In order to do the total capitalization, simply write the total expenditure, not the average expenditure, 19 lakh. And the amount of interest which you have capitalized, which happens to be 1,54,000. And this will be your what we call answer. Is it clear to you? After this particular case, you can easily actually do this particular question. And this question is similar to the last question. You can easily do this particular question. Correct? Now, in this particular case, what I have to tell you, now the last topic which is remaining with respect to this particular question is exchange difference arising from foreign currency borrowings to the extent regarded as an adjustment to interest cost. I have already told you, although not much has been asked from this particular chapter, to be very honest with you, correct? Only I think once a question is struck in the examination, if we are going to take into account the last 3 or 4 attempt papers, correct? In 1 or 2 papers only we had the questions, but this particular topic I do not know why I have a feel actually this time a question could strike from. So that is the reason actually you need to pay a bit of attention towards this particular topic. And this particular topic I have already seen actually student fraternities sometimes skip a lot in the examination. I do not know why actually. This is not a dreaded one, but you must actually make it a part of your preparation. So we'll take up this particular question. Case study actually is, this is 7.1. When you will receive the note over there, it will be written as 7.1, not 34. 34 is the case study number of my regular course premium. As you know, in our regular course premium, we nearly cover 30-40 case studies almost in every standard. And in this particular case, 7.1, it is written to you, FTX Limited has taken a loan of US dollar on 1st of April 2021. On 1st of April 2021, loan amount has been taken. Now, this particular loan which the entity has raised on 1/4/2021 is in foreign currency. You must have noted by now. 1st of April 2021. Is it clear to you? Now, whatever is the amount of loan, I will write it that also, don't worry about that. This is the amount of loan in foreign currency, that is equal to 10,000. Further, it is given that rate of interest on this loan is actually 5% interest per annum. And now it is given that on 1st of April 2021, the exchange rate between the two currencies is equal to rupees 45 is equal to 40 is per US dollar. So that means $1 is equal to rupees 45 on this particular date as far as exchange rate is concerned. Now exchange rate at the end of the year is, now at the end of the year exchange rate $1 is equal to rupees 48. $1 is equal to rupees 48. No doubt our liability has increased and we have incurred a loss now, isn't it or not? Further, here it is written very importantly, the corresponding amount could have been borrowed by FDX Limited in local currency at an interest rate of 10% per annum on 1st of April 2021. Now question states that the loan which this particular entity has taken in foreign currency, actually this loan could have been raised by this particular entity in local currency also. This loan on this particular date 1/4/2021 could have been raised in local currency. Could have been raised in local currency. This is given to you in the question. However, in local currency, the rate of interest, the company would have had paid 11% if this particular loan would have been raised from the local currency, and perhaps that is the reason actually why this particular entity is seeking the loan in foreign currency, because rate of interest, as you can say, in local currency is higher. Is it clear to you? So under such situation, actually what we have to do, the first thing is that you need to find out the loss which you have incurred in what we call this foreign currency borrowings. So you must have noticed actually you raised a loan of 10,000. So initially your recording will be 10,000 into 45, that is equal to 4,50,000. That means you are going to actually record the foreign liability at 4,50,000. The loan which you have raised in foreign currency, so it's a foreign liability, and foreign liability is a monetary item. At the end of the year, you are going to record the foreign liability at $10,000 into 48, that comes to actually 4,80,000. So 4,50,000 minus 4,50,000, that means your liability has gone up by 30,000. Or you can directly compute the amount of loss this way, $10,000, because by the end of the year, the rupee has devalued by 3, so quite obviously your liability will increase by 30,000. So that indirectly it means there is a loss to you, that is profit and loss account. This loss logically should be debited to profit and loss account, as we have already seen the what we call treatments under this particular, under what we call AS21. Now loss due to foreign exchange difference, as I have written also over here, that is equal to 30,000. Is it clear to you? Now, next thing which you need to take care of is, now you need to compute the interest on foreign currency borrowing. Now, how to compute the interest on foreign currency borrowings? This is the important point. When you are going to compute the interest on foreign currency borrowings, it is of pertinent importance that you are going to take into account the total amount of foreign liability at the end of the year. Now, at the end of the year, your foreign liability will be equal to $10,000 into 3, into what we call 48, $10,000 into 48. So, if I am going to compute the interest on foreign currency borrowing, it will come to $10,000 into 48. Kindly, for God's sake, do not write initial rate. You will use the closing rate. And now you will charge the interest at 5%. So, your total interest on foreign currency borrowings will amount to actually rupees 24,000. Is it clear to you? Now the next thing is that which you have to actually do the calculation, you will have to do a notional calculation through your imagination. What will be your imagination? That if you would have had raised this particular loan from the local currency, suppose if I would have had raised the loan from the local currency, how much loan I would have had raised? I raised a loan in foreign currency to the extent of $10,000. And on that date, the amount actually given to us is 45, I think, isn't it or not? So 45, that means if I will convert this loan into Indian currency, that comes to rupees 4,50,000. That means if 4,50,000 worth of loan I would have raised in Indian currency or the local currency, the amount of loan would have been 4,50,000. And on that particular loan, I would have had paid interest at the rate of 11%. So this is how you are going to do a notional calculation. In order to do the notional calculations, you are going to write your interest that would have resulted if the loan was taken in Indian currency. If your entity would have taken the loan in Indian currency, then the amount of loan would have been 4,50,000. Correct? And then see here, in order to compute the amount of loan, I have taken the what we call original exchange rate. Is it clear to you? And on that particular loan, you are going to compute the interest. Your interest in that particular case would have been 49,500. That means if I would have taken the loan in Indian currency or the local currency, the interest would have been equal to 49,500. But by taking the loan from the foreign currency, I am paying an interest of 24,000. Now I will find out the difference between these two interests. The interest will come to 25,500. And obviously this will be known as excess of interest on local borrowings over what we call interest on foreign currency borrowings. Once you have computed this particular interest, now there is a foreign exchange loss of 30,000. Now we know that if there is a foreign currency loss due to loan raised in foreign currency, and since loan is meant for construction of the asset, logically this loss should have been debited to the asset account. Obviously, because it is also a sort of cost. I have already told you borrowing costs are generally capitalized. So logically this entire 30,000 should be capitalized, logically. But standard says that if the loan has been raised in foreign currency, in that particular case, only to the extent, see here, however, only to the extent of excess of interest on local borrowings over interest on foreign currency borrowings, which we computed, that is equal to 25,500. Only this much of interest can be capitalized. Is it clear to you or not? That means out of total 30,000 worth, which logically or as a rule should have been capitalized, but because the loan has been raised in foreign currency, now here there is some restriction. Out of this 30,000 loss, I can capitalize only excess of interest on local currency borrowings over the interest on foreign currency borrowings, and the rest of the interest, 4,500, will be treated as normal business expenditure. Is it clear to you or not? Is it clear to you? So this is all you have as far as this particular standard. These are the points which you need to take care of, and I have actually included some questions from your MTP which you can easily manage, because this question we have already done. Is it clear to you? So this is all as far as this particular Ind AS 23 is. This particular session, that is Ind AS 36, it deals with impairment losses. I need not require to tell you, because a similar sort of standard you have already done in your earlier phases of education. If you remember, AS 28 and both these standard have tremendous what we call similarity, no doubt about that. And you are also well aware of the crux of this particular standard. You know exactly what is the theme of this particular standard. That is, actually at no point of time an entity should reflect, especially the non-current asset, at a value actually which exceeds the recoverable amount. That is the what we call entire crux of this particular standard. That means if you are reflecting an item which happens to be more than the recoverable amount, in that particular case, indirectly it is perceived or it is construed as if actually you are exaggerating your financial statement. So that is important, that at no point of time the carrying amount should exceed the what we call recoverable amount. That is the entire crux of this particular standard. So ultimately it leads us to the fact that in order to comprehend the intricacies of this particular standard, we need to be very well aware of what we call carrying amount. Now suppose the carrying amount of a particular asset in the balance sheet is 100 and the recoverable amount is actually 90, then standard is not going to allow you to reflect this particular item at 100. That means this particular item must be brought down to the recoverable amount. Indirectly, in order to bring this amount to the recoverable amount, we will have to actually consider rupees 10 as the impairment loss, and this impairment loss, how it will be dealt, that is the what we call theme of this particular standard. Is it clear to you? So by now you are well aware of this particular fact that under this particular standard, basically we are going to discuss carrying amount and recoverable amount. These are the two vital pillars around which actually the entire gamut, entire what we call storyline of this particular standard actually runs around. Now as far as impairment loss is concerned, impairment loss will take place only if you have written what we call a particular item, or you are carrying it at a value which is exceeding the recoverable amount. So in order to actually better understand the standard, we need to first of all equip ourselves what exactly the recoverable amount. Even in the last session we had a bit of discussion with respect to recoverable amount. Recoverable amount is generally the higher figure between what we call value in use and fair value less cost of disposal. Fair value less cost of disposal. value in use and fair value less cost of disposal, we are going to pick up the higher value. Then we are going to compare the carrying amount and the recoverable value. If carrying amount is more than the recoverable value, then we say that there is an impairment loss. What exactly the value in use? In order to compute the value in use, first of all, I will have to take into account what we call remaining life of the asset. Once remaining life of the asset is found out, then it will be easier for me to find out the value in use. Is it clear to you or not? So first of all, I will take into account the remaining life of the asset. Let us say remaining life of the asset is 3 years. So I will take into account the benefits which this particular asset could actually fetch to us. Then we will take into account the present value. So that means in order to find out the what we call value in use, we will simply take into account the cash inflows from the remaining life, and then we are going to simply take the present value of those inflows to find out the value in use. And fair value less cost of disposal, in simple words, means net sale value. In simple words, it means net sale value. That means at what amount it can be sold out, and in order to sell it out, we may have to incur some expenses. Those expenses will have to be subtracted to find out the net sale value. So this is the entire crux of this particular standard. Now coming over to what we have discussed so far in this short discussion, let's have a look over this particular case scenario which has been picked from what we call your December 24 examination. Now in this question, it is given to you that Earth Limited purchased an equipment for rupees 51 lakh on 1st of April 2013. Now in the examination, it is of paramount importance that when you read the question, actually you keep on asking yourself questions. For example, the moment you went through this particular line, immediately it should strike to you that which exactly is the date, which is the beginning one, that is 1st of April 2023. Now what is the cost of this particular asset, which is written over here as 51 lakhs. So this is the way to actually go around in the examination. Further, it is given in the question that the useful life of the equipment is 5 years and the residual value is estimated to be 1 lakh. So quite obviously now you are in a position to find out the depreciation cost is 51 lakh, residual value is 1 lakh, and life of the asset is 5. So that means your depreciation per year will be equal to 10 lakh, and further in the question it is given company adopts a straight line method of depreciation. Further, it is given that on 31st of March 2024, a test for impairment was conducted after obtaining the following information. And the information which you obtained is related to fair value less cost of sale, that is equal to 36 lakh. It is directly given, and value in use is also given to you as 32 lakh. That means when you are going to reach the end of the accounting year, that is on 31st of 3 2023, you let 31st of 3 2024. Logically, as an accountant, what you should do, first of all, obviously I will have to provide the depreciation. Now cost of the asset, as we know, is 51 lakh. In the heat of the examination, sometimes student directly write 50 lakh. 50 lakh is not the cost. This is the depreciable amount in the jargon of the accounts. Is it clear to you? Your cost is 51 lakh. And since you have already computed that your depreciation on a straight line basis is 10 lakh, that means the carrying amount at the end of the year is 41 lakh. This will be considered as your carrying amount. Now, once you have computed the carrying amount, as I told you, and moreover, it is given in the question that at the end of the year, you did an impairment test whereby you found that recoverable amount. Now, recoverable amount, I told you, is higher figure between value in use, and value in use is given to you as 32 lakh in this particular question, and fair value less cost of disposal. Fair value less cost of disposal in this particular question is 36 lakh. We have to pick the higher figure. Higher figure is 36 lakh. But importantly, your recoverable amount is lesser than what we call carrying amount, or carrying amount is higher than recoverable amount, you can say so. So there is an impairment loss of rupees 5 lakh. Now logically, impairment loss must be written off to profit and loss account. That means our entry will be profit and loss account debit to impairment loss account. Is it clear to you or not? This is the point which you need to understand. Now, we pick up another case scenario, and it's a pretty strong case scenario. It has been picked up from December 23 examination. Now, here it is written, Coel Limited acquired a machine on 1st of April 2017. Which is the date on which actually you have acquired the machine. So on 1st of April 2017, we have acquired the machine. Now, could you tell me what is the cost of the machine? That is 14 crores. So cost of the machine is actually 14 crores. So I'm going to write here 14 crores. Further, it is given that useful life of the machine is 7 years. Now, if useful life of the machine is 7 years, in order to find out the depreciation, I will have to divide it by 7, obviously. Also, it is given that machine is actually depreciated on a straight line basis and does not carry any residual value. It is also given in the question that there is no residual value. So now you can find out and concretely say and conclude that your depreciation per year will be equal to 2 lakh. Now, when you are going to reach the end of the year, that is your first year, on 31st of 3/2018, what will be the carrying amount is suppose I am going to ask you, because the cost of the asset is actually 14. So you are going to provide depreciation at the end of 31st of 3. So ultimately it leads us to the fact that carrying amount as on 31st of 3/2018 happens to be actually 12 lakh. Isn't it or not? Then likewise, I am going to reach the end of 31st of 3/2019. Again, I am going to provide a depreciation of 2 lakhs. So now the carrying amount will become 10 lakh. Finally, I am going to reach the end of 31st of 3/2020. And on this particular date, my carrying amount will be 10 minus 2. That will be equal to 8. 31st of 3/2020 or 1414. Actually, we have reached the end of 31st of 3/2020. Just wait. 31st of 3/2020. Now we are going to reach the end of 4th year, that is 31st of 3/2021. Again, I am going to provide the depreciation. Now, depreciation will be 2 lakh, so the carrying amount will be equal to 6 lakh. Now, the carrying amount is equal to 6 lakh. Now, 31st of 3/2021 or 1/4/2021 will be considered one and same date, isn't it or not? And it is given in the question now. It is given in the question that on 1st of April 2021, the carrying value, and you know the carrying value on this particular date is equal to 6 lakh. The carrying value of the machine was reassessed at 10.2 crore. There is a difference between revaluation analysis and what we call impairment testing, because it is the policy of the enterprise to keep on revaluing the what we call asset at a particular or a specific point of time. For that, they hire the services of actuary or the expert valuers. So, on 1st of April 2021, or you can say at the end of 31st of 3/2021, or in the beginning of the 5th year, 1/4/2021, they did what we call some revaluation. And they found actually the carrying amount, which happens to be 6 lakh, actually it is now estimated at 10.20. Now, because on this particular date, the carrying amount has been assessed at, it is known as revalued amount. So, revaluation was done and we found that the value actually is 10.20. Now, if value is 10.20, ultimately what will happen on this particular date, our revaluation reserve will get created to the extent of 4.20. So on this particular date, our revaluation reserve has also been created. Another important point is that when you are going to reach the end of the 5th year, now you will reach the end of the 5th year, that is on 31st of 3/2022. When you are going to reach the end of the 5th year, now if I am going to ask you, what will be the amount of depreciation which you are going to provide? So in order to find out the depreciation, now I will have to take into account the revised carrying amount. Now our revised carrying amount actually after the revaluation is actually 10.20. That is 6 was the carrying amount and we are going to add the upward revaluation reserve. Ultimately it will be equal to 10.20. So revised carrying amount is 10.20. That is what we call the revised value. Now, total life of the asset, as was given in the question, was 7 years. Out of 7 years, already 4 years have gone by. That means the remaining life is 3 years. So, in order to find out the depreciation, I will take into account the revised value. If there would have been any residual value in the question, I would have had subtracted the same, and I am going to divide it by the what we call remaining life. And remaining life actually is 3 years. Remaining life actually is 3 years. Is it clear to you or not? Remaining life is actually 3 years. So that means now we are in a position to find out the depreciation. If I am going to divide 10.20 by 3, it will be equal to 10.20 divided by 3, it comes to 3.40. So that means when I am going to reach the end of 31st of 3/2024, I'm going to provide a depreciation of 3.40. I'm going to provide a depreciation of 3.40. So what will be the carrying amount at the end of 31st of 3 2022? Because in the beginning of this particular accounting year, your carrying amount is 10.20, and now you are going to subtract 3.40. So that means on this particular date, on 31st of 3 2022, or at the end of the 5th year, you may say so, this is the end of the 5th year. So your value will be 10.20 minus 3.40. That comes to actually 6.8. That comes to 6.80. Similarly, now when you are going to reach the end of 31st of 3 2023, 31st of 3 2023, when you are going to reach the end of 31st of 3 2023, again you are going to charge a depreciation of 3.40, isn't it or not? So ultimately your value after subtracting 3.40 from 6.80, it will be equal to 3.40. But what exactly the question is asking? You need to take care of this particular aspect also. Now it is given in the question, for the year ended 31st of 3 2023, conditions indicating an impairment of the machine existed and the amount recoverable ascertained only to be 1.58. Now, we have already reached the end of 31st of 3 2023, and we have already found out the what we call carrying amount. Now, carrying amount actually is 3.40. Isn't it or not? Carrying amount is 3.40, because when we are going to reach the end of 31st of 3 2023, I am going to provide a depreciation. I will subtract it from 6.80. So I will be left up with this balance. Now, so this is the carrying amount. Now question says that at the end of 31st of March 2023, so there were some conditions there, or some indicators of impairment were there. So ultimately we did an impairment testing and we found actually recoverable amount happens to be 1.58. So on this particular date, your carrying amount is this much and recoverable amount happens to be 1.58. Recoverable amount is 1.58. That means there is an impairment loss to the extent of 1.28. Yes, right. 1.82 will be equal to your impairment loss. Now, in this particular case, you simply cannot write that entire impairment loss of what we call 1.82 will be written off to profit and loss account. Correct? This should not be your answer. Your answer should not be also this one, because some of you might feel actually, because I just told earlier, if there is a revaluation reserve, for example, in this particular case, actually there is a revaluation reserve existing because a revaluation took place, and on account of which revaluation reserve got created to the extent of 4.20. Obviously, there is some balance in revaluation reserve, and general rule is that if there is a revaluation reserve, then impairment loss must be set off first against the what we call revaluation reserve. So some of you might be tempted to actually write this particular answer that 1.82 should be written off to revaluation reserve, actually which is not incorrect. I'm not telling that it is incorrect, but in the light of the information of this particular question, it is incorrect. In the light, why it is incorrect? Because here, which I have written boldly, but in the examination it is not written in bold way. Here it is written, company had followed the policy of writing down the revaluation surplus by the increased charge of depreciation resulting from the revaluation. Because in this particular question, it is given that company is following a policy of writing down the revaluation reserve. That means they are going to reduce the revaluation reserve by the increased charge of depreciation. An increased charge of depreciation is always related to the revaluation, because if revaluation will take place, obviously, and especially if the revaluation is upward one, obviously company will have to provide more depreciation in comparison to the fact if the revaluation would not have had taken place. So on account of revaluation, depreciation charge also increases. So what this company's policy is, the policy of this particular company is that if on account of revaluation, depreciation reserve will increase, then increase in depreciation first of all will be set off against the revaluation reserve. That mean in this particular question, first of all, what I will have to do, because there is a balance in revaluation reserve, of 4.20. First of all, I need to know what is the increased amount of depreciation. Increased amount of depreciation. After computing the increased amount of depreciation, I will subtract it from the revaluation reserve. Now, whatever balance is there, this balance, against this balance, this impairment loss will be written off. If the balance is sufficient to absorb 1.82, fine. But if balance in revaluation reserve after what we call subtracting the increased amount of depreciation is not sufficient, in that case extra amount will be taken to profit or loss account. What my point is actually, just pay attention here. I have solved this question. I intentionally solved here also. I've already told you in this particular case, cost is 14 lakh, life is 7 years, depreciation is 2 years. Actually, I gave you a long analysis, but you can directly do. We know that cost is actually 14, correct? And from 1/4/2017 till 1/4/2021, there will be 4 years. So during these 4 years, total depreciation will be 2 into 4, 8. So 14 minus 8 will be equal to 6. So this is the carrying amount which we computed here also. That is on 1/4/2021, carrying amount is 6 lakh. Is it clear to you? Now on this date, asset was revalued at 10.20 on account of which revaluation reserve got created. Because revaluation reserve got created on this particular date, one thing is sure, our carrying amount will be considered as 10.20, number one. And now I will have to provide the revised depreciation. Out of 7 years, 4 years have gone by. In order to what we call compute the revised depreciation, you will take the revised carrying amount. The revised carrying amount is 10.20 and remaining life is 3 years. So per year depreciation will be equal to 3.4. So when you are going to provide depreciation at the end of 31/3/2022, your balance will be equal to 6.8. This is the carrying amount which we computed here. Is it clear to you? 6.80. Again, I am going to provide the depreciation at the end of now 31/3/2023. At the end of 31/3/2023, this is 23. Now the carrying amount will become equal to 3.4. This is exactly what we computed here. And on this particular date, it is stated in the question that there are some indications with respect to impairment. So entity actually did the impairment testing. And when we did the impairment testing, we found that recoverable amount is lesser than the carrying amount. So quite obviously, there is an impairment loss to the extent of 1.82. So far, it is not a big problem to comprehend the question. Now, the basic point here in this particular question is what should be the treatment of actually impairment loss. And here I have written here, impairment loss shall be set off against revaluation reserve to the extent of balance remaining in revaluation reserve after subtracting increased charge of depreciation. Time and again I'm telling you, the general rule is that actually if there is a balance in revaluation reserve, then impairment loss must first be written off against revaluation reserve. And if impairment loss is more than the revaluation reserve, then balance remaining will be set off against the profit or loss account. Generally, this is not incorrect. But in the light of this information, because the information is given in this question that this company is having a policy, first of all, to reduce the revaluation reserve by the increased amount of depreciation charge. So I need to know actually how to compute the increased amount of depreciation charge. See here, I have shown you here. You must have noticed that our depreciation under normal circumstances would have been equal to 2 lakh. In the first 4 years, we charged a depreciation at the rate of rupees 2 lakh. But because of the revaluation, at the end of 31/3/2022, we charged a depreciation of 2. And that means in the 5th year and in the 6th year, we also charged a depreciation of rupees 2. We charged a depreciation of 3.4 and 3.4, 3.4 and 3.4 because of revaluation, because depreciation got changed. However, if no revaluation would have had taken place, then in the 5th year, my depreciation amount would have been 2 lakh and 2 lakh. Indirectly, it means due to revaluation, each year my depreciation charge is increasing by 1.4. Is it clear to you? So total increase, because after the 4th year, 2 more years have gone by, and on which date the impairment testing is being done. So in the next 2 years, total additional depreciation charged is 2.80. Now we can say so. Is it clear to you? So what will be the treatment in this particular question? Now you should be able to understand. Total balance in revaluation reserve happens to be 4.20, and additional depreciation or increase in depreciation on account of revaluation is 2.8, and as per the policy of this particular company, first of all we are going to subtract this increased depreciation from the revaluation reserve. After subtracting, actually there is a balance of now only 1.40 in revaluation reserve. So, and total impairment loss is 1.82. So out of 1.82 lakhs of impairment loss, 1.40 will be debited to revaluation reserve and balance 0.42 will be taken to profit or loss account. This is the correct treatment in this particular question in the light of the information. However, let me also tell you, if this particular line would not have been given over here, in that case, my particular answer would have been this one, that entire impairment loss would be set off against revaluation reserve, because revaluation reserve is sufficient. If this line would not have been given over there, because of that particular information, we had to adopt this particular approach in this particular question. Is it clear to you? Interesting question, I told you, and very important, because most of us only actually go for the simpler things in life, and few people forget that when you go a little bit extra yard, that becomes the difference between success and failure. Anyway, case scenario 3 we pick up now. It relates to MTP set 1 June 23, correct? This question is from MTP. Details for an asset are as under. Now again some details are given to you, and cost of the asset happens to be 60 lakh and useful life period is 10 years. What is the cost of the asset? 60 lakh. Useful life is 10 years and salvage value is rupees 4 lakhs. So I sincerely hope by now the thing should be absolutely clear, and useful remaining life is 3 years. Indirectly it means, first of all, you must understand total useful life is 10 years, and question is specifically mentioned that remaining useful life is 3 years. So what period has expired so far? Actually 7 years have gone by, it means, isn't it or not? But question says that upward revision done in the last year. Now in order to confuse you, out of 10 years, first question says that remaining useful life is 3 years. Because question is stated that remaining useful life is 3 years, so it led us to the conclusion that 7 years have gone by. But now question says that indirectly it means we are at the end of the 7th year. Indirectly it means. Now question says upward revision done in the last year. That means at the end of the 6th year upward revision was done. Are you getting my point or not? So you have to analyze the question this way around. So that means at the end of the 6th year, so there is some revaluation was done, and as per the revaluation done in last year by upward revision means the value moved up by 50%. Further in the question it is given current value in use is actually 12 lakh. Current value in use means at the end of the 7th year. Current value in use is 12 lakh, current selling price is 11 lakh, current disposal cost is 1 lakh, and impairment loss to be charged to profit and loss account as per applicable Ind AS would be. Now there are some multiple alternatives given to you. All these are multiple alternatives given to you. This question was from MCQ. In order to understand this particular question, let's have a look first of all, because so far in the question it is given to you that carrying amount in the beginning of the 7th year. In the beginning of the 7th year also means at the end of the 6th year. Why we are picking up at the end of the 6th year instead of 7th year? Because at the end of the 6th year some revaluation has taken place. So in order to find out the upward rise, I need to know the carrying amount at the end of the 6th year or in the beginning of the 7th year, whatever you may like to say. 60 is our cost, and it is given in the question 4 is your residual value. So depreciable amount will be 56, and total life of the asset is 10 years, and I want to compute depreciation for the first 6 years. So this is how I am going to compute the depreciation. Once you have computed the depreciation for the 6th year, you subtract it from 60, you will get this value. This signifies the carrying amount at the end of the 6th year. At the end of the 6th year, an upward revaluation took place to the extent of 50%. That means whatever your carrying amount, that it was upvalued by 50%. So 26.40 into 50% will give you 13.20. So indirectly in the beginning of the 7th year, or at the end of the 6th year, you may say so, your carrying amount now is actually 39.60. But don't forget, now there is a revaluation reserve to the extent of 13.20 also, isn't it? Now, because the value has gone up, now when I am going to provide the depreciation at the end of the 7th year, at the end of this, because we are already in the beginning of the 7th year or at the end of the 6th year. Now I will reach the end of the 7th year, but at the end of the 7th year I will have to recompute the depreciation. And so many times I have told you, in order to compute the revised depreciation, we take into account the revised carrying amount, that is 39.60, and don't let it skip out of your memory. Even while computing what we call revised depreciation, the scrap residual value or the scrap value will also be considered. And remaining life is 4 years. Why remaining life is 4 years? Because we are at the end of the 6th year. Don't let it skip out of your memory. We are at the end of the 6th year or in the beginning of the 7th year, one and same thing. So that means the remaining life is 4 years. So that means in the next 4 years, per year depreciation will be equal to 8.90. Are you getting my point or not? That means in the 6th year, I am providing a depreciation. of what we call 8.90. I'm just asking you. Your earlier per year depreciation was how much? 60 was your original cost and 4 was the scrap value, and original life is 10 years. So initially that means you were providing depreciation at the rate of 5.60. Just to make you understand better, I have written here that if revaluation wouldn't have taken place in this year, that means at the end of the what we call 7th year, you would have had provided depreciation 5.60 instead of 8.90. If no revaluation would have taken place, obviously you would have continued with your old policy of depreciation. In that case, depreciation amount would have been 5.60. And just to make the point, just to understand it better, what we did in the last question, correct? Now, carrying amount in the beginning of the 8th year, because we have reached the end of the 7th year, correct? So obviously at the end of the 7th year or the beginning of the 8th year, the carrying amount 39.60 minus 8.90 is 30.70. No doubt this carrying amount is inclusive of revaluation reserve. Generally we write it this way, including revaluation reserve of 13.20. This carrying amount is inclusive of revaluation reserve without any doubt. Similarly, now question further states that current value in use is 12 lakh. Now here it is given current recoverable amount, because we have already reached the end of the 7th year. At the end of the 7th year, this is your current year. At the end of the 7th year, you call it at the end of the 7th year, or you call it beginning of the 8th year. So whatever information is given to you, that is at the end of the 7th year. At the end of the 7th year, you have computed, or in the beginning of the 8th year, you can write that way. Your carrying amount is 30.70, but some more information is given to you. So now you will have to compute your recoverable amount, and recoverable amount is higher figure between net selling price or value in use, so which is 12 lakh in this particular case, because you were given current value in use is 12 lakh and current selling price is 11 lakh. So 12 lakh is higher figure, your recoverable amount will be equal to 12 lakh. So from 30.70, you are going to subtract 12 lakh and your impairment loss will be 18.70. Now in this question, it was not given, similar to the last question, that company has a policy of reducing the revaluation reserve by the increased amount of depreciation. In this question, it is not given. So that is why in this particular question, you will simply write impairment loss will be charged to revaluation reserve. That means out of 18.70, you are going to charge 13.20 of what we call your impairment loss to the revaluation reserve, and the remaining impairment loss will be charged to profit and loss account. I hope you got the difference between the last question and this question. Suppose if in this particular question, same sort of line would have been written over here. Similar to the last question, if same line would have been written over here. So first of all, from the revaluation reserve of 13.20, I would have had subtracted increased depreciation. Increased depreciation. How much increased depreciation? Increased depreciation would have been the difference between these two. After subtracting that increased depreciation, whatever balance in revaluation reserve is there, that balance now will be utilized for writing of impairment loss. That means whatever your impairment loss is there, first of all, to the extent of this balance, you will write it off against the revaluation reserve, and any remaining balance will be written off against profit and loss account. correct? But anyway, in this particular question, it is not given. So that is why straight away you can say that whatever your impairment loss is there, first of all, it will be utilized against the revaluation reserve. That means out of 18.70, 13.20 worth of loss will be set off against the revaluation reserve, and remaining impairment loss of 5.50 will be set off against the profit and loss account. So this is the point which you need to understand in this particular question. Now we go for another important aspect of this particular standard, that is related to cash generating unit. Now as far as this particular part is concerned, cash generating unit. Now first of all, you need to understand a wee bit regarding what we call cash generating unit. Suppose this is an organization, and this particular organization is segregated into, let us say, several departments, correct? And in one of the department, there are, let us say, 3 types of asset, and they are very similar to each other, and they are interdependent upon each other for better understanding. Then they can be clubbed together as one single cash generating unit. That means in order to generate the cash or the inflows, the importance of three assets are almost equal. That means we cannot segregate that which item is actually contributing more to the inflows. So we can say that this is a cash generating unit. In the same department, let us say there are 3 more assets or 2 more assets, and they are of similar nature. So that can be treated as that means in the same department there can be several cash generating units. So in simple words, cash generating unit you can say is the collection of what we call assets. Is it clear to you? Or a group of assets for better understanding. Now, sometime what happens, suppose there is a cash generating unit, and in this particular cash generating unit, we presume that there are 3 assets, correct? And sometime it becomes very difficult to know the what we call impairment. We know that there are some indicators of impairment, but at the same time we are not in a position that to compute the recoverable amount of a particular asset, because all these 3 assets are interdependent upon each other. So sometimes it becomes a little bit tedious to compute the recoverable amount of a specific asset. So when it becomes difficult, then what we do in order to compute the impairment loss, we compute the impairment loss of the whole cash generating unit. This is the point which you need to understand. And once you have understood that, now we are in a position to pick up the question. Now we will pick up case scenario 4. Now in this case scenario 4, it is written that K21 Limited is a cash generating unit, and which is having around 100 assets. There are 100 assets with carrying amount of 100 lakhs. That means the total carrying amount of the cash generating unit actually is 100 lakh. 100 lakh is not the carrying amount of one single asset. This 100 lakh is the carrying amount of all the 100 assets. Now further it is stated in the question, and includes rupees 20 lakh worth of goodwill also. And includes 20 lakh worth of goodwill also. It means in this cash generating unit, first of all, you need to understand the question. In this particular cash generating unit, where total carrying amount is given to us as 100 lakh, first of all, it is given total carrying amount is 100 lakh. But further it is given that in this cash generating unit, there are 100 assets, and there is goodwill also, and and carrying amount of goodwill is 20 lakh. So that means the carrying amount of other assets must be equal to 80 lakh, because it is stated that carrying amount is 100 lakhs and it includes the what we call 20 lakhs for allocated goodwill. Further, in this particular question, it is also given in the current year, one of the individual asset is broken down, and one of the individual asset has broken down, and its carrying amount as on 31st of 3, 2027 is 5 lakh. One of the asset has broken down. Out of this, in this cash generating unit, there are 100 asset, and out of 100 asset, one particular asset now has suffered some breakage. Correct? So that's the reason we may say now this particular asset is impaired. This particular asset is now impaired. It can be safely presumed that this particular asset, because it has broken down, so it must be impaired now. And further it is given, its carrying amount is 5 lakh. And you are being given the carrying amount of this particular asset as 5 lakh. It is also given, and further it is also given fair value less cost of disposal is equal to 20,000. It is also given. Although value in use is not given, perhaps value in use must be equal to 0, because this particular asset has been broken down now. So that is the reason its fair value less cost of disposal is not given. Correct? Now you are being given recoverable amount of CGU is 94 lakh. Now carrying amount is 100 lakh, but recoverable amount of the cash generating unit is also given. Now in this particular question, what is happening actually? There is cash generating unit. In the cash generating unit, we can see there is goodwill and there are 100 assets. But one of the asset has broken down. So whenever it will be given in such a manner that there are so many assets in a cash generating unit and one of the asset has suffered impairment loss. So first of all, in order to compute the impairment loss of the entire CGU, because ultimately we will have to compute the entire what we call impairment loss of the CGU. But before that, we need to actually take into account the impairment loss of that particular asset. In order to find out the impairment loss of that particular asset, here I have written individual asset. Now the carrying amount, as I wrote earlier, is 5 lakh. Recoverable amount is 20,000, because in this particular question, no value in use is given. So the higher figure between these two obviously will be 20,000. So impairment loss, now we have computed the impairment loss of this particular asset. Now once we have computed the impairment loss of this particular asset, we knew that this cash generating unit is having a carrying amount of 100 lakh, out of which goodwill is 20 lakh. But as far as other assets are concerned, they are 80 lakh, no doubt. But out of 100 asset, one asset has suffered impairment loss to the extent of 480, as we computed earlier. So that is why now we can say the carrying amount of other assets, that means besides goodwill, carrying amount of the asset in the CGU now is equal to 75 lakh 20,000. So it means now the entire carrying amount of the cash generating unit can be recalculated. Goodwill will be equal to 20 lakh. And other assets will be equal to 75 lakh 20,000. So 95 lakh 20,000 will become the carrying amount of the entire CGU. Now in this question, as I told you, entire carrying amount of the CGU is also given to you. Now you will compare this carrying amount with the recoverable amount. So now we can say that impairment loss of 1,20,000 has taken place. Now in this cash generating unit, there is total impairment loss of 1,20,000. There is total impairment loss of 1,20,000. Now point is that how it will be treated. Standard says that first of all, impairment loss must be utilized against the goodwill. Because in this case, amount of goodwill given to you is 20 lakh. So this entire loss of 1,20,000 will be set off against the goodwill. Is it clear to you or not? So ultimately, in the cash generating unit, we may say that cash generating unit is goodwill is now 18.20 and other assets will remain at 75 lakh 20,000. 75 lakh 20,000. Is it clear to you? This is the point which you need to understand. Case scenario 5, here it is written there is an entity by the name of K22. It is a cash generating unit. Cash generating unit, K22 has a cash generating unit and the name of the cash generating unit is Plant A. Having a carrying amount of 1,000 lakhs as on 1/4/2028, this particular cash generating unit, correct, by the name of Plant A is having a carrying amount of 1,000 lakhs. Plant A was acquired under business combination and goodwill of 200 was allocated to it. That means in this particular cash generating unit, there is some allocated amount of goodwill. In fact, to be very honest with you, wherever there is allocated goodwill in a cash generating unit, then only the problem arises. Not exactly the problem. Then only we say actually treatment of impairment loss is such that first of all, it will be adjusted against the goodwill and then against the remaining assets of the cash generating unit. It is also written that it is depreciated on SLM basis. It means the entity depreciates on SLM basis. Useful life of plant is 10 years with nil revised value. Now, in this cash generating unit, there is Plant A. An entity has a policy of depreciating the asset, correct, on a straight line basis method, and the useful life is also given to you as 10 years with nil what we call revised value. Now it is also given that on 31st of 3/2029, Plant A has a recoverable amount of 600 lakh. Remember one thing, Plant A is nothing but entire cash generating unit. Calculate impairment loss of Plant A indirectly means calculate impairment loss of cash generating unit, because the name of the cash generating unit is Plant A. Also prescribe its allocation as per Ind AS 36. Actually, first of all, you need to find out the carrying amount of the cash generating unit, and the name of the cash generating unit is Plant A. In order to find out the carrying amount, you will have to actually first of all take into account the depreciation, because it is given that carrying amount is 1,000, correct, of plant A divided by 10. So depreciation per year will be equal to 100 lakhs, and the carrying amount of the asset, that means plant A, other than goodwill, because there is a goodwill also. So 1000 minus 100, that is equal to 900. Now you got the what we call value of plant A, and plant A is nothing but it means group of assets. Group of assets. Now their carrying amount is 900 lakh, and goodwill is already given to us as 200, because this time in the question it was not written that value 1000 is inclusive of goodwill, so we are keeping the goodwill separately. So 900 now is the what we call carrying amount of what we call other asset, and goodwill amount is 200. So we can say now the total carrying amount of the cash generating unit after writing off depreciation, plant A 900 lakh and goodwill 200 lakh, total carrying amount is equal to 1100 lakh, and the recoverable amount of plant A or the cash generating unit is given to us as 600, so impairment loss is 500. Now out of this 500, as I told you, first of all it will be utilized against the goodwill, because goodwill amount is 200, that means out of 500, 200 will be used against what we call writing of goodwill, and balance 300 of the impairment loss will be set off against the assets which are in the cash generating unit plant A. Correct? Is it clear to you? So this is how the treatment will be done in this particular question. Similarly, there is case scenario 6, and in this particular question you are being given there is an entity by the name of K23 and it acquired B Limited for rupees 600 crore. Further, it is written B Limited has 3 cash generating unit. We acquired an entity by the name of B Limited, and this B Limited is having 3 cash generating unit, and the name of the cash generating unit respectively are X, Y, and Z. Further, it is also written that K23 recognized a goodwill of 120 crores and allocated it to cash generating unit X, Y, and Z, but not individually. That means they allocated what we call 120 lakh to 3 cash generating unit, but not individually. Correct? Further, it is written for the accounting year ended 31st of 3, 2028, cash generating unit X suffered a substantial losses and recoverable amount is actually 200 crores. Now, in this question, you must have noticed actually there are 3 cash generating unit. It is a case of more than 1 cash generating unit. So, in this case, there are 3 cash generating unit. And further, it is given in this particular question that cash generating unit X has suffered some losses, and its recoverable amount is also given to you as actually 200 crores. 200 crores. Also, you are being given in the question carrying amount. Also given in the question carrying amount of respective cash generating unit. Carrying amount is 260 of cash generating unit X, of Y it is equal to 240 as you can see, and likewise of Z it happens to be 160, and finally the goodwill amount is given to you. Carrying amount of goodwill which is given to you is important, that is 24. So total amount is equal to 684. Is it clear? This is of cash generating unit. Recoverable amount of the group of cash generating unit including goodwill is 630. So that means group of cash generating unit is given to us. Their carrying amount is also available, and their and what we call recoverable amount is also available in this particular question. Further, it is also written that cash generating unit X is having only 2 assets. I have already told you cash generating unit is nothing but collection of assets. Now this cash generating unit X question here has got 2 assets with book values of what we call 160, and that is why its carrying value, as you can see, is 260 given in the question, because it is having 2 assets, asset 1 and asset 2, and their respective carrying value is also given. Now question says that calculate the impairment loss. Question says that compute the impairment loss to be recognized in the financial statement. Now, in order to find out the impairment loss, first of all, what I need to do in this particular question, because it is very specific in this, very clear in this particular question that cash generating unit X is impaired. So first of all, I will try to find out the impairment loss so that I can find out the carrying amount of X, correct? So there is a clear indication that cash generating unit X is impaired. So hence it should be tested first. So in order to test it, we take into account the carrying value of X, which happens to be 260. Its recoverable amount is also given as 240. So there is an impairment loss of 20. because this impairment loss is related to cash generating unit, correct? So loss of 20 crore shall be allocated between two assets of X in the ratio of 160. There is an impairment loss in this particular cash generating unit to the extent of 20. This 20 will be allocated to these two assets in their respective ratio of 100:16, correct? That is the point which you need to understand. Further it is given now, once you will adjust the what we call impairment loss, obviously now the carrying amount of cash generating unit X will come back to 240, because earlier it was 260, now impairment loss is 20, so its carrying amount is 240. So that means out of 3 cash generating unit, you have already computed what we call impairment loss in the context of a particular cash generating unit, because specific information was available. Now once you are done up with that, next step is to take into account the entire group of cash generating unit. Now if we take into account the entire group of cash generating unit, in this case, because there are more than one cash generating unit, first I will take into account the carrying amount. Now that especially you need to pay attention, carrying amount of X now is 240 and Y is given 240, Z is given 240, goodwill is also given. So total carrying amount is actually 664. And recoverable amount was given to us as 630, so impairment loss is 34. Now out of this impairment loss of 34, what exactly is the treatment? See here, I have already told you we have got 3 cash generating unit, X, Y and Z, and their respective carrying amount after taking into account the impairment loss of cash generating unit X. Carrying amount are given to us as 240, 240, 240 and 160. 240, 240 and 160 given to us, correct? Besides, there is goodwill also to the extent of 24 lakh. Now we have just computed that there is an impairment loss. There is an impairment loss of what we call 34. Now out of this 34, now 24 will be subtracted, adjusted against the goodwill without any doubt. Is it clear to you? Now remaining impairment loss is 10. This remaining impairment loss will be allocated to all the assets of the cash generating unit in their respective carrying amount. You cannot compute it, but you will have to write it that way. Is it clear to you? This remaining impairment loss out of 24 is set off against the goodwill. Now goodwill is no more. Now whatever remaining loss is there, impairment loss, this impairment loss will be allocated to the carrying amount of the assets, all the assets of all the cash generating unit, correct, in their carrying account ratio. So this is how you will have to write it. And then we are being given another question, case scenario 7. In this question, once again, here it is written, K24 Limited acquires another entity by the name of C Limited. Also this time given there are 3 cash generating unit, group of what we call cash generating unit is given. Difference between the last question and this one is that here we are being given net fair value less cost of sale is this much. So this time their fair value less cost of sales is also given. Also we are being given goodwill of 120 lakhs, and for the accounting year ended 31st/3/2029, similar to the last question, it is given cash generating unit X has suffered substantial losses and recoverable amount is determined at 240 lakh. Recoverable amount is determined at. Similar to the last question, in this question also carrying amount is also given, correct? Almost same question, but only difference is that this time fair values are also available. So first of all, in this particular question, whenever fair value will be given to you, your first task should be to allocate the goodwill on the basis of the fair value. This is of paramount importance because total goodwill is 24 lakh. Now, if fair values are given in the question, you will have to actually allocate it to the respective companies. Honestly speaking, we do not require to allocate it among all the cash generating unit because only cash generating unit X has suffered the damages, or we need to actually compute the impairment loss of cash generating unit because it is given cash generating unit X actually has suffered losses. So what will be the proportion of the goodwill which you are going to allocate to this particular cash generating unit, which we didn't do in the last question because in the last question fair value less cost of sale was not given. So at that time, in order to compute the impairment loss of cash generating unit X, we simply compared the what we call recoverable amount with the what we call carrying amount. But in this question, now what I am going to do, first of all, I am going to take into account the goodwill, which is 24 lakh, and then I will take the respective ratio of the fair value. All the fair values are given, total is 480, so 240 divided by 480, 12 lakh worth of goodwill will be allocated to X. So directly or indirectly, it means now you are going to consider carrying amount of X, which is given in the question as 260. Now you will add goodwill also. That mean as far as cash generating unit X is concerned, there are other asset worth rupees 260 and there is goodwill also now because you have allocated the goodwill. So, and recoverable amount 240 is given. So 272 minus this, that means total impairment loss is 32. As far as cash generating unit X is concerned, we are able to find out now that there is allocated goodwill which we allocated on the basis of fair value 12 lakh, and besides that there are other assets to the extent of 260. Now impairment loss of what we call 32 lakh has taken place. This 32 lakh, 12 lakh will be adjusted against the goodwill. Goodwill will become 0, and balance impairment loss 32 minus 12, now remaining is equal to 20. This 20 will be subtracted from the carrying value of the other assets. So that means value of other asset is 240. Indirectly, now we can say that carrying amount of X is equal to 240. Now, because its recoverable amount is 240 and now we have brought it to recoverable amount. Correct? So this is the point which you need to do in this particular question. So first of all, it shall be, because in this particular question, you are being asked what will be the treatment of impairment losses with respect to cash generating unit X. So I've already told you with respect to this. And now the last topic. This last topic is extremely tough and very few will teach you regarding corporate assets. And remember one thing, I have included one question from my side and one question from your MTP June 23. Correct? And I expect this year, this is pretty important question. This is pretty important question which may strike in the examination. So you need to take care of this particular fact that you shouldn't actually neglect this particular topic. It is very vital. Now, what we mean by corporate asset, it is not easy to grasp the what we call meaning of corporate asset. Remember one thing, corporate asset, as I told you, it's a pretty important topic. Under this, obviously, when there will be some corporate assets, then we will have to compute the what we call impairment loss, and calculation of impairment loss whenever there would be corporate asset is not what we call an easy task. So let's have a look over here. First of all, what we mean by corporate asset. Let us say there are two big assets, but they are not contributing directly to the production line of the organization. Correct? Let us say this particular asset is headquarter building. Headquarter building is also an asset. Similarly, there is another what we call department, let us say R&D department. So they are not contributing directly to the production line of the business, but their importance cannot be neglected. The point is this, their importance in running the entire organization cannot be neglected. So how to compute, and these will be termed as corporate assets. First of all, you need to understand, and how we are going to find out the impairment losses whenever there would be what we call a case of corporate assets. Let's have a look over this particular question to understand the intricacies which are associated with such a situation. K27 Incorporation has 3 cash generating units. It is given A, B and C. Further, it is given there are adverse changes in technological field in which the entity operates. Thus, the entity conducts impairment test of each of its cash generating unit. Actually, some technological changes have taken place, so it is an indication of impairment. Perhaps some impairment may take place. So on account of that, actually, this entity has decided to do an impairment test. At the end of 2021, it is given the carrying amount of cash generating unit A, B and C. So cash generating unit A, B and C are there, and their carrying amount is also given to you. The operations are conducted from headquarter. And the carrying amount of the head office asset is 200 lakhs that comprises of headquarter building 150 lakh and a research center of 50 lakh. So far in this particular question, what we are being given, actually there are 3 cash generating unit A, B and C. Further, there are some what we call corporate asset, because it is given in the question that operations are conducted from the headquarter And in this headquarter, there are two assets which is given to us. One is head office building. One is head office building. And its carrying amount is given to us as 150 lakhs. And there is a research center. There is a research center, and even its carrying amount is also given 50. So total of the corporate asset is 200 lakhs. Is it clear? Also now it is given in the question, and in most of the question wherein there will be a case of corporate assets, you will always be given such a hint. It is given that headquarter building devoted to the cash generating unit can be allocated in the ratio of 19:56:75. What does it mean? Actually, no doubt about that, they are corporate assets, correct? But they are contributing not directly but indirectly to the functionality of this entire organization. However, out of these two corporate assets, now it is given in the question that headquarter building can be allocated to respective cash generating unit. It is given in the question, and in most of the question, whenever there will be a case of cash generating unit, generally such information is given. Is it clear to you? So headquarter building, it can be allocated in the ratio of 19:56:75. So as per the benefits which these three cash generating unit might be deriving from head office, correct? Perhaps on that basis, this ratio is given to us. Whatever may be the reason, we are being given that in this ratio, it can be allocated. But regarding research center, it is not given how it can be allocated. That means research center cannot be allocated, but one of the what we call corporate asset can be allocated to respective cash generating unit. Further, in this particular question, it is given that carrying amount of research center, and moreover now it is given in the question that research center cannot be allocated. Value in use of cash generating unit. Now value in use of these respective cash generating unit is given to you, correct? 199, 164, 271. Value in use is given, but fair value less cost of sale is not given. So quite obviously that means indirectly this value in use is nothing but recoverable amount of cash generating unit. Further, it is also given recoverable amount of the entity as a whole, and this entity comprises of cash generating unit and headquarter, isn't it or not? And as a whole, this entity is commanding a recoverable value of 720. So first of all, what I need to do? Obviously, I need to find out the carrying amount of respective cash generating units after taking into account the impairment loss. Not only of cash generating unit, I need to find out the carrying amount after taking into account impairment loss, but also of corporate assets. Once I am done up with this, that means once I have computed the impairment loss and allocated the impairment loss to three cash generating unit and two what we call these assets, then I can find out the carrying amount of the entity. And once I will have the carrying amount of the entity, then I will be able to compare it with the what we call recoverable amount of the entity, which is given to us as 720. And that is how we shall be able to find out the impairment loss. But it is easier said than done. But let's have a look. It is not as easy. Let's have a look over here. First of all, in order to solve the question, quite obviously, you will have to prepare a chart like this, correct? Table like this. In fact, all the figures are in lakhs. First of all, what is given to you? Carrying amount. You write the carrying amount. It is given in the question. So carrying amount of three cash generating unit is given. Now, under such situation where corporate asset would be given, and it will also be, and it is also be given that one of the corporate asset is allocated. So first of all, your target is to take into account that corporate asset which can be allocated to the cash generating unit. So this is exactly what I have done here, plus corporate asset building, because it is given in the question that corporate asset building can be actually allocated in the ratio of 19:56:75. Remember one thing, value of building is 150. So out of this 150, 19 lakhs worth of building can be allocated to A, 56 lakh worth of building can be allocated to B, and 75, because it is given in the question that in this ratio we have decided. So if we are going to use this ratio to divide, to segregate what we call this 150, you will get 19 lakh, 56 lakh and 75 lakh. So once you have allocated the building, now you will get the total carrying amount of these three cash generating unit. Total carrying amount after the allocation is now this much. Quite obviously, now you have the carrying amount of cash generating unit after allocation of one of the corporate asset. Now you compare it with the recoverable amount. Now recoverable amount, as I told you, was given in the question of 3 cash generating unit, correct? So now we compared it, and now we find actually there is no impairment loss in case of cash generating unit because recoverable amount is more than the carrying amount. But in case of cash generating unit there is impairment loss to the extent of 42 because, as we can see, carrying amount given to us is 206, recoverable amount is 164, so there is a loss of 42, correct? Similarly, in case of cash generating unit C, we find that carrying amount 275 and recoverable amount is 271. So quite obviously in this particular case, we may say there is an impairment loss of 4. Total impairment loss happens to be 42 plus 4, 46. But another important point is also there. It is not enough. Next point is that now I will have to allocate the impairment loss. What I want to say actually, first try to understand. It is pretty tricky point actually. It is not easy. Actually, if I will talk about cash generating unit B, in this cash generating unit B actually we have already seen that originally the carrying amount was 50 and we allocated some portion of building to it. Some portion of building was allocated to it initially, isn't it or not? 150 plus 56, the total became actually 206. Is it clear to you? Now, we compared it with the carrying amount of cash generating unit, recoverable amount, the recoverable amount was 164. And that is why we are saying actually there is an impairment loss of 42 in it. There is an impairment loss of 42. But now I will have to allocate this impairment loss to this portion and to this portion, because in this cash generating unit, now one part is this one and one part is allocation of building. So that is why this 42 must be allocated to these two parts. How we are going to allocate it, that is another point. See here, and allocation is not a very tough task. You can see actually this way around. Here you can look, then you will be able to understand. Total impairment loss is 42 when total carrying amount 150 plus 56 is 206. So when total carrying amount is 206, impairment loss is equal to 42 and the allocation of building is 56. So you can simply find out what proportion of the impairment loss will be allocated to the building. So that is exactly what I have done over here. So out of 42, now I have allocated 12 lakh of loss to building, and balance 30, 42 minus 12 will be allocated to this one. So that means 150 minus 30 will become what we call 120, will be the value of this part, and building will be equal to 56 minus 12, that will be equal to 40. Is it clear to you or not? Is it clear? Similar is the situation here with respect to cash generating unit C. Now, if we will look into cash generating unit C, we find initially the carrying amount is actually 200, but we allocated some portion of the building to it. So some portion of the building you allocated to it also. So total carrying amount is 275 and you compared it with the recoverable amount. So there is a loss of 4 lakh. Now, out of this 4 lakh, some portion will be allocated to the building and some portion will be allocated to the other assets, correct, of the cash generating unit, what we call C. So in order to allocate, first of all, you find out this is impairment loss on total carrying amount of 275. So 4 divided by 275, correct? 4 divided by 275, and the allocated portion of the building is 75. So what proportion of impairment loss will be allocated to building? And if you will compute it, it comes to actually 1. That means out of total impairment loss of 4 lakh, 1 will be allocated to the building and 3 will be to the cash generating unit. Is it clear to you? Cash generating unit B. Because in cash generating unit, C, in cash generating unit C, we have included the building also. So to cash generating unit C, we will allocate 3 and 1 lakh will be allocated to the building. So this is the trickiest part of what we call this particular question. So after this, now we can say carrying amount of this particular entity, this particular cash generating unit A is 100, no problem with respect to this. But carrying amount of cash generating unit B will be considered as 120, as I told you here, 120, and allocated impairment loss 30, total is 120, and I have written also here 150 is the cash generating unit of B. This is 150. And the impairment loss was 42, but out of 42, 30 you allocated to B. So that is why 120. And similarly, with respect to entity C, now if you will see with respect to entity C, its carrying amount is 200 and impairment loss of 3 is allocated to this. So 197 will become the carrying amount. And total impairment loss allocated to building 12 and 1. 12 and 1. That is equal to 13 lakhs. So that means carrying amount of headquarter building will be equal to 150 minus 12 minus 1, that is equal to 137. So now after what we call this impairment loss, you have the total carrying amount of cash generating unit and headquarter asset. It means entity. Now in the entity there is cash generating unit A, its carrying amount is 100, B carrying amount is 120, C 197, headquarter building is there, now its carrying amount is 137, research center will stay at 50, and total now will become 604, and recoverable amount is more than the carrying amount. Technically there is no impairment loss. But if impairment loss would have been there, then same means the impairment loss would have been allocated in the ratio of all these things to all these assets. Is it clear to you or not? So that is how you are going to do this particular question. And similar is the question with MTP June 23. I have modified a bit. Cash scenarios 9, and this is the last scenario which we are going to face in today's this long session. And all these questions I have already done. The first question which I did is Earth Limited, as you remember. And we have also done Coel Limited, also I have re-included over here. And similarly, even this particular question, I'm doing it now for you. Even this particular question we have also done. So now we come over to the final question of today's this particular session. We have covered all the MTP question and the examination question now. Case scenario 9, MTP June term modified, XYZ Limited is an entity, and this time it is having two cash generating unit, P and Q. Further, here it is written carrying amount of cash generating unit P and Q are 3,000 and 1,000 lakhs respectively on 31st of 3, 2028. So far we have seen that in this particular case scenario, there are two cash generating unit with a carrying amount of 3,000 and 1,000. 3,000 and 1,000. It is given in the question. And further, it is given in the question that this company, that this particular entity is having an administrative building of 1,200 lakhs and research and developmental center of 900 lakhs. There are two corporate assets. Also, it is given administrative building out of these two corporate assets. Similar to the last question, one asset, administrative building, can be allocated in the ratio of 30:5. But R&D center cannot be allocated to the CGU. The first thing which you are going to do now is to allocate the what we call administrative building. So administrative building will be allocated, and it will be allocated in the ratio of 30:5. Amount is 1,200. So 1,200 you are going to allocate in the ratio of 30:5. When you are going to allocate it in the ratio of this, you will get this particular figure 1,200. 1,200. Is it clear to you? So ultimately, after the allocation, the carrying amount will become 4,000 and what we call 1,200. This is your carrying amount. Is it clear to you or not in this particular question? So after this carrying amount, as I have written over here, 4,000 and 1,200 after the what we call allocation. Now here it is written, due to spread of coronavirus and lockdown, impairment tests have been done on 31st of 3, 2028. Remaining useful life of P is 5 years and of Q it is 5 years. Now very interestingly, it is given as far as remaining life is concerned. First the question says that remaining life of P and Q. Remaining life of P is 10 years, remaining life of Q is 5 years. Also, it is given in the question fair value less cost of disposal is not realizable. That means fair value less cost of disposal is not available because these assets cannot be realized now. So whatever value in use will be there, you are going to consider it as your recoverable value. Future expected cash flow from cash generating unit are 600 lakhs for the next 5 years. Actually, the life of P is 10 years. Now, question says that in the next 5 years, this cash generating unit is going to bring inflow of 600 lakhs. In the next 5 years, this cash generating unit is going to bring you inflow of 600 lakh and again 300 lakhs in the next 5 years. In the first 5 years, because total remaining life is 10 years, in the first 10 years, it is going to fetch us a return of 600, while in the next, what we call 5 years, this entity is going to give us a return of 300 lakhs. And now further, it is also given in the question that as far as Q is concerned, then life of Q is only 5 years. In the first 5 years, it will give us a return of 350 lakh. Obviously, you are going to use it, as I told you initially, to find out value in use. With the help of this, you can find out the value in use, but you will have to find the present value. And to compute the present value, it is also given in the question. Future expected cash flow from XYZ Limited as a whole is 950 lakhs for first 5 years and 400 lakhs for the next 5 years. Now, in the last question, if you remember, the recoverable amount of the entire entity was given. Entity comprises of cash generating unit and headquarters. And even in this particular question, you are being given the recoverable amount of entity, but indirectly you are being given. Recoverable amount will be equal to what we call value in use. Because in this entity, there are two cash generating unit, and there are what we call corporate assets. Now, question says that as far as this entity is concerned, in the first 5 years, it is going to bring us a return of 950. And in the next 5 years, it is going to fetch us a return of 400. This is also given to you in this particular question. You are going to use this information to compute the present value so that recoverable amount can be found out. Clear? Further, now it is also given in the question that discount rate is 12% per annum. And you are being given annuity factor of 12% for first to 5 years is this, and for 6 to 10 years it is equal to this. So with the help of this annuity factor, you will be able to find out the present value. For example, if I am interested in finding the present value of 600, if I am interested in, all I will have to do is to multiply it with this particular annuity factor, 3.6048. And similarly, for the 6 to 10 year, the factor is this. I will have to multiply it with 2.0454. And similarly, if I want to find out the present value of Q, because Q has a remaining life of 5 years, so I will have to multiply it with 3.6048. So you can see we can find out the value in use or recoverable amount, correct, of P. We can also find out of Q, and we can also find out by applying the same methodology the recoverable amount of what we call entire entity. This is the question, and now it should not actually appear as a very tough task in this particular question. First of all, I have computed the recoverable amount so that it becomes easy. As far as recoverable amount of P is concerned, I told you, you will have to multiply 600 with this. This is exactly what I have done over here. Then you multiply 300 with this. This is exactly what I have done here. So that is how I will be able to find out the recoverable amount of P, which I will use later on to compute the what we call impairment loss of what we call this cash generating unit. Similarly, recoverable amount of Q, simply multiply 350 with this factor to get what we call recoverable amount. And finally, the recoverable amount of the entity can be found out. As I told you, we have to multiply 950 and 400 with the respective discount factor. So now we have the recoverable amount of the entity. The first thing first is that there are two cash generating unit P and Q, and it was given that headquarter administrative building can be allocated in the ratio of 30:5, as I told you. So allocation will be done. So out of 1,200, 1,000 will be allocated to building, 200 will be allocated to P. So now the scenario is like this. There are two cash generating unit P and Q, and their respective cash generating unit originally are 3,000 and 1,000, and after allocation of headquarter building, now their carrying amount becomes 4,000 and 1,200. Now we are going to compare their carrying amount with their recoverable amount, as we did even in the last question. So we find that these are the recoverable amount. Now in case of P, we find that carrying amount is more than the recoverable amount, so there is an impairment loss. However, in case of cash generating unit Q, there is no impairment loss simply because of the fact that carrying amount is lesser than the recoverable amount. Now, if you remember in the last question, the entire impairment loss, because we should not let it skip out of our memory, as far as P is concerned, it is a cash generating unit and we have allocated some portion of building to it. Some portion of building to it. Isn't it or not? Now, cash generating unit of P is 3000 and portion allocated is equal to 1000. And there is an impairment loss in case of P to the extent of 2776.50. Now this 2756.50, very clumsy figures are there, 277650. This is the total abnormal loss, the total impairment loss. This loss will be allocated to what we call cash generating unit and to what we call building, as we did in the last question. But how to compute it? In order to compute it, first of all, you need to understand that this is an impairment loss. This is an impairment loss on what we call this amount, total carrying amount of 4000, because you compared this amount, carrying amount, with the recoverable amount. So if I will take the proportion, it will be total loss proportion 1223.50 divided by total carrying amount, that is equal to 4000. This is the what we call proportion we have taken now. And now building figure is actually 1000. Amount of building is actually 1000. So amount of building is 1000. So ultimately whatever now you will get will show that this much of impairment loss should be actually subtracted from the headquarter. So this is exactly what I have done over here. In fact, I have allocated it to cash generating unit because the portion of cash generating unit is 3000 and building is 1000. So we find that out of 1223.50, 917.6250 is related to what we call cash generating unit and 305.875 is actually related to building. Is it clear to you or not? So this is the point which you need to understand. So ultimately what we find that revised carrying amount before R&D adjustment, obviously R&D cannot be adjusted at this moment. Now administrative building is 1200. Now we have allocated impairment loss. So the revised value of this will be equal to this much, and obviously the carrying value of P will be 3000 minus portion of the impairment loss 917.625, so 20825.375, and Q, there was no impairment loss, its carrying value will remain same. So now we can find out the carrying amount of the entire entity. In order to find out the what we call impairment loss of the entire entity, we need to have the carrying amount of cash generating unit P, Q, and administrative building and R&D. Now we have the carrying amount of P after the impairment loss 2082.375, and P is 1000, and building we just computed 894.125, here we computed, and R&D is 900. So this will deliver you total carrying amount, and we have already found out the recoverable amount of the entire entity earlier, which is equal to 4242.75. So ultimately your impairment loss will be equal to 633.78. So in this case, carrying amount is higher than the recoverable amount. Quite obviously there is impairment loss. Now how to allocate the impairment loss? Impairment loss will be allocated to all the assets which are there in the entity. Is it clear to you? You can write only this much. You need not require to show the calculation, but if you want to show, you can show it. So you will take their carrying amount ratio and you will allocate this among what we call all the assets. That will be P, Q, cash generating unit P, cash generating unit Q. Also there are what we call two corporate asset, building and R&D centers. And I have done the calculation. You can easily understand that if some of you are interested. I have already done this question. I have already done Coir Limited question. I have already done MTP set questions. So these are the things which are there in this particular strand. So on such count, we start this particular session that happens to be Ind AS 38, and as you can see flashing on your screens, it relates to intangible assets. And prior to this one, you have already done an existing accounting standard by the name of AS 26, and quite similarity between these two. AS 26 and Ind AS 38 both deal with intangible asset. I have already told you, great similarity between these two standards barring a few points. But anyway, let's come straight to the business end. As usual, this particular standard also provides some guideline with respect to recognition, measurement, and disclosure of intangible assets. Now, as far as scope of this particular asset is concerned, it will include all types of intangible assets, whether they happen to be what we call your patent, copyright, trademark, brands, softwares, techniques, technology, intellectual rights, etc. Is it clear to you? The first thing we should be aware of is this, that intangible asset has three chief characteristics. An item can be categorized as an intangible asset only if it has got three criteria. One, it should be identifiable. It should be identifiable. What we mean by that? It should be identifiable means it can be segregated from the other assets. This is the foremost what we call characteristic in order to be categorized as an intangible asset. So intangible asset is one which is identifiable. It means it can be segregated from the what we call other assets. Number two, generally, all the intangible assets are classified as non-monetary assets. Non-monetary assets. Many a time I have seen actually students do not know exactly the meaning of monetary items and non-monetary items. As far as monetary items are concerned, 90% items in the balance sheet which you write actually, they are basically monetary item. What we mean by monetary item? For example, suppose I have written cash, I have written debtors in the balance sheet. And let us say in front of debtors I have written 5 lakh. Now, more likely than not, chances are there that my entity is going to recover the same amount which I have written in my balance sheet. Obviously, some of you may counter me by saying that there could be what we call bad debts. But every day and every time, bad debts are not going to take place with regularity. You must understand this thing. I said actually more likely than not. That means probability is very high that I am going to recover the same amount. Any item which you put in your balance sheet, correct? And if you have reasonable certainty that you are going to get the same amount, that is classified as monetary item. Now, what we mean by non-monetary item? Non-monetary item. As far as non-monetary items are concerned, for example, I have written here property, plant and equipment. And let us say property, plant and equipment value I have written 50 lakhs. In the balance sheet I am carrying it at 50 lakh. But there is hardly any reasonable certainty that I am going to get 50 lakh against the same. So such items, similarly if you have written inventory, some value you have written over there. So chances are more likely than not actually you are not going to recover the same amount. So such items are categorized as non-monetary items. So similarly, intangible assets are also classified as non-monetary items. This is the point which you need to take care of. Coming over to the next and last one. Obviously, I need not require to tell you that all the intangible assets have no physical substance. They do not have any physical substance. So these are the three important characteristics. Is it clear to you? After having a look over all these things, you should also understand the next point is that with respect to measurement. Now coming over to the measurement, similar to the normal procedural aspect which we apply in case of what we call property, plant and equipment, all those steps are required with respect to recognition of intangible assets. Intangible assets are initially recognized at cost, and when we say cost, as you know, the meaning of cost basically means it comprises of purchase price plus any taxes and duties which you have paid, similarly any registration charges, brokerage cost or any professional fee which you have incurred, likewise if any legal fee you have incurred, similarly all such directly attributable expenses which your entity has incurred in bringing the asset to its present use, correct, and its present location. All those expenses, directly attributable expenses, will also be added back. But at the same time, if you have received any trade discount or for that instance any rebates, those will be subtracted while computing the cost. So this is how you are going to compute the cost of a particular item. While taking into account cost, you also be aware of one important aspect. Any professional fee which you have incurred, you must include that. Similarly, any cost of testing. Sometime in order to test, actually we use some material. It is also important to understand. For example, I am doing some testing. That means I want to know whether through application of this technology or techniques I will be able to what we could produce the products or not. So I use some material, let us say, to produce the product. Let us say material worth rupees 25,000 I use. Generally what happens while testing, when we use the material, some materials are scrapped and they are sold out for a scrap value. That means we are able to get some scrap for, let us say some materials were sold at a scrap, so my net material cost will be equal to 21,000. This net material cost you must take into account while computing the cost of the intangible asset. This is the point which you need to take care of. Coming over to the next area now, I told you these are the two costs wherein you need to actually take care of. But at the same time, if your entity has incurred any expense in promoting the intangible asset, any cost of promotional expenses like advertising, similarly any administrative and general overheads, and likewise if you have incurred any cost in conducting the business in a new location, such cost will not be included. Is it clear to you? Besides that, if there are initial operating losses, initial means in the initial stages, it could be a possibility that entity might actually incur some losses through application of this particular intangible assets, correct, through this production process. So initially, if you have incurred any operational losses, even those operational losses will not be taken into account while computing the cost of the intangible asset. So let's come straight to the point to understand actually whatever we have discussed so far in this short duration. Now, W9 Limited on 30th 11/2027 purchased a new software for Rs 6 lakh. But it is written that this 6 lakh includes 50,000 as non-refundable taxes. That means I have purchased or acquired a software wherein actually 5,50,000 is the actual price, because I have paid 50,000 as non-refundable taxes. That is why my purchase price is 6 lakh, and that is why I am saying actually it is inclusive of 50,000 as the non-refundable expense. Similarly, now further after acquiring this particular asset in the month of, let us say, October, now in November 2027, actually you incurred 1,20,000 further. Actually, this particular date is on 30th of October 2027, you acquired the asset. And in the month of November 2027, let us say actually you have incurred some expenses. And the expenses were 1,20,000. Now, total expenses which your entity has incurred is equal to 1,20,000. I just told you, any labor cost or any expense which your entity incurs in bringing the asset to its present location or use or for intended use, such expenses are considered as directly attributable expenses and must be made a part of the cost of the item. And similarly, further it is written that in December 2027, your entity actually hired some external instructors because you are going to operate this new software. So you need to actually train your staff, and for that you must have hired some external instructors to whom you paid actually 20,000 rupees, and further other training cost amounted to rupees 5,000. All these expenses, 25,000, will also be made part of the cost of the asset. Further, it is written that some modification were done in November 2027 and the cost incurred was. This is the point I was trying to tell you. Now, entity actually did some expenses, incurred some expenses in what we call testing, and they used material cost, and material cost is actually 24,000. But it is given that 3,000 recovered from the sale of scrap. So that means you are going to include only 21,000. 24 minus 3,000, that is 21,000 you are going to include. Is it clear to you? As your material cost, only 21,000 expense. Further, it is given professional fee also you have paid. I just told you professional fee and any amount which you spend while testing in material will be taken into account. So 21,000 and 11,000, that makes 32. So 32 will also be included. So this is how ultimately you are going to compute. Further, in this particular question, another line is given. However, due to low initial orders, initially entity incurred 23,000 as loss. Initially, I told you any initial operating losses will be ignored. So how much amount should be capitalized? So what will be the cost of this particular asset? The point is this. So purchase price, as I told you, actually is 5,50,000. So taxes and duties you have paid 50,000. Labor cost 1,20,000, 25,000. Trading expense 20 plus 5. And testing expense, as I told you, material cost 21 and plus 11,000 professional fee. 21 plus 11 is equal to 32. So total will be equal to 7,77,000. At this particular value, you are going to actually recognize the cost. Another important aspect which you need to take care of is that any internally generated goodwill or for that instance brand is never ever recognized as what we call intangible asset. Reason being is that internally generated goodwill and brand cannot be segregated or identified from the other asset because there is contribution of whole what we call entity and all the assets of the entity in the generation of what we call goodwill and brand. That is the reason actually internally generated goodwill and brand are never ever recognized as an intangible assets. Why? Because their separate identifiability, which is one of the prominent characteristics, as I told you earlier, cannot be established. So that is the reason. However, another important aspect of this particular chapter is this particular point, from where almost in every examination, if we are going to scan the last 3 attempts and even the MTPs, correct, even MTPs and last 3 attempts, almost every year there was a question from this particular topic, what this particular topic is all about. This particular topic deals with other internally generated asset. I told you internally generated goodwill and brands are never classified as an intangible asset. But at the same time, if your entity has actually generated some other intangible asset like any technology, any production process, correct, any know-how, any patent, any trademark, that will be considered and that will be recognized as an intangible asset, but as per some rules. Generally, an entity when it actually try to internally generate an intangible asset besides goodwill and brands, correct, then generally 2 steps are required. For the internally generated asset, entity need to spend some amount initially that is known as research phase expenses. Quite obviously, if my entity want to actually generate a particular production process, technical know-how or technology, then obviously I need to spend some amount on research phase. Whatever expenses which an entity has incurred during the research phase, all those expenses will always be treated as revenue expenditure. Remember one thing. So any expenditure on internally generated asset besides goodwill and brands, correct, any expense on research phase will always be treated as revenue expenditure without any doubt. Now coming over to the next part, as I told you, after incurring research expenses, if entity finds that there is some potential in it, then entity goes for development of that particular intangible asset. That means another point is that is the second stage that is known as developmental phase. Now during this particular phase, entity obviously would like to develop that particular intangible asset because through its research, entity has now got a hint and smacked that this particular what we call item which we are going to develop is definitely going to bring us some returns. So if entity finds some potentiality, as I said earlier, then entity goes for its development. Now as far as development is concerned, here you need to take care of one aspect. Whatever expense entity incurs in the development phase, correct, all those expenses can either be treated as revenue expenditure or can be capitalized. Can be capitalized means an intangible asset can be recognized. Now the point which you need to understand is this one. Let us say this is our current year and this current year starts on 1/4/2026 and it ends on 31st of 3/2027. Let us say it is given in the question that during this particular accounting year, entity has spent on developmental expenditure are given on development of an intangible asset, and total amount incurred by the entity, let us say, is equal to 100 lakhs. Total amount incurred is equal to 100 lakhs. Now further it is given in the question, let us say by 31st of 12/2026, by 31st of 12/2026, out of this 100 lakhs, total amount spent was 60 lakhs. That means rest of the expenditure, 40 lakhs, were spent from this particular point till this particular point. Is it clear to you? That means prior to this particular point, entity has spent 60 lakh and 40 lakhs after this. But this entire amount of 100 lakh is in the developmental phase. Now let us say question states that on this particular date, that is 31st of 12/2026, this item which entity was developing, it meets the asset recognition criteria. Actually, there are some criterias. If those criterias are met, then we call that these developmental expenditure have met the asset recognition criteria. So technically on this particular date, because our developmental phase expenditure has met the asset recognition criteria, now the treatment will be like this. That means prior to this particular date, all the amount which I have spent, even what we call on developmental phase, those expenses will be treated as revenue expenditure. That means out of 100 lakh in this accounting year, entity will treat 60 lakh as revenue expenditure, and rest of the 40 lakh expenditure which entity has incurred after this point when asset recognition criteria has been met, then those expenses 40 lakh will be treated as cost of intangible asset. That means intangible asset will be recognized at the end of the year at a value of rupees 40 lakh. Indirectly, this part, that is 40 lakh, will be capitalized. Is it clear to you? The moment, actually development phase criteria, the moment when those expenses will meet the asset recognition criteria, then at that point you are, and at that point and after that, you are going to actually recognize the intangible asset. Is it clear to you? That means the amount which you have spent on developmental phase after this particular point will be capitalized, and that's the reason at the end of the year there will be an intangible asset in the financials that is at a value of rupees 40 lakh. So this is the point which you need to take care of with respect to what we call developmental phase expenditure. When we say asset recognition criteria, that means whatever actually which we are developing as an intangible asset, that means now it has got the potentiality to fetch us return. Directly or indirectly, it means asset recognition criteria simply means this particular item which we are developing has the potential now to give us return. It can be sold out, it can be let out, it can be used in the production process. That is what we mean by asset recognition criteria. Coming over to this particular case study 5.1, over here it is written W2 Limited is developing a new production process. In the financial year 26-27, entity incurred an expenditure of 50 lakh for generation of intangible asset. Now, similar to this particular question is this one. In this particular question, you are being given that entity is developing a production process. And in the current accounting year, which is given to you, which is starting from 1/4/2026 and ending on 31st of 3/2027, it is given to you that entity has incurred total amount in the development of this particular item production process is actually 50 lakhs. Further, it is given during 2026-27 on 1st of January 2027. Now it is given that on 1st of January 2027, entity is able to demonstrate the asset recognition criteria. Now on this particular date, actually ARC, asset recognition criteria, is met. Asset recognition criteria is met. Very important point. Further, it is given that accountant wants to capitalize 50 lakh rupees. Can he do so? Actually, one line is not written over here. Kindly actually rectified. During 2027, on 1st of January 2027, entity is able to demonstrate the asset recognition criteria and write in bracket expenditure till date 20 lakh. Expenditure till date is 20 lakhs. It is not printed, so kindly write it. Expenditure till date is equal to 20 lakh. That means out of this 50 lakh, till up to this particular point, total expenditure is equal to 20 lakh. Now, but the accountant of this particular entity is quite smart. Now, he thinks actually, because we have now reached the end of the year, and on this particular date, this particular asset, this particular developmental expenditure has now met the what we call asset recognition criteria. So why we should not capitalize the entire amount of 50 lakh? That is the version of the accountant actually. But what is your version? That exactly the question is interested in. I need not require to tell you what will be your answer. Out of 50 lakh, any developmental expenditure incurred prior to the fact that ARC is met will be expensed. That means 20 lakh will be treated as revenue expenditure, and after this 30 lakh will be treated as what we call capitalized. That means at the end of the accounting year, there will be an intangible asset to the tune of rupees 30 lakhs. I have already told you, as far as measurement in balance sheet is concerned, an entity can choose either the cost model or entity can choose the revaluation model, similar to what we call property, plant and equipment, that is Ind AS 16, correct? Now, further here it is given some points with respect to amortization. As you know, when we write off what we call any tangible items, then decline in value is termed as depreciation, and similarly amortization is the terminology which we use when we actually charge their reduction in value or decline in value to profit and loss account with respect to intangible asset. Correct? Instead of depreciation, we call it amortization. Important point is that intangible asset, obviously most of the intangible asset have some definite life. Correct? That is also known as finite life. Finite means definite life. After a particular point of time, they will become useless. So they have some definite life, and most of the asset, whether intangible or tangible, they have a definite life. Now, if there is a definite life, then depreciable amount of intangible asset with a finite useful life is allocated on a systematic basis over the useful life. Obviously, for example, there is an intangible asset and we have recognized it at a cost of rupees 100 lakh, and its limited life or finite life or definite life is 10 years. So obviously I will charge a depreciation of 10 lakh, although the standard says that we need to provide depreciation on a systematic basis. Further, it is also written amortization should start when the asset is available for use, and that is normally the case. Amortization should be stopped when asset is classified as held for sale. Amortization method should reflect the pattern in which assets' future economic benefits are expected to be consumed. Most of the time, we write the depreciation by taking into account the useful life, but often, we will provide depreciation by taking into account the future economic benefits. What does it mean? For example, the cost of the asset is 100 lakh, and I presume they have got a life of 5 years. And for the next 5 years, we will take into account the returns in each year. Are you getting my point or not? So it is not necessary that in order to provide the depreciation, every time I will take into account the useful life only. That means cost divided by useful life. That doesn't mean that every year I am going to provide a depreciation of 10 lakh, or in this case, let us say 20 lakh, because in this case, I have considered a life of 5 years. And standard says that we need to use a systematic basis. For example, if I know that this particular intangible asset is going to fetch me return of this value each year for the next 5 years, then in order to show the reflection of the decline in value, the best method is to take into account the ratios of the future economic benefits and on the basis of that ratio, I should provide the depreciation. That is what we mean by this particular sentence. Obviously, whatever amortization is there, we are going to debit it to profit and loss account. It could be a possibility that there are some intangible assets whose useful life is almost indefinite. Correct? We call it indefinite. There are certain intangible assets, for example, like brands or intangibles, correct? Like brands or trademarks, they may have indefinite useful life. That means their useful life cannot be determined in advance. So in such cases, no depreciation is provided, although impairment testing is done annually. So you just for your MCQ, you need to take care of this particular part. Now coming over to the questions, W29 Limited developed a product at a cost of 150 lakh. At a cost of 150 lakh. Cost is 150 lakh. Now in this question, sales are given to you. In the first year, that means through use of this particular production process, you will get a sale of 400 and then 300, then 200 and 100 for 4 years. Correct? It is given you are asked to suggest how you are going to amortize the cost of the intangible asset during its useful life, presuming its useful life is 4 years, because 4 years sales are given to us. Now, one way is that I can simply take, one way of writing off is simply take into account the cost. The cost is 150 lakh and divide it by 4. Now, in this case, if I am going to charge depreciation this way around, it will be equal to thereabouts 150, 75 lakh, then 37 lakh 50,000. Each year I will have to provide a depreciation of 37 lakh 50,000, but it will not show a systematic basis, because standard stresses upon this particular fact that you need to use the depreciation on a systematic basis. Is it clear to you or not? So, as per the standard, as per the standard amortization method, should reflect the pattern of economic benefits consumed. Now, it is being given that during the next 4 years, economically, this particular asset is going to bring you benefits of 400, 300, 200, and 100. So it is better to actually provide depreciation or amortization on the basis of sales ratio. And that is exactly what we have done here. For example, first of all, I will make another column. I will add all these what we call benefits. 400, 300, 200 is equal to 1000. And on the ratio of that, I am going to write off the cost. Here it is written year, proportion, and amount of amortization. Now in year 1, your benefits are 400 and total benefits in 4 years is equal to 1000. So this will be your ratio. So on the basis of this ratio, you are going to write in the first year the cost. So 60 lakh out of total cost of 150 lakh, 60 lakhs you are going to debit in the first year. And similarly in the second year, 45 lakh. And in the third year, you are going to write off 30 lakh. In the fourth year, you are going to write off what we call 15 lakhs. Is it clear to you or not? Suppose if in this particular question it would have been given, that there are no economic benefits after third year, then how much of cost you would have written off in the third year? Now see here, in the first year we have already, total cost actually is 150 lakh. Total cost is equal to 150 lakh, isn't it or not? And in the first year, we have already written off, as seen here, 60 lakh. We have already written here 60 lakh. Similarly, in the second year, we have written off 45 lakhs. And likewise, in fact, question is, if at the end of the third year, there are no economic benefits. So after the first 2 years, we can say unamortized cost, because we have written off what we call 105 lakh in the first 2 years. So out of 150 lakh, we may say that 45 lakh worth of cost is still unamortized. That means, because after the third year, there will be no benefits, so entire 45 lakh remaining unamortized amount will be written off in the third year. Suppose if in the same question would have asked this way around, if there are no economic benefits at the end of the third year, what would have been the amount which you would have had written off in the third year? Then your answer would be 45 lakh. If there will be no economic benefits in the third year, then whatever unamortized cost is remaining now after the end of the 2 years, whole unamortized amount of 45 lakh now will be written off in the third year. Is it clear to you or not? Now coming over to the next question. W32 Limited acquired a patent at a cost of 80 lakhs. Now you acquired a patent at a cost of 80 lakh for a period of 5 years. Now initially I acquired a patent for rupees 80 lakh. I acquired a patent for rupees 80 lakh and I estimated its life to be of 5 years. So logically it means I should write off 16 lakh annually. And especially in the first 2 years, I will write off 16 lakh, and similarly third year, fourth year, and fifth year. But in the question it is given, and the product life cycle is also 5 years. I've already estimated product life cycle as 80, cost is 80, and product life cycle is actually 5 years. Further, it is given company capitalized the cost and started amortizing the asset at rupees 16 lakhs per annum. That is what exactly I said. Company started writing off this particular item at 16 lakh. After 2 years, that means after 2 years, now what will be the cost of this particular asset after 2 years? Because you have already written off. Initially, you purchased this particular asset for 80 lakh. You estimated its product life cycle would be only 5 years. So on that basis, you wrote off actually 32 lakhs. That means after the first 2 years, unamortized amount will be equal to 48 lakh. 80 lakh minus 32 lakh if I am not wrong. So this is the unamortized amount after the second year, correct? After the second year. Now the third begins. But what happens here, it is written in the question that after 2 years, it was found that product life cycle may continue for another 5 years. Another 5 years. Try to understand this particular point. Actually, initially we thought that life cycle will be equal to 1, 2, 3, 4, and 5 years. So logically, after the end of the second year, remaining life should have been actually only 3 years. But now the question says that now we are estimating that this particular product is going to fetch us return for another 5 years. That means after the end of the 2 years, the product life cycle may continue for another 5 years. That means now we have 2 more years. Is it clear to you? That means after the end of the second year, there are 5 more years. But in this particular question, it is also given the net cash flows from the product during the upcoming 5 years are expected to be 36 lakh, 46 lakh, 44 lakh, 40 lakh and 34 lakh. That means in the next 5 years, you are going to write off depreciation on the basis of the cash flows. This is the point which you need to understand. In the first 2 years, actually, you simply divided the cost by the what we call life, and you found out the depreciation in the first 2 years as 16 lakh. Now, this remaining 48 lakh will have to be written off in the next 5 years, and in the next 5 years, you are going to write them off on the basis of these cash flows. This is exactly what I have done. This is the entire solution which I've already done here. I've already told you in the first year 16 lakh you are going to write off. Then 48 lakh is the unamortized amount, and this unamortized amount, first of all, you will write all the inflows, total them up. This is your 200, compute the ratios. So ratio will be 36 by 200, 36 by 200, 46 by 200, 44 by 200 and so on. And on this ratio, you simply write off the unamortized cost of 48 lakh. So this is how in the next 5 years, you are going to write off the what we call cost. Is it clear to you or not? Now the next topic, recoverability of carrying amount. What we mean by that, let's have a look over this particular question. W35 Limited is developing a production process. So again, this time it is given that there is an entity and it is developing a production process, and during the financial year 31st/3/2026, the company has incurred total expenditure of 40 lakh on the production process. So till the end of 31st/3/2026, total amount is spent actually is 40 lakh. Till 31st/3/2026, total amount is spent is given to you as 40 lakhs. This entity has spent 40 lakh as the total amount. Further, it is given on 1/12/2025. On 1/12/2025, it is written first, because our accounting year must have begun on 1/4/2025. And now it is given that on 1st of December, 1/12/2025, it is given the process has met the norms to be recognized as an intangible asset. So on this date, asset recognition criteria is met, and it is also given expenditure till that point is actually 16 lakh. So out of this 14 lakh, now we can safely say that in this particular period, total expenses is equal to 16 lakh. And quite obviously after this point, the total expenses must be equal to 24 lakh 40 minus 16. And I need not require to tell you the what we call accounting treatment. These expenses, 16 lakhs, without an iota of doubt, you are going to actually expense, and 34 lakh will be capitalized. Capitalized in the sense, it means at the end of the accounting year, at the end of 31st/3/2026, now you have an intangible asset at a cost of rupees 24 lakh. Further, it is written, during financial year ended 31st/3/2027, the entity further incurred 70 lakh. Now it is given in the question in the next year, when your next year ended on 31st/3/2027. 31st/3/2027 next year ended, and it is given that entity has incurred further 70 lakh rupees. Further 70 lakh. Because at the end of 31st/3/2026, you are already having an intangible asset, correct, at a value of 24 lakh. That means in the beginning of the current year, that is 1/4/2026, there was an intangible asset in your books, and that was being reflected at a value of rupees 24 lakh. Now, because in this particular accounting year, entity has spent 70 lakh, so subsequently whatever expenditure will be incurred after the recognition of intangible asset, we will capitalize even those expenditure. So at the end of the accounting year, this intangible asset will be reflected at 94 lakh. That means on 31st/3/2027, you are going to recognize this intangible asset at a value of 94 lakh. Also, it is given that recoverable amount as on 31st/3/2027 is actually 62 lakh. Now, point here is that at the end of the year, although the value of this particular intangible asset or the cost of this particular intangible asset is 94 without an iota of doubt, 24 lakh and 70 lakh. But at what value now I should recognize it in the balance sheet as at 31st of 3/2027, because in this particular case, this is your carrying amount, no doubt about that. You are going to compare it with the recoverable amount. We are going to now compare it with the recoverable amount. Is it clear to you or not? If I am going to compare it with the recoverable amount, now it is given to you, it is 62 lakhs. Recoverable amount is 62 lakhs only. So that means there is an impairment loss. That means at the end of 31st/3/2027, that means in 26/27, I will capitalize 70 lakh. This is my first answer. At the end of the year, carrying amount of the asset is what we call 94. But at the same time, recoverable amount is 62 lakh. So whatever difference is there now, I think this difference is equal to 32 lakh, if I'm not wrong. This will be considered as impairment loss. That means in 26/27, how many things I am doing? First of all, I will capitalize this 70 lakh. So cost of the asset will move up to 94 lakh, number one. Number two, because the recoverable amount is 62, we will compare the carrying amount at the end of the year with the recoverable amount. We find that there is an impairment loss. So this impairment loss too will be debited to profit and loss account. Is it clear to you? So this is how you are going to do the solution, and this is exactly what I have written over here. Quite obviously, similar to any tangible items, even an intangible item is de-recognized when we find actually that it has gone past through its life or no economic benefits are prevailing through this particular item. As far as disclosure is concerned, standard says that useful life or definite life, whatever is there, you need to reflect it. If there is indefinite life, you need to mention it. Useful life and amortization rate and methods you also mention, and gross carrying amount, accumulated depreciation, etc. must be disclosed. These are the guidelines of what we call standard. So these are the questions which you have actually received so far as new syllabus is concerned. And all these questions, now you can do it by yourself. To be very honest with you, all these questions are similar to the one which I have been doing and which I just did now. Correct? For example, in this particular question which came in June 24, just take care, sometime actually staff commits a mistake. So June 24 question, examination question, Y Limited is developing a new distribution system of material. So they are developing a new distribution system indirectly means they are developing some technology, some what we call production process or some process they are developing. Correct? And following are the costs incurred at different stages of R&D. Now you have been given in this particular year that this entity has actually incurred, R&D means research and development phase expenditure. In 2019 and 20, entity has spent on research actually 16 lakh, and amount is in crores. Similarly, in 2020-21, it is given entity has spent actually 20 lakh in research. However, after this particular point, developmental phase starts, and in 2021-22, we have incurred 60 lakhs. Similarly, in 22-23, 72 lakh. In 23-24, we have spent actually another 80 lakh. On 31st of 3/2024, it is given that company identified the level of cost saving at 32 crores per annum expected to be achieved by new system over a period of 5 years. Very important point. Actually, when we reach the end of 31st of 3/2024, here it is. When we reach the end of 31st of 3/2024, it is given in the question that this entity is now estimating that by applying this new system, we will be able to annually save 32 crores. Through application of this technique, there will be annual savings. There will be annual savings of 32 lakhs, 32 crores per annum. 32 crores per annum. It is given to you. And how you are going to use this, I will let you know in a short while. Further, it is given that there will be annual saving for the next 5 years. That means after this particular point, you can say life of this particular asset is 5 years. After 31st of 3/2024, life of this production process will be equal to 5 years. Further, it is given In addition, the system developed can be marketed by way of consultancy, which will earn additional cash flow of 20 crores per annum over the period. Not only you are going to use this system, not only you are going to use this particular system, but you can also use it through providing consultancy. So that means another inflow will generate. See, even annual savings is sort of what we call cash flow. Indirectly, what question is telling, after the end of 31st of 2024, you will be able to get some benefits through use of this particular technique. Correct? One, it will help you in saving the cost. That itself is a benefit. And further, you can also what we call provide consultancy services through this particular system, and it will fetch you 20 crores per annum. 20 crores per annum. It is also written in this particular question. Is it clear to you or not? Also, it is written the fair net cost of disposal is 190 crores. Fair net cost of disposal. It is also known as fair value less cost of disposal. Fair value less cost of disposal is actually 190 lakh. How we are going to use this particular data, I will let you know later on. Further, it is also written in the question, Y Limited demonstrated that new system met the criteria for asset recognition on 1/4/2021. On 1/4/2021. Now, 1/4/2021 asset recognition criteria is met. 1/4/2021. Actually, you need to understand this way around. Just to make the point a little bit more clear, I am taking a little bit longer route. Prior to this year, we will end over here on 31st of 2023, correct? Similarly, preceding this particular accounting year, we will move over to 31st 2022, and then we will move over to 31st 2021, 31st 2021, and obviously prior to this one there will be 31st of 2020. These are the accounting years which are given to us in this particular question. Now question states very disguisedly later on that on 1/4/2021 ARC was met. On 1/4/2021. On 1/4/2021 will be the date which will lie over here, 1/4/2021. On this date, asset recognition criteria is met. Indirectly, it means whatever amount which you have spent during these two what we call accounting years, those expenses are 16 lakh and 20 lakh, you will expense them. Is it clear to you or not? So 36 plus 20 lakh, you are going to expense them, and total amount will be equal to 36 lakhs. It is written in the question. Let me also see. I must have written over here also. So here it is given 16 lakh and 20 lakh should be charged to statement of profit and loss account. Is it clear to you or not? So 36 lakhs you are going to charge to profit and loss account without any doubt. Now, important point is that after this, actually your developmental phase expenditure has now started. Because after this particular point, asset recognition criteria is met. Whole amount 60 lakh, 72 lakh, 80 lakh, you add them up. Is it clear to you or not? We are going to add all this particular amount. So if we are going to add all this particular amount, technically speaking, because in this particular stage we have spent 60 lakh, on this particular date this asset will be recognized at 60 lakh, and at the end of 31st of 3 this asset will be recognized at 60 lakh plus 72 lakh. Because 60 lakh it is already recognized and we have spent further 72 lakh. So that is why I am writing here 60 lakh plus 72, 132 lakh. And similarly another 80 lakh we have spent. So 60 lakh plus 72 lakh plus 80 lakh. That means at the end of 31st of 3, 2024, I will recognize these items at 132 plus 80, that is equal to 212 lakh. At the end of the accounting year, this asset is being recognized at 212 lakh. But the important point is that you will learn it under Ind AS, because right now we are doing Ind AS 38 and under Ind AS 36 actually, which relates to intangibles, Actually, what happens, this is the carrying amount of the asset, no doubt about that. 212 is the carrying amount of the asset, no doubt about that. But what you are going to do now, you are going to find out the recoverable amount. That means at the end of 31st of 3, 2024, at the end of 31st of 3, 2024, my carrying amount, no doubt, is actually 212 lakh. 212 lakh is my carrying amount. But I will have to find out the recoverable amount. We will learn about recoverable amount under actually Ind AS, as I told you, because this is 38 we are doing, under Ind AS 36, which relates to impairment, where you will learn the concept of recoverable amount. Actually, by now you all are familiar with recoverable amount. You know that recoverable amount actually is higher of, it is higher of value in use and fair value less cost of disposal. The higher amount between value in use and fair value less cost of disposal. Now in this particular question, fair value less cost of disposal is already given to you at the end of 31st of 3, 2024. Now how you are going to compute the value in use? Value in use basically means the present value of future economic benefits. Present value of future economic benefits. And I just told you, correct? It was given in the question, through application of this particular technique, the entity will be able to save 32 crores per annum, and besides that it will be able to earn through consultancy 20 crores per annum. All in all, you will get a benefit of what we call 32 plus 20, that is equal to 52. So I will have to find out the present value of this 52. And for that, it is given to you in the particular question. Actually, lots of questions are being asked. First one is the amount chargeable to expense. I have already told you amount to be capitalized at the end of 31st of 3, 2024. I have already told you 212. And impairment loss to be recognized. That is exactly we are trying to find out. In order to find out impairment loss, you will use this particular formula. Actually, present value factor, annuity factor is given to you at 10% for 5 years is 3.79. So you can simply multiply 52 with 3.79. Correct? Whatever figure which you are going to get. Actually, I will have to tell you that figure is coming to 197.08. 197.08. I told you recoverable amount is a higher figure between value in use and fair value less cost of disposal. Because 197.08 is higher than fair value less cost of disposal, your recoverable amount will be considered as 190. Now you will compare the recoverable amount with the carrying amount to find out your impairment loss, that will be equal to 22. This is how you are going to solve this particular question, and this is exactly what we have written over here. So you can easily actually find out. Actually in this question, I think I have done some mistake. I told you higher figure and I have picked up 190. Actually, higher figure is 197. Extremely sorry. Higher figure is 197.08 and I have taken the lower figure. Extremely sorry. Extremely sorry. So 197.08. 197.08 you will have to subtract from 212 lakh to find out your impairment loss. And this will be equal to, I will have to use the calculator, minus 197.08. That comes to, according to my calculation. Why I'm telling my calculation, sometimes I also go wrong, especially if the calculator is not working. I'm not in a habit of using too much of calculator, honestly speaking. So 14.92 is your impairment loss. So this is right. So here it is written 14.92. So what will be the amount at which now asset will be reflected in the balance sheet? Obviously, because you have now subtracted 212 minus 14.9.2, obviously now in the balance sheet, asset will be reflected at 197.08. Is it clear to you or not? So these are the answers to all the questions which are given to here, and all the rest of the question now you should be in a position to do, because all these questions are absolutely on similar line to the question which we just did. This is June 23 question, and solution is given to you, and this is December 23 question. Again, same question, and this is MCQ question. Actually, I have also solved it for. We start today's this particular session, which you can see flashing on your screens. Ind AS 108 operating segments, and most of you, the moment you are going to have a look over this particular standard, you might feel actually you are very well aware of all the intricacies associated with this one, because you have already gone through AS 17 in your earlier phases of education. No doubt about that. There is hardly any difference between what you have read in your earlier phases of education and what you are going to read now. Anyway, but because this particular standard is part of your course, so we have to do it. So from the examination perspective, we cannot say that it is a pretty formidable one, pretty important one or something like that. But the important point is that because it is a part of your syllabus, you have to read it. Now, as far as guidelines of this particular standard is concerned, as you can see, actually, the guidelines deals with the fact that a particular entity need to first of all identify the operating segment. And after identifying the operating segment, they need to aggregate, and then later on, the entity will have to actually identify that which operating segments are there which need to be reported, and finally prepare the segment reporting. Now, coming over to what we call all these particular steps, in order to know actually which are the operating segments, entity first of all need to understand you need to understand the meaning of operating segment. What we mean by operating segment? First of all, you need to understand that operating segment basically is a component of an enterprise. It is a component of an enterprise, and any component of a particular enterprise will be treated as operating segment if following criteria are satisfied. One criteria is that if we are able to get and accumulate the discrete information. What we mean by discrete information? Discrete information means specific information, specific, particular, separate information. There is a component of an enterprise. If I am able to what we call get the discrete information in respect of its assets, liabilities, income and expenses, then I may consider this component as an operating segment. Is it clear to you? Likewise, if there is a component of a particular enterprise and its performance is reviewed, performance is reviewed, monitored or assessed by CODM. Now, what we mean by this CODM, Chief Operating Decision Maker. First of all, you need to understand that it is not a position, it is a function. And this function can be carried out by Chief Executive Officer, Chief Operating Officer, or what we call any director. This is the point which you need to understand at professional level. Correct? So a component can be considered as in what we call operating segment if discrete information is there and its performance is being reviewed by the what we call CODM, and CODM is a function actually. It can be carried out by, as I said, Chief Executive Officer or what we call Chief Operating Officer or any what we call Executive Director. Is it clear to you or not? Further, a component can be considered as operating segment if we are able to see that this particular component is incurring its own expenditure and it is also generating its own income. So by applying these what we call criteria, an entity decides that out of various components which are the operating segments. Suppose a particular entity now through application of these criteria has decided upon this particular fact that these are our operating segments. As I told you, now after that there is another step. The standard says that once the entity has selected which component are the operating segment, then if possible, entity must aggregate them. For example, let us say out of these components which we have already selected as operating segment, these are the operating segments now actually. Let us say out of these two operating segments are such that their product base is absolutely same. Their customer base is also same. And even their let us say production process base is also same. Or for that instance, both these operating segments are what we call operating in the same regulatory environment. Put in simple words, it means if two or more than two operating segments have similar sort of products, similar customer base, similar production process, or they are operating in a similar regulatory environment, then we can club them into one operating segment. Is it clear to you? That is what we mean by aggregation of operating segment. So let us say through application of all these rules, now entity finally actually decides and conclude that we have got these many operating segments. These many operating segments. Is it clear to you? Now the next step is, once the operating segments have been decided upon and selected through application of first two rules, now the next one is, now we have to find out of these segments which are the reporting segments. And in order to know which are the reporting segment, we have to apply the qualitative threshold limits, which you know. Actually, in order to know which operating segment happens to be a reportable segment, as you know, we have to apply three criteria. One is known as revenue criteria, another one is known as result criteria, and finally another one is known as asset criteria, segment asset criteria, segment revenue criteria, result criteria, and asset criteria. Correct? If a particular operating segment is having its revenue equal to or more than 10%, then it will be considered as then it will be considered as a reportable segment. So as far as threshold limit is concerned, with respect to all these three criteria, is 10%. If any of the criteria, remember one thing, if any of these criteria is satisfied, then we may say actually that operating segment happens to be a reportable segment. So first of all, we need to actually understand this particular point, and in order to understand this particular point, let's have a look over this particular question. Now, in this particular question, let us say, here it is given to you information relating to 5 segments of N999 is given to you. Now, in this particular case, you have already seen that these are the selected what we call operating segments. So in this case, you can see 5 segments are there. And some specific information is also given to you. For example, segment revenue information with respect to this. So segment revenue of this particular operating segment and the other operating segment is also given to you. That means total segment revenue is also given to you as 900. Similarly, segment results are also given to you. So we may see actually here that in this particular case, segment A is having profit as the final result, but segment B is having a loss, segment C is having a profit, segment D is also having a profit, but segment E is having a loss, and the total net what we call profit or loss is given to you as 45. And besides that, we are being given what we call respective segment assets of the respective segments. Now we have to select which are the reportable segments. So in order to select, for example, suppose I want to apply the segment revenue criteria. Through segment revenue criteria, first of all, what I am going to do, I'm going to consider the what we call total revenue of all the operating segment. So these are the operating segment A, B, C, D, and E. I will total their revenue, that is equal to 10%. Now total revenue is equal to 10%. Now I will apply the 10% rule. Now 10% rule is equal to 90. Now that means if revenue of a particular segment happens to be equal to 90 or more than 90, then we may say that it is able to meet the threshold limit of 10%, because I have already computed the 10% of total revenue 90. Now, if you will see in this particular case, as far as your segment A is concerned, because its segment revenue is 150, which is more than 90, so that means it is a reportable segment. Similarly, if I will take into account B, again, because its revenue happens to be 200, which is more than 90, it will be considered as reportable segment, and so on. Even C will be considered as reportable segment. However, D's total revenue is 50, whereas 10% of the total revenue is 90. So segment revenue criteria is not met as far as the segment D is concerned. Similarly, in case of E, we may say that it is a reportable segment. So on the basis of segment revenue, we may say that these segment A, B, C, D, and E are reportable segment. Is it clear to you? Then similarly, I am going to apply the next one. Next one is known as result criteria. In order to apply the result criteria, what I need to do, and I have seen actually most of the students sometimes commit unnecessarily what we call mistakes, correct, when they apply actually this particular criteria. In order to apply this particular criteria, first of all, you need to understand that you need to compute the absolute amount of profit. Now, what we mean by absolute profit, I need to compute absolute profit and absolute loss. What we mean by that? Pay attention here. Now, if you look into your question, you will find actually segment results. Now, A is having a positive result 50. First, you select those segments which are having the positive result. Positive result of C is 80 and result of D is also positive. So out of these 5 segments, 3 segments are there whose result is positive. Now if I am going to add 50, correct, here it is 80 and finally 25. The total will be equal to 50 plus 80, 130, and 130 plus 25 is equal to 155 if I am not wrong. Correct? Then I will take into account the losses. Now as far as loss is concerned, there are 2 department B and what we call in case of C. Correct? So that is 70 plus 25. That is equal to 95. 50 plus 80 and actually I have done here a mistake. It is 10. So that is coming to 140. So what my point is that out of these what we call 5 segments, we have seen that as far as A is concerned, as far as C is concerned, and as far as D is concerned, they are having positive profits. So their results are positive, they are having profits. I total them up. It will be this 140 will be known as what we call absolute amount of profit. Absolute amount of profit. Correct? And there are 2 what we call segment in this particular case where we are having negative result. For example, B and what we call E. And the negative result of B is 70, that is loss, and loss of segment E happens to be 25, so total comes to 95. So this is what my point is. First of all, what I need to do is to compute the absolute amount of profit, which I did 140 and 95. Correct? Absolute amount of loss. Now out of this, now I will have to select the higher figure. Higher figure happens to be 140. Now I will compute 10% of this. Now 10% comes to actually 14. Now all I have to do is to find out the what we call figure of profit or loss of what we call each segment and compare it with this figure. Correct? For example, in case of if we are going to actually have a look over what we call segment A, we find that its segment result is 50. Now 50 is more than 14. So we may say that even what we call in this particular case result criteria, segment A is a reportable segment. Similarly, if we are going to take into account B, now when you are going to compare, you are not going to take into account profit or loss. You will simply compare 70 with 14. Don't think you are comparing minus 70 with 14. Are you getting my point or not? You will simply compare 70 with 14 and 70 happens to be more than 14. So in this particular case, B is also a reportable segment as per result criteria. C is also a reportable segment. Now coming over to D. Now D is having what we call result of only 10 and 10 is less than 14. So it is not meeting the what we call threshold limit. And as far as E is concerned, don't think that you are comparing minus 25. Now think only this way around. You are comparing 25 with 14 and 25 is bigger than 14. So we may say now E is also a reportable segment. Finally, we come over to the asset criteria. As far as asset criteria is concerned, first of all, what you need to do, you take the total asset, simply find out 10% of this. 10% of this is 30. Now because segment asset of A is 40 and 40 is greater than 30, so we may say that as far as segment A is concerned, again it is meeting this particular criteria, segment asset criteria. And coming over to B, B is having 65, 65 is more than 30, so it is also a reportable segment. C is having 140 worth of what we call segment assets, more than 10% of the total asset, that is 30, so it is also a reportable segment. But D is not able to meet because its segment assets are 20, whereas 10% of the total asset is equal to 35. E is reportable segment. So if any of the criteria is met, that is known as reportable segment. Unfortunately, in this case, we find actually this particular segment D is not able to meet any of the criteria. So D cannot be considered as a reportable segment. Is it clear to you or not? After this, there is another important point. Now we pick up this particular question from MTP Set 1 June 23. Now in this particular question, it is given to you there is an enterprise and it is operating through 8 segments, namely A, B, C, D, E, F, G, H. So there are 8 segments. 1, 2, 3, 4, 5, 6, 7 and 8 segments are given. Now in this particular question, you must have noticed that as far as segment revenue is concerned, we are being given actually external revenue from external sales. External sales means the sales done by this particular operating segment to the clients, to the customer, to the third parties. And there are some internal sales. Internal sales basically means inter-segment sales, because sometime a particular operating segment might be having some dealing with the other segment of the same enterprise. So these are known as internal sales. Anyway, so as far as A is concerned, its external sales are 0, but internal sale is equal to 500, but total sales of A is equal to 600. Correct? As far as total sales of A is concerned, that is equal to 600. Total sales is equal to 600. Similarly, if I am going to take into account B, now that is equal to 1326 plus 300, that comes to 1626. Total sales or total revenue of B is equal to this much. Similarly, if I am going to take into account C, that comes to, I think, 224. If there are some mistakes on my side, I apologize for the same in advance actually. And then D is equal to 76. E is having only what we call 26, that is revenue through external sales, and F is also having external sales of 250, while G is having internal as well as external sales, and total is equal to 100 plus 24, that comes to 124, and similarly H is equal to 174. Now total is also given. Now total of external sales is equal to 2000 and total revenue from internal segment is 1000. So total revenue is equal to 3000. Is it clear to you? Total revenue is equal to 3000. So better way is that first of all compute 10% of the total revenue. Now if we are going to compute 10%, that will be equal to 30. Now all you have to do in order to know whether it is a segment or a reportable segment or not, compare what we call these respective figure with 30. Now because as far as operating segment A is concerned, it will be considered as reportable segment simply because its total revenue is more than 10%, that is 30. And similarly 1626 is higher than 30, so it is reportable segment. Sorry, 10% comes to 300, but again they are reportable segment. 224 is less than 300, so it is not a reportable segment. It is also not a reportable segment. It is also not a reportable segment. This is also not a reportable segment, and even G and H are also not reportable segment as far as revenue criteria is concerned. So on the basis of revenue criteria, we may say so far actually A and B only are reportable segment. Now we have to apply the result criteria, and this is the most clumsy task I have seen a student ever face actually, because in this particular case again you are having some positive result and negative results. For example, this segment, this segment, this segment, this segment, and this segment are having what we call positive, whereas B, D, and what we call F are having negative results. So your first task should be to take the absolute figure of profit and loss. If you are going to take the absolute amount of profit or loss, I must have done it somewhere. See here, I have done it. As far as result criteria is concerned, you take into account the profits first of all, total them up, that comes to 240. Then take the total of the total losses of the respective operating segments, total them up, get the absolute amount of loss. Now you must have noticed in this case, out of these two, higher figure is 600. Once you have selected the higher figure, now you simply compute the 10% of that, that is equal to 60. Now we know that higher figure is 60. Correct? Higher figure is 60, 10% is 60. Now we have to simply check the net results. Now 30 is lesser than 60, so on the basis of result criteria we may say actually A is not able to meet this particular what we call criteria, result criteria. Similarly, as far as B is concerned, don't think now when you are comparing, simply ignore the what we call negative sign. Simply compare 540 with 60, and 540 is higher than 60, so it will be considered as reportable segment. Similarly, 90 is higher than what we call 60, so it is a reportable segment. 30 is lesser than 60, not a reportable segment. 48 is lesser than 60, 30 is lesser than 60, 30 is lesser than 60, 42 is lesser than 60. So on the basis of result criteria, we may say only B and C. So far till up to this particular point, actually our reportable segments are A, because A has qualified the revenue criteria. If any criteria is qualified by a particular segment, that will be considered as a reportable segment. Even B will be considered as reportable segment. In fact, B is qualifying both the criteria. C has qualified the result criteria. So far at this particular point, we may say there are three what we call segment which are operating segment. Now we have to apply the segment asset criteria. Segment asset criteria is easy. This is the what we call total amount given to you. Simply compute 10% of it, first of all 20, and compare the respective figures. If you are going to compare the respective figure, 30 is lesser than what we call 20, lesser than 20. So 30 is greater than 20, should I say that way around. So now we may say, as far as asset criteria is concerned, A is qualifying this one, B is not able to qualify this one, C is also not able to qualify this one, D is able to qualify now, and E, F, G and H are not able to qualify because their net results are lesser than 20. So ultimately we find actually there are four segments which are actually operating segments. Is it clear to you or not? Because if any of the criteria is satisfied, those segments are considered as an operating segments. Now, another important point is that, one more point I just for your knowledge sake also. Now you know that you have already selected A, B and C, D. They are these segments happen to be what we call reportable segments, simply because of the fact that they have satisfied at least one criteria out of the three criterias, correct? Now we come over to the next point. Now after actually question hasn't asked this one, correct? But you should know, especially after having reached this particular level. Now I will take into account their external revenue, not internal revenue, external revenue. Now external revenue of what we call segment A is nil, segment B is 1326, segment B is 74, and segment D is 50. Those segments which have qualified any one of the criteria, threshold limits I'm talking about, are reportable segments. Now you take into account only the external revenue, not the internal revenue. Total it up. So total external revenue of your selected reportable segment is equal to 1450. After that, you compare it with the 75% of the total external revenue. Total external revenue. Your total external revenue is actually 2000. Total external revenue is 2000, correct? So 75% of total external revenue is 2000 and 75% of it happens to be 1500. You must have noticed these are your four reportable segments, but their total aggregate external revenue is less than 75% of the total external revenue, which is 1500. So Ind AS 108 states that in case if such a scenario unfolds, in that particular case, entity need to select one more segment as reportable segment for the purpose of segment reporting. So now entity will decide that which segment it should choose, even though it is not meeting the threshold limit, but entity now will have to select one more segment out of the remaining segment, correct? Just to see to it that total aggregate external revenue is at least 75% of the total external revenue. This is another important point. Is it clear to you or not? Now there is another question in this particular June 23 examination which you should be in a position to do, but in this particular question, one thing just I want to tell you. When you will go through this particular question, it is similar to the one which we did. Only thing is that there are actually 6 what we call operating segment in this particular case. Their segment assets are given to you. Is it clear to you? Now, if you will note that segment asset of A, B, C, D, E and F. I want to actually make one point clear. That is why I'm writing 200, 336, 132, and then 62, then 96, and ultimately 54. So total of what we call segment asset is given to you, and total is also given to you as 880. So, but in this particular question, it is also given that deferred tax asset. In this particular question, it is also given deferred tax asset included in the assets of each segment are. Now below some information is given that these segment assets of the respective segments actually include deferred tax asset. includes deferred tax asset. For example, segment A is having deferred tax asset of 20, segment B is having 16, segment C is having 12 worth of deferred tax assets, segment D is having just 2, segment E is having 16, and F is having 40. So first of all, what you will have to do, you will have to subtract this deferred tax asset from this segment asset. Correct? After subtracting the same, and of course you will have to total them up also. So just to avoid the time, actually, I will do it for here. See here, if I am going to find out the total of deferred tax asset, now total of deferred tax asset as per the calculation which I have done is coming to 80. Correct? Coming to 80. So now in this particular question, the first thing which you need to do is you need to get the total of the segment asset by excluding the what we call deferred tax asset. So 80 worth of deferred tax asset must be subtracted. Is it clear to you? Now you compute 10% of it, that comes to actually 80. And after subtracting this, for example, the net segment asset of this department happens to be 180, and this happens to be, I think, 320, and this happens to be 120, if I am not wrong, and this one is 60, this one is having 80, and this one is having 40. So now you compare these figures with this one, 320 with this one, and so on, to decide upon the fact whether it happens to be a reportable segment or not. So the point actually I just wanted to hammer into your mind is that in case if the question states such information that there are some deferred tax asset, so in that particular case, how to actually find out on the basis of segment asset criteria which segment happens to be reportable segment or not. So first of all, you will have to exclude the what we call deferred tax asset. This is the point I just wanted to bring. Otherwise, rest of the question is absolutely same. And here I have done it what we call full solution, so you can easily manage it. It's a pretty small standard, simple one. Correct? In the next session when I will meet you, I will most probably meet you with what we call Ind AS 16, and this is being demanded by lots of students. Lots of messages were being bombarded. I'm bombarded of it, no doubt, but I was out of station for 3 days, so that's the reason I couldn't upload. But anyway, from tomorrow I will most probably upload what we call 16, and after that 8 and what we call 113 I will upload on a single day. So on that basis we'll wrap up this what we call series, and I hope that it must have given you a tremendous amount of boost and mileages. Looking forward to go through what we call your messages once again as usual. That gives me vigor, energy and zeal to come out with my best, as I keep on telling you in time. Till then, it's time to say goodbye.